Hello from Davos, I'm Brian Sozzi. We're inside the Congress Center for the second day of the World Economic Forum.
And I'm Julia LaRoche, and for the next 3 hours on Yahoo Finance, we will be bringing you all of the live coverage along with Yahoo Finance Editor-in-Chief Andy Serwer and anchor Alexis Christoforous, so you won't want to miss it. But guess what? It does not end there. We'll be bringing you the latest all week long on Yahoo Finance.
And Julia, we have to kick this off. Big tech-themed show here for right off the top of the show. And we have to start with Secretary Steve Mnuchin. He was on a panel. Let me read this quote to our audience. On the panel, he said, if people want to just arbitrarily put taxes on our digital companies, we will consider arbitrarily putting taxes on their companies. So you're starting to get the sense that there is a new digital tax war brewing between the US, the EU, and most importantly, the UK.
Well, look, it echoes what President Trump was saying just yesterday, that the US, we want to embrace tech, not shun it. And he said, look, we want to be free to innovate, because you're talking about solving real world big problems. And I gotta say, I noticed this at some of the panels this morning, particularly Google CEO Sundar Pichai talking about the potential of quantum computing and the ability to solve some of these big, complex problems that some of us can't even begin to wrap our minds around. So I was sensing quite a bit of optimism coming from Sundar Pichai during his panel. And this is something that, you know, when you think of big tech, sometimes you think of some of the bad implications of these technologies, but he was really shining a light on some of the optimism there.
Let me give some quick context. As we all know, France said late last year that they will look to impose a 3% digital services tax on revenues from big tech companies like a Facebook, like a Google. Today, UK Exchequer Chancellor Sajid Javid said they will go ahead with a digital services tax of about, I think, 3% come April. So again, the tech war is definitely on.
Yeah, but Brian, tech is a huge conversation here, and we're seeing that talk about so many different issues. You were mentioning some of the digital taxation issues, but it goes so much more than that. And we were actually checking out some of the panels, the breakfast this morning. What were you hearing from the things that you were attending?
Well, a lot of big executives were out getting breakfast this morning. First and foremost, Apple CEO Tim Cook had a closed-door breakfast with President Trump. Unclear what they talked about there, but we heard from President Trump yesterday. He gave 5G a shout out. That's something Verizon CEO Hans Vestberg talked extensively about with us yesterday too. And President Trump also said, embrace technology, don't shun it. So I think the president is continuing to play up a strong tech message.
I got to see some of the interesting highlights of the morning. Yahoo Finance had a presence at the Satya Nadella breakfast where Walmart International CEO Judith McKenna was speaking. And I thought this was interesting because you and I talk about this all the time. It's upskilling the workforce, and she was really touting the big retailers' academies. These are training programs in the back of more than 200 stores where they're reskilling their workforce. So this is another conversation as technology changes industries, as it disrupts industries. How do you reskill the workforce to keep up with these changes? And it's really going to be beholden on companies.
It's time for change in tech. We'll leave it there right now. We'll be right back with one of our biggest guests who will talk about the outlook for diversity in corporate America. Martine, good. Martine.
Welcome back to Davos. We're live inside the Congress Center, bringing you the latest interviews from the World Economic Forum. Our next guest is Mercer CEO Martine Ferland. Thank you so much for joining us.
Thank you for having me.
So I want to talk to you about what it means to build a sustainable financial future for workers and organizations. You write a lot about this. What do you mean by this?
Well, we mean an inclusive workforce. If you think about many countries in the world have aging issues, and the working population is shrinking in some places, and therefore we need to pull in all the resources that we can. The size and the productivity of our workforce really fuels our economic growth.
And, you know, the World Economic Forum put out a report about the gender gap, and we did see quite an improvement globally. It's still 99.5 years to reach gender parity, but when it comes to the economic opportunity, it got even worse. It's 257 years. So what needs to change? What needs to move the needle? It's 2020, and we're still having this conversation.
It's, yes, a bit discouraging, isn't it? But at the same time, there is progress, and the more we can measure, the more you can act. And therefore, measuring the inflows into the workforce, measuring the promotion up, making sure that women have access to opportunities and development goals and development learnings, and therefore measuring the promotion up and also monitoring why they would exit the mainstream, for example, are all measures. We're making progress. It's a little bit too slow, isn't it?
Too slow.
Martine, I hear a lot of talk. I've been to a lot of panels, a lot of talk on better pay for workers, better working condition for workers. Why is it so slow?
Why is it so slow?
To drive that change in corporate America.
It is not complicated, but it is hard. It requires a change in mindset. It requires a change in patterns. So sometimes, in particular in this economy where you're in full employment, the qualified skill set are quite rare, difficult to get by, you just jump on the next resource. So you really fish in the same pond. You don't take the time to go outside your usual ways of recruiting. So it requires more focus. It requires just more work.
Do you think that's a reason or a byproduct of, I say, boards and companies not focused on stakeholder capitalism, which, as we all know, is a major theme this year at the World Economic Forum?
Yeah, and then the stakeholders, the employees, are right there as an important constituencies. And we do believe at Mercer that engaged employees will just serve clients better, and all will be better in the end. And therefore, it's quite important to really engage and sustain and offer programs and ways of working that are inclusive of all.
And another issue and challenge out there is retirement. Sometimes I hear folks say that we might be entering a retirement crisis. What is kind of your outlook for retirement? What are the challenges there? What are the opportunities? What are the problems that we can solve?
Yeah, it's clearly something that keeps me up at night. If you look at the amount of savings compared to the needs that we have as we are living longer and longer. In the US alone, for example, we calculate right now that the average person will outlive their savings by about 10 years. And therefore, we're also living healthier, longer, and we need to change the mindset as to what does it mean to retire. What's the age at which people expect to? Are there flexible ways to exit the workforce in a more part-time basis, freelancing basis? I think technology really helps us to solve some of these problems.
Do you think government needs to step in here and address the situation? Sure, there's Social Security, but my generation, Julia's generation, Social Security probably won't even be existing anymore.
Well, with the working age shrinking, the working population shrinking, and more and more people being in the plus 50 range, I would be careful of relying too much on others. I think but also we have more and more tools nowadays to be more educated in an easier fashion. It's not always easy or interesting. People, they put off working on their retirement savings or thinking about that. They have more immediate needs. But at the same time, technology can help engage people, meet people where they are, and customize also the approach for them.
Yeah. So one of the other challenges, though, is that we're living longer than the men, and it seems like there's almost a bigger gap for us. So how do we help close that gap when it comes to the retirement crisis?
Yeah, there's absolutely a trifecta there, in the sense that we typically take more time off to take care of either children, and now with the longer age, longer living, caring for older elderly parents. We also, typically on average, have roles that are a bit less rewarded, less compensated on average, and we live longer. So we definitely have a trifecta. So we need to work harder at getting women in the workforce, keeping them in the workforce, keeping them in STEM type of jobs, for example, and really convening to their needs. They invest, they're much more risk averse. Yep. On average, and therefore the education, the system, the programs just need to recognize the difference in the way that they behave.
Well, it's time to get some great work done. Martine Ferland, yes. CEO of Mercer, thank you so much for joining us.
Good to see you.
Thank you.
Julie, a little bonus material. I know this is very much a tech-focused show, but the opportunity to talk to Saudi Aramco's chairman amidst all of the activity here at the World Economic Forum, most importantly about the outlook on climate change. I encourage everybody to check that article out. It's going up on Yahoo Finance very shortly.
Any insights they can share with us now?
Obviously, he remains very bullish on the outlook for Aramco.
There you go. Well, our next guest is Bill Browder. You're a former hedge fund manager. Now you're a human rights activist.
Yep.
So I just want to start. What do you think is the biggest risk that we face going into 2020?
Well, everyone looks at the world through their own prism, and I look at the world and see a lot of dictators and kleptocrats gaining power and a lot of democracy losing power. And so, from my perspective, a bad leader can do a lot of bad things, and we're seeing a few countries where there's some very bad leaders.
I should also point out that you were the initiator of the Magnitsky Act. How is that going, and what are you seeing when it comes to the implementation there?
So the Magnitsky Act is a piece of legislation named after my lawyer, Sergei Magnitsky. It was passed in 2012 in the United States, and there are now 6 countries that have it: United States, Canada, UK, and the 3 Baltic countries. It freezes assets and bans visas of human rights violators around the world. They hate it. Every dictator hates it. Every dictator is afraid of it. The big prize this year is the European Union having a Magnitsky Act. If bad guys can't keep their assets safe in the Western world in good countries, then they have less of an incentive to be bad guys, and that's the purpose of the Magnitsky Act.
Bill, do you think Russia's headed for an oil or a financial crisis driven primarily by the U.S. or growing U.S. dependence of our making our own oil and natural gas? It's something the president touted in his speech yesterday.
Well, so Russia is sort of a one-trick pony. It's sort of like a gas. It's effectively a gas station. That they've created such a terrible business climate that there's no entrepreneurship. Nobody starts businesses, and so they're totally dependent on oil and gas. And so if people don't want to use oil and gas anymore, then they got nothing.
You know, I read your book, Red Notice. Highly recommend it for folks who have not read it. And I remember this one thing you wrote in there because I'm going to tie this to the theme of WEF. You wrote about being an unlikely capitalist given your background. I would love for you to flesh that out and also talk about the theme here of stakeholder capitalism and what you're seeing as it relates to that.
So I've got a crazy story. My grandfather was the head of the United States Communist Party. And so in my rebellion, I became a capitalist. I went to Stanford Business School. I became a hedge fund manager. I went to Russia. I started the largest investment fund in Russia. And then all sorts of terrible stuff happened. I discovered corruption. My lawyer, Sergei Magnitsky, was brutally murdered. And so I became probably the only hedge fund manager to hang up my hedge fund shingle and become a full-time human rights activist. And so it's been a strange and unlikely journey at every step of the way.
Well, I know you're doing a lot of great work when it comes to human rights. What is kind of the North Star for you? What is the thing that you want to accomplish in your work now?
Well, the idea, the best thing I could do is to get every civilized country in the world to pass a Magnitsky Act so that there will be no place for bad guys to travel to and keep their money.
Bill, there were some rumors or speculation that your safety was at risk at this event. Can you update our viewers on the status of your safety?
So I come here every year to do 2 things, to meet with Western politicians about the Magnitsky Act, and then I also come here because it's the only opportunity I have to be face-to-face with Russian government officials and to challenge them openly on the murder of my lawyer, Sergei Magnitsky. They hate me for doing that. And I got a call on Friday of last week from the British security services saying they have a message for me from the Swiss security services that there is some type of risk to my personal safety based on Russia's anger towards me.
Is this the first year that you have gotten that type of message?
So I've been coming here for more than 2 decades, and it's the first time I've gotten a message like that.
Do you feel, what do you get out of WEF when you come here? You're just mentioning you're able to, make these confrontations. Do you feel that you're making progress when you come here, when you're getting your message out?
Yeah, this is a gathering of all the decision makers, opinion leaders, and important people of the world. And if I'm trying to get them on my side, I can meet 20 of them a day over a 4-day period, and really change the course of history.
How at risk is the upcoming presidential election to Russian hacking?
Well, the Russians hacked the previous election. That was objectively determined by all the intelligence agencies in the United States. It was clear, and there has not been any harsh consequences for Russia doing that. And moreover, there haven't been any dramatic changes in the defense for the future. And Vladimir Putin is a guy who understands just hard boundaries. If you put a hard boundary up, he'll move to something else.
Do you think they're gearing up for a big attack?
I think they've probably already started their attack. We just don't know where and how.
Well, Bill Browder, author of Red Notice, thank you so much for joining us at WEF this year.
Thank you.
All right, and our next guest is going to be talking markets. We have Troy Gajewski from Skybridge, so stay tuned. Welcome back. We're live inside the Congress Center at the World Economic Forum in Davos, Switzerland, and we're about to talk big data. We have Dan Streetman. He is the CEO of TIBCO. Thank you so much for joining us, Dan.
Hey, thank you very much, Julia. Brian, great to see you guys.
Good to see you.
Yeah. So first of all, when it comes to data, I want to talk about what the holy grail is for you when you think of data. What are the opportunities?
Sure. Absolutely. The holy grail really is to be able to unlock the power of data to make smarter, faster decisions. In essence, we at TIBCO help people connect everything in their enterprise, really get a whole unified view of that so they can intelligently understand all their data, govern it, control it, and then finally make meaningful, confident predictions about what that data is going to do for the next best action. So being here at Davos is great because all of the problems we're talking about solving really are unlocked by data.
You just said something that I wrote down, next best action, NBA. Talk to us, like, where exactly can we start seeing the next best action? Can you walk us through an example?
Absolutely. So like the world's largest airlines all use TIBCO in order to determine what's going to happen next in real time. As they shift through their schedules, they shift through the experience with an employee or a customer, all of those things are important aspects of what they do. Now, obviously, you go to other things around sustainability and ESG and other aspects where the data is going to be just as important. So just like we work with large companies, we work with great organizations to help them really solve problems that before now were impossible to solve.
Dan, I remember following TIBCO when you were a public company.
That's right.
What does the business look like now? I went back and looked into 2014, and you guys were profitable. Are you still profitable? What's the size of the company?
Absolutely. So we are now owned by Vista Equity. So it was great to have our chairman, Robert Smith, talk earlier today.
I sat on his panel.
Oh, great.
It was very, very insightful.
It was tremendous. The 21st century leadership, that paradigm. So it's phenomenal to work with a company like Vista and help really continue to invest in our R&D, bring next generation solutions that really help our customers, organizations everywhere solve tough problems.
Well, you just mentioned leadership, so
Right.
I want to bring this up because you are a military veteran, so thank you so much for your service. What did you learn from your time in the military? You talk about a can-do attitude, and I'm going to ask you to tie that to the theme here of stakeholder capitalism. So your learnings from the military that you apply to your business and how you think about all of the stakeholders.
Sure. Well, first, thank you for acknowledging the service of all those around the world. Anybody in uniform, from fire service to first responders, on behalf of them, I thank you guys for acknowledging that. I'll come back to this whole aspect of what you learn in any organization that has a service focus is the idea of being a team, the idea of being cohesive. And I love the theme this year, stakeholders for a cohesive and sustainable world. And I think that's a phenomenal way to bring leaders together from non-governmental organizations, from corporations, and from governments. And I think that's a phenomenal aspect of we really are better together. And I think that's a phenomenal piece of what we do here at Davos.
Dan, I want to get back to the business just a little bit. 6 years under the House of Vista Equity Partners. Do you have any plans to go public again?
So our job is to make sure our customers are successful. If they're successful, everything else follows. So really that's our key focus, is continuing to sustain our innovation, to work with the largest customers around the world and most impactful organizations to really make a difference in their lives.
But do you think, the valuation at the time was close to $4.5 billion. Do you think your valuation has grown since then?
If you do the right things, your valuation follows. You're absolutely continuing to deliver value to our customers and to our stakeholders.
So you've done the right things?
We've done all the right things and we're continuing to do more. We look forward to actually continuing to engage with everyone here at Davos. It's just a great audience and a great forum.
Yeah, and I want to talk to you about just the idea of building a business because we know you were a Salesforce alum, and I think you touched on something about culture and bringing in the stakeholders. So what have you learned in your time building a business? What is it that works? What's the secret sauce?
Absolutely. So culture is critical, and we've heard that from Satya, we heard that from Mark earlier, we heard it from Keith Block, the co-CEO at Salesforce. Culture defines who you are, and it's a key aspect of what we do at TIBCO. Our TIBCO spirit, we call it, helps drive all our aspects around innovation, how we work together, how we are bold, and most importantly, how we're optimistic about the future that we can unlock with the power of data.
Is stakeholder capitalism a look into the future?
Stakeholder capitalism is now. I think stakeholder capitalism really reflects all aspects of what companies do. We heard earlier, really, companies exist to solve the problems of the people and the planet. And if you can do that, you can serve those stakeholders, everything else follows.
Dan Streetman, thank you so much for your time. I appreciate it.
It's our pleasure, and I really appreciate being here. Thanks a lot, guys. Take care.
All right, and we have our markets guest up next, Troy Gajewski from Skybridge. Stay tuned. Welcome back to Yahoo Finance's live coverage inside the Congress Center at the World Economic Forum. We're joined by Skybridge co-CIO Troy Gajewski. Troy, thank you so much for joining us.
Yeah, it's great to be here.
All right, Troy, we got to start with the markets.
Of course.
When you look at 2019, Jeffrey Gundlach put it this way to me: you could throw a dart and pretty much everything was up. So as we are now into 2020, what is your outlook for the markets?
Well, so if you think about, there's a disconnect between the real economy, corporate fundamentals, and markets, and the main explanatory variable for that is Fed policy. So when you think of what the Fed started to do in September, they started to expand their balance sheet by over $100 billion a month, which is on pace with what they did in QE3. And of course, this came right after 3 cuts. So you have extremely accommodative monetary policy, which is driving risk premium lower and equity multiples higher. So if you look at the first 3 to 6 months of this year, it's more than likely that this trend of expanding multiples in the S&P continues, and we could see a scenario where equities are up 10% the first 6 months. Now after that, that's where it gets a bit dicier, because if the Fed does stop expanding their balance sheet, markets start to focus on the upcoming election, because at this point it's pretty much consensus that Trump will win re-election. Look, it's hard for a Republican to win Pennsylvania. So, you'll start seeing more volatility, we think, in Q3. But until then, enjoy the ride.
Yeah, Paul Tudor Jones is out there with some comments at I believe yesterday morning at the World Economic Forum, comparing today's market to early 1999, I guess before the dot-com crash. Do you see it that way?
Yeah, so we've talked about this late last year. I mean, the question was 2019, 1999, or was 2019, 1998? And the similarities are pretty eerie in that, you think about 1998, the Fed cut rates 3 times, did temporarily expand their balance sheet because of long-term capital and the Russia default crisis. This time around, it was in order to stave off, some of the externalities or the negative consequences of the trade war. But then on top of that, out of the blue, they've massively expanded their balance sheet, and they've promised to do at least $60 billion a month in T-bills up until June. So if anything, this could be 99 on steroids. Now, we hope that we don't end up with bubbles, right? Obviously, that
sure sounds like one is forming right in front of our face.
100%. So what the Fed is doing now is they're running the medium-term risk of bubbles in equities, corporate credit, and commercial real estate in order to further reduce the near-term risk of recession. And we always remind our clients that the last 2 recessions were caused by collapsing asset bubbles, the first in equities, the second in housing. So, it's a dangerous game the Fed's playing. Ultimately, they wanted to decrease the risk of recession in 2020. We just hope that doesn't lead to a massive hangover in 2021.
Well, I want to get your reaction to President Trump's speech here at the World Economic Forum, really touting the strength of the U.S. economy, also the stock market, and then talking about the Phase 1 trade deal, and that he says that Phase 2 is coming quickly. From your vantage point, what do you make of his comments?
Well, look, I think what you make is that fortunately trade war escalation has ceased. I mean, when you looked at the path to recession at the end of 2020, it would have relied upon continued escalation in trade. We would have had CapEx continue to decline, business fixed investment continue to decline, and that eventually spread to the labor market. So now that situation has ceased to deteriorate, we're looking at somewhere between 2 and maybe 2.25, upside surprise at 2.5, with admittedly Boeing being a wild card. How much does that drag on manufacturing? So, on the one hand, resolution of trade conflict's been a good thing, but on the other hand, no one really expects this monumental Phase 2 deal that's going to lead to 3 or 4% growth. And by the way, the thing we always remind people of is the Fed actually did Trump a favor in 18, because if they had a tightened policy in 18, we would have had a bubble in 18, and it would now be collapsing in 2020, which would have meant he had very little chance of re-election. So, it's interesting. The president says a lot of different things. He's right that the U.S. economy is strong. He's right that we have had the successful completion of trade deals. But, we wouldn't have 4% GDP growth if the Fed cut rates by another 50 basis points.
I want to switch gears a little bit. This theme of the conference, among many, is climate change.
Yes.
And I hear a lot of people telling me they're really taking what Larry Fink at BlackRock said in his annual letter. As a person who runs money, are you willing to dump shares in good companies if they don't have those ESG or strong ESG goals?
No. I mean, look, fiduciary responsibility trumps all else. I think the point people like Larry and others have made is that we're finally reaching a point where you can actually have wealth creation tied to climate change agenda, particularly with the increased efficiency in photovoltaic cells. If you look at what Japan's doing with the hydrogen transition in their economy. So hopefully we're getting to a point where you're not forced to make that decision, either embrace ESG or stick to your fiduciary responsibility. Over the next 5 to 7 years, we think they'll be synonymous. autonomous, and that you won't have to make those difficult calls.
Do you think BlackRock would cause turmoils in markets? If they dump these positions, it could be pretty massive.
Yeah, look, I mean, they're obviously the largest owner of just about every stock on the planet, and as we move from a world of active investment to more passive, when they decide to shift policy, that can be very detrimental from a liquidity standpoint. And I think it's actually ironic right now that you see activist investors pushing back at passive investors who are theoretically overstepping their bounds in non-fiduciary areas. So it's fascinating to watch. Our main focus is clearly on the economy and markets, but that is a big part of the Davos conference, obviously.
And Troy, you've been coming here before, so I got to ask you, because we've been asking a lot of our guests this, what do you get out of coming to the World Economic Forum?
Well, for me personally and professionally, it's very similar to our SALT conferences, which we have in Vegas and we have one in Abu Dhabi. The difference is here they have current world leaders, current presidents. 2 years ago, I believe it was Xi. Trump couldn't make it last year, but he made it this year. Whereas at SALT, we tend to have ex-presidents and ex-members of the administration. So that's really cool, to see, 10, 15 feet away, listen to Angela Merkel explain, the transition from
Just fun to see her walking in the hall.
Yeah, it's very, very interesting. And then I think the dialogue you get with other business leaders on what their views are on the various policies coming out of the administration. Because remember, 2 years ago, most embraced deregulation and tax reform. I don't think there was a business leader in the world that didn't see there was merit to that. But the huge uncertainty was around trade. And how much would that hurt CapEx? How much would that slow growth? Would we be honest with the American people that there's a trade-off there? And so I think what's interesting is 2 years later, we have some degree of resolution. Obviously things are going to heat up with Europe, and maybe we'll get a phase 2. But so for us, it's being real-time exposure to other decision makers and understanding how the policies are going to affect markets going forward.
I wanted to get your quick thoughts on the trade deal. Secretary Mnuchin said today that there are no talks or really underway or no progress on a phase 2 trade deal. Is that a reason to sell stocks at these levels?
We don't think so in the short term, because again, the biggest issue with trade is a lack of escalation. I really don't think there are many macro participants or active equity investors that are hoping for a hug moment with China and everything's going to be great. So lack of escalation is one. I think what Mnuchin's basically saying is, look, we're going to keep using the carrot and stick approach. If the carrot doesn't work, we'll come with the stick, like they mentioned with Europe. And in the meanwhile, from an investment standpoint, focus on lower risk of recession and massive expansion of the Fed balance sheet. So don't use that as a reason to sell equities. Troy
Gajewski, co-CIO of Skybridge, thank you so much for joining us.
Great to be here.
Don't miss this. We'll be talking about wealth inequality. It's something that's dividing the globe, so stay tuned. Welcome back to our live coverage of Davos inside the Congress Center. We're joined by Deutsche Bank's chief economist, Torsten Slok. Torsten, there's a lot of conversations going on here about global growth, but growth sometimes comes with side effects. What are those side effects?
Absolutely. I think that this year's event is really coming to a point where consensus is appreciating that there are three side effects that are very critical, namely pollution and climate change. Then there's also inequality, and then there's higher debt levels. And if you take these three things combined, you say, well, shouldn't we just have as much growth as we can have? Well, maybe we now reached a level of welfare and a level of income of standards of living where maybe some of the consequences are just so negative. So that's why a lot of the debate and a lot of the things around these unquantifiable issues of climate change, inequality, and debt levels haven't gone up so much.
Torsten, President Trump, in another interview today, suggested if the Fed just cut rates again, the U.S. economy would be growing close to 4%. Do you agree with that?
So, I mean, if you take the Fed's model purpose of the U.S. economy and you ask the question, if you lower the Fed funds rate by 25 basis points, you will only get roughly 0.1, 0.2% more in GDP. So in that sense, even if the Fed went all the way down, it would be difficult to get all the way up to 4. That being said, you could start thinking about today whether the Fed should not have raised rates in 2018 and whether they cut rates too little in 2019.
Do you think they will cut again soon?
So the bottom line to that is it's all about inflation. The economics profession, as you all know too well, has just had a really hard time predicting inflation for so many years, and inflation has been incredibly subdued for a very long time. Even though the unemployment rate is only 3.5%, we see a little bit of wage inflation, but not much, and we definitely see not much in consumer price inflation. So the Fed has been arguing much more around the issue of is there inflation or not. And for now, the answer to your question, Brian, is we just don't see any rise in inflation on the horizon for the next 18 months.
Let's dig into some of these side effects you were just referencing. Inequality. This is something that's come up over and over, and sometimes I watch in your chart books that you put out about things like the stock market, for example, and you'll see President Trump tout the stock market and the gains there, but the reality is not everyone's benefiting from the climb in the stock market. What are some of the myths, if you will, around that?
Yeah, so after the financial crisis, one of the main effects was that the Fed cut interest rates that lifted stock prices, that lifted home prices. Who benefits from that? People who own stocks, people who own homes. But since the financial crisis, there are fewer people who own homes, there are fewer people who own stocks. So that means that the wealth concentration was on fewer hands. So almost by definition, the Fed was part of the reason why we got more inequality. So the answer to your question is that because of inequality has gone up, we also now have had that people at the low end of the income distribution who have a higher propensity to consume, they tend to spend more of their money when they get it. They have unfortunately not been contributing as much to the recovery, and maybe therefore inequality is actually a reason why the expansion has been so weak for the last 10 years.
Could you tie inequality to climate change? Is there a correlation there? Is there something to that?
I think what's interesting about that question is also think about it, both the ECB and the Fed at the moment are having a review of their policies, and the ECB has been particularly outspoken, Lagarde, saying we should actually look at climate change. We should look at inequality, and we would say, well, in financial markets, why should we look at that? But maybe it is because we've gotten to a point where these other things that are going on around GDP per capita, before we just close our eyes and say, oh, that's probably not a problem. But it looks like now that this is becoming more and more an issue, that even central banks are thinking about changing their emissions. At the same time, the Fed and the ECB changing having a review and changing their emissions is a potentially very important issue for markets.
Torsten, Christine Lagarde is about to announce the outcome of her strategic review. How disruptive could that review and those findings be to markets?
So that could actually potentially be quite disruptive because think about it, both, as we spoke about earlier, both for the Fed and for the ECB, inflation has been incredibly low, surprisingly low. It's very difficult for economists to explain why inflation has been so low. So maybe now, both reviews, maybe the outcome is to say we're going to allow overshooting in inflation, we're going to allow inflation to be a little bit higher. And that's another way of saying we're going to keep interest rates lower for longer. And if interest rates are lower for longer, it could be boosting stock markets and corporate bonds, IG, high yield level loans more, simply because if the risk-free rate, in this case the Fed funds rate and the ECB rate stays low, well then people will continue to hunt yield like we've seen and we've discussed for the last 10 years.
Getting back to U.S. markets, do you think U.S. markets, U.S. investors have lost their mind? I'm looking at this IMF report we got this week. Global growth, 3.3%. Something doesn't seem right.
Well,
we have the market trading out at 21 times earnings?
That's right, and as you think about also, that's a relatively, it was a downstep from what their growth projection. I used to work at the IMF in the division, putting together.
Well, they do good work, all right.
They do very well, good work. But at the end of the day, they have been revising forecasts down, which is telling the market, well, maybe the Fed will therefore stay on hold for longer, and therefore we know what that means. If the Fed is dovish or interest rates stay low, I should go and hunt yield out the risk spectrum. First, I should buy investment grade credit, maybe high yield, maybe even equities, maybe even emerging markets, with the whole idea that if the risk-free rate, the Fed, is going down, then I should just hunt yield, even no matter what happens to fundamentals. So you're right to say there looks to be almost central banks versus fundamentals, because fundamentals are not getting too much attention. It really is all about, is there more dovishness or central bank money printing coming around supporting financial markets?
Torsten, before we let you go, a lot of people are learning things here at the World Economic Forum. What have you learned so far?
Well, I am taking away from the program that you have running here just next to you that some of the sessions are like on plastic bottles, it's on rising levels of oceans and other things. And some of these things is a unique opportunity to hear things and think about things that you haven't thought about too much, at least before. So I try to go and see things and try to broaden my mind and say it should not only be about unemployment, inflation, and S&P 500. We have to look out broader. And I think this is what the whole forum here does so well, namely try to discuss a broader range of issues than the things that we just talk about on Yahoo Finance, namely what will happen to the dollar, to interest rates, and to the stock market.
Torsten Slok, Chief Economist of Deutsche Bank, thank you so much for joining us.
Thanks for having me.
And find out what's next for the future of media. We sit down with CEO of Verizon Media, Guru Gowrappan. Welcome back to Yahoo Finance's live coverage of the World Economic Forum. We're live inside the Congress Center, and we have Verizon Media CEO Guru Gowrappan. Guru, thank you so much for joining us.
Thanks for having me.
All right, Guru, I want to talk about the cornerstones of the business for Verizon Media that are really important to you going forward. What are those?
Number one is trusted content. I think when you think about, and we did a lot of discussion here in Davos around that, how much the value and ecosystem around media is moving to trusted content. So I would actually put it there. And then moving down the value chain about closing the loop, when we talk about commerce, how content and commerce connects to that, and then really creating communities that really trust the content and do the transactions.
Guru, what will that future looking over the next decade of that fusion with commerce and media?
Look, one of the things I say when we talk about Verizon Media and other many media assets, when we create content, we're in the business of creating inspiration. What's happened in the past is we create inspiration, but the transactions happen somewhere else. You don't participate in the value chain. I think that's going to change. We have started changing it because we see 60% of our content has commercial intent. You write about travel, you write about Bali, you write about Davos. The next thing in a week or 10 days, you're looking at travel or booking something. We don't participate in that. So I think in the next 10 years, I think everybody's going to become more end-to-end, close the loop, so that people can participate in their economy and actually do the right thing for consumers in terms of user experience.
You know what, I'm also sensing that there's a community aspect involved in this. How important is community to you when it comes to this?
It's massive, right? We talk about society. I think when you think about Verizon, we talk about 4 key stakeholders. We talk about customers, employees, society, and shareholders. Community is a big part of society, what we do, and actually our customers as well. When you think about that, you take finance, you take sports, you got a very deep community base which follow a brand. You take Yahoo Finance, you take Yahoo Sports, there's a deep, but we don't do end-to-end for them, right? So I think what we're trying to do now is our core product, everything you do every day, not just generates revenue and engagement, but also serves the community. So it's very important.
Corporate culture is a big theme at Davos. What have you done to turn the corporate culture around in Verizon Media? I think you talk to a lot of employees internally, and it's a very much a different company.
Look, I think at core, we have to be purpose-driven. I think the economies you take from China, India, US, any big market, employees in today's world are looking to do more than paycheck. It's more about, am I here adding value? Am I having a big impact to the customers and broader economy? We touch 900 million consumers today globally, right? That's a big deal. Not many companies, there are probably 4 companies that fall in that zip code of being able to have that impact. But the bigger thing is you don't start from top, you say from bottom up, saying, hey, are you having a big impact? I'm a mission-driven guy, and I think every employee now has become so much about mission and purpose, about creating networks that move the world forward, and also connecting people to their passion. I think that's helped rather than saying, hey, achieve the business goal. Those are the output. If you put the right input in, you see the right output.
You just mentioned that you're mission-driven. What is the North Star for you? What is that mission that you really want to accomplish?
Look, number one, we're already doing great on Yahoo Finance and sports and all of those things. I think the bigger thing is we touch about 900 million consumers today. How can we grow that and have a much bigger impact? I think that's truly having a big societal impact leads a lot of it. We've been on a curve, if you think about 2019, was about stabilization of the business. 2020, I've said, is all about growth for media business, and I think that sets the stage for next 5 and next 10 years. So it's all about growth.
You mentioned sports. Can you give us an update on the sports betting partnership?
Look, betting has been a big bet, pun intended, when what we did in 2019. And the idea was, again, when I talk about closing the loop for customers, they're not just coming in, consuming scores, content, but then going through the value chain saying, hey, now I'm playing fantasy sports. The next thing I want to do is bet on a player, bet on a team, bet on any of the odds that you see. So we launched our partnership with MGM 3 months back. We launched 1 state. There are many more states coming live. It's doing really well for us. And I think this is something, again, come back to that, where you keep the consumer in the ecosystem and give them what the value they're looking for, so that they're not leaving for another system.
In 2020, more states.
Yes.
I want to talk a bit about your background, because you came over from Alibaba.
Yeah.
What are you learning? What have you learned since becoming a media company CEO?
Look, if you think about China and Alibaba and a lot of those things, a lot of the lessons are it's a platform company. Mm-hmm. If you think about us, we're a platform company. And the biggest secret of platform company is not just you creating a platform, but about how all stakeholders participate in that platform. Your customers, your shareholders, your society, how you make money, all of that coming in. So you have to almost make sure that you're listening. When you're closed and you're not listening outside in, then you're not growing. So I think that is a big secret of companies doing hyper growth. I think Alibaba has done that really well in China. I think we are doing that. When I start looking at some of our properties growing 30-40%, because we've now listened to our customers and really leapfrogging those innovations.
And here at the World Economic Forum, people are learning so many different sessions, so many panels. I mean, so many people just walking the halls. What are you taking away from this year's World Economic Forum?
Look, we had a big session this morning with the Governor's Council around media. We talked a lot about trusted content. And one of the things we're trying to lead the charge in that space. One, if you remember, late last year, we got out of social content, or UGC. We sold Tumblr, because the idea for us, when you do trusted content, you're not going to do UGC. It's hard to police, it's hard to monitor. We want to create our content or partner with great content creators to put on our platform. That's number one. Part of that, if you think about last week, we launched One Search, which is around private search, right? The whole idea is we're not going to track, take your data, sell your data, target you based on what queries you had. You come in, you do one search, the search is vanished after that, and that's again part of the whole idea around trusted content, creating privacy. So I'm taking away that we as companies and CEOs and leaders have a bigger responsibility for society. The time is now to act. It's not about 5 years out. So we have a lot of things to do this year and beyond.
Well, it's certainly a great thing to hear. Guru Gowrappan, CEO of Verizon Media Group, thank you so much for joining us.
Thank you.
And find out how venture capital can take on climate change next. Welcome back to the World Economic Forum. We're joined by DC VC's managing partner, Zack Bogue. Zack, thank you so much for joining us.
Thanks for being here.
So it sounds like you all are all in on climate change. How can we unleash the power of venture capital to take on this massive challenge?
Sure. So DC VC is an early stage deep tech venture fund. And by deep tech, we mean we like to back entrepreneurs who are solving hard, real world problems computationally. So they're applying computational approaches like machine learning and AI to hard, real world problems using biology and biotech and other sciences. One of the hard, real world problems that we're all facing now is climate change, and we think there are some credible approaches that can start to chip away at some problems there.
So what is the moonshot for you? I mean, you can give us some examples. I know you all invested in a company called Planet. They're doing some really cool things, but what's your moonshot?
My personal moonshot is I feel that advanced nuclear power is going to be a big part of the solution for creating clean energy or zero carbon energy for the world.
You know, what are some of how should an average investor, or how could an average investor invest in deep tech? I looked at some of the companies you hold. I have never heard of some of them.
We feel that it's actually fairly difficult to invest in deep tech, and that's kind of what we do, and that's why our investors hire us to invest in these types of companies. You need an understanding of science, business, technology, really a sort of a coupling of all of these.
Do you imagine
things.
some of these companies will go public?
Absolutely. We had a great validation of one of our early investments in Elasticsearch, which is an early scale-out compute company that went public about a year and a half ago.
I want to talk more about this idea of just unlocking the potential of venture capital when it comes to climate change, because it sure seems like policy takes too long. So what is the opportunity that you see with VC?
It's a tremendous lever for spurring innovation. and has proven that over the past 50 years of the industry. And a great example of this is our portfolio company, Pivot Bio, which has created computationally bred microbes to replace chemical fertilizer. So chemical fertilizer is this very polluting industry. About 10% of global greenhouse gas emissions are attributed to it, all in. And Pivot's microbes can actually let crops fix their own nitrogen and eliminate big chunks of the chemical fertilizer industry as it, if it continues to progress on its track.
A lot of the panels here are talking on regulation in tech. Where do you stand on that? Do you think some form of regulation would be good for big tech?
Absolutely. I think there could be some government intervention. Luckily for us, deep tech does not include consumer internet, which I think is where in the crosshairs right now. So I will leave that to the regulators and the large technology companies to figure that out.
Is climate change an infrastructure problem?
Absolutely. We've built the wrong infrastructure over the past, couple hundred years of the Industrial Revolution, and we need to build a bunch more, much cleaner infrastructure in energy, in transportation, in the way we design cities. So absolutely.
And what is your sense on tech valuations right now?
Luckily as well, deep tech is a little bit more immune to the hyper valuations that we're seeing out there, but we are seeing some pretty high valuations, across the board in technology companies. Deep tech companies are a little bit, less accessible and also take longer to grow, so we're not seeing the valuation bloat that you see in other sectors.
Another thing that I just thought was interesting, just reading about your company, y'all were talking about computational capabilities that just seemed like science fiction 10, 15 years ago. What's next?
What's next? We're increasingly excited about what we're loosely calling biology as a platform. A lot of materials innovation over the past 90 years was driven by petroleum and inventing new compounds of petroleum, like plastics, which actually was a huge innovation and made a lot of the built environment around us. The design space for biology, if you can modify the genome and have a bacteria make a plastic-like substance, one, it creates 1,000 or 10,000 times bigger design space, and on the other hand, it also comes from plants which are renewable and not from petroleum.
You recently raised a big chunk of money, $725 million?
Correct.
Are you nearing any investments? New investments?
Absolutely. We've made, I would say, less than 10 investments, but that's a pretty good clip for us out of Fund 5, which is the newest fund. And we're rolling, continuing apace.
Well, Zack Bogue, managing partner of DCVC, thank you so much, and hold it right there, because we are going to toss to Andy Serwer and Alexis Christoforous for another 2 hours of live coverage from the World Economic Forum. Andy, Alexis.
Thanks so much, Julia and Brian. Yep, we're here with Andy Serwer and myself, kicking off day 2 here of the World Economic Forum in Davos, Switzerland. And Andy, this morning, President Trump held a breakfast with some big American CEOs. And coming out of that breakfast, I actually bumped into Ivanka Trump, who's here with her husband, Jared. They're part of the delegation here, the White House delegation. We had just a couple of moments to speak, and she said, my father has a very positive message about America to share with all the attendees here. And the speech he gave here at the forum yesterday was very optimistic, and it sounded in many ways like a stump speech as he started to talk up all of the accomplishments of his administration. But that breakfast, I would love to get some news coming out of that breakfast, because there were some big names in that meeting.
Yeah, well, no doubt, Alexis, Davos is in full swing. The streets are rife with CEOs and leaders from around the world. In fact, Prince Charles is talking right now, so we're missing that. But had a chance to speak to David Solomon from Goldman Sachs last night, as well as Marissa Mayer, our former CEO. Yeah. And yeah, this CEO breakfast with President Trump this morning, there were a lot of heavy hitters there, like Mark Benioff, Tim Cook, Brian Moynihan, and Chuck Robbins from Cisco, as well as, I'm happy to say, our first guest today, Rob Capito, co-founder and president of BlackRock. Rob, welcome.
Thank you.
So I have to ask you, how was breakfast and what went down?
Well, breakfast was great. President Trump talked about all of the growth plans that he has for America. He complimented many of the CEOs for their growth plans and for helping to keep the economy going. It was very focused on job growth and job creation, which Ivanka Trump is sponsoring. And we heard from other CEOs about how they're joining programs to create jobs. And it was a very optimistic speech. He talked about some of the new trade deals that are going to take place which should make everybody happy. He talked about the low and lowest unemployment in the United States, which should also make people very happy. And we left very optimistic about the future plans for jobs and growth. And I really admire Ivanka for stepping up and creating many, many jobs since the administration started. So it was making sure that he knew that he appreciates what CEOs are doing. He also had some very good ideas for CEOs in various businesses. And I left feeling very optimistic about the future for the United States.
And it sounded like the president was in a good mood. You said it was even entertaining in spots.
Yes, I mean, you know that President Trump can be very entertaining, and he did it in his style. He called out a few people for things that they are doing well. He had various cabinet members speak as well as to what they're doing. So I thought it was a very good meeting, a good breakfast, and I was very honored to be invited.
And he's making the most of his time while he's here. Yeah. He's here for just a short amount of time. I want to talk about Larry Fink and what he said recently about climate change.
Your CEO,
right?
Your partner.
Yes.
Climate change reshaping the financial landscape. And I'm curious, as you move forward with this mission now, how do you sort of come to terms with being able to provide shareholders with maximum returns while still staying true to this mission of investing in sustainable companies?
Well, this was really a call to arms because it's not as much about divesting in companies. It's focused on investing in companies that are going to create the new energy, help in climate change, and understanding that the world of finance is going to change as everyone is very focused on ESG. How are we going to represent that in a portfolio so that you're going to get the best performance? And that's really what it's about, is understanding that there are issues, there are people that are very focused on the issues that want to do things. In order to do that, it's going to change the performance of the funds that you invest in. So just for example, if we had had this call to arms last year, you might have not had coal represented in your funds to the extent that it is, and you may have invested more in renewable energies and other energies that are going to change the climate going forward. Now, if you look at coal stocks were up 2% last year, and renewable energy stocks were up 25 to 30. So this is a call to arms to understand is as we start to focus on this, and this becomes very important to the world, people are going to invest differently, and we want to make sure that we're telling our clients to be in front of this, as well as make sure that everyone is starting to become transparent in their disclosures on what they are doing for the environment going forward, and that's going to be table stakes for us to invest in it.
And there are new standards that are being hashed out right now, right, Rob?
Well, standards are important, but we have to actually make sure we understand that they're important standards, that they work, that we can measure these. And it's not going to be through a new product that we're going to get all of the effects of this. It's going to be from everybody focusing, and we're going to commit a lot of resources to technology that we can look at portfolios and with the same risk and returns make them more ESG friendly and focus a lot on climate change, which is what our clients are telling us they're very, very interested in. The other part of the letter is about purpose. Right. And that the new world that we're hiring all want to come to a company that actually has a purpose, that they feel that they're going to make an impact. So we want to alert companies, if they're going to attract and retain people and grow their companies, it's important to think about what that purpose is and tell us about it. As a very large investor, we want to stimulate the dialogue. And if we get people thinking, more companies actually want to participate in this. So we're going to stimulate that, and it was great timing before coming to Davos, and that's what a lot of discussion has been about, sustainability.
Right.
So, you talked about not divesting from companies that some may consider offenders. I think of an ExxonMobil or a Chevron, sometimes misunderstood companies. Do you see going forward BlackRock divesting of companies such as those oil giants?
No, I think there are some obvious thermal coal and certain type of other fossil fuels and certain type of other products that are not going to be on the top of our list to be an investor in.
Right.
But as I said, it's not about as much about divestment, because some of those very large energy companies are actually the biggest inventors, producers in new energies. So we want to hear the dialogue. Where are they putting their money? Where's the growth going to come from? So that's why it's just not that simple to pick a name because of one product that they're in. There are also a lot of complications. You know, it impacts many businesses, like the insurance business, like locations of where you're going to be. You know, climate change affects a lot of companies, and they're going to have to think about this for their future revenue growth.
Hey, Rob, we don't have a lot of time left, but first of all, I want to tip my hat to you, because last year at this time, you were optimistic about the markets. Many other people weren't, and it looked bad to start the year, but you ended up being right. And so kudos to you. Now, what do you see for 2020?
So I'm leaving this conference even more optimistic than I was last year. And I think people last year, and you and I had this very long discussion, we're talking about a recession, we're talking about interest rates rising and job growth. And what I pointed to you is that there's so much cash on the sidelines, earning very, very little. And it scared a lot of people last year, and they stayed in cash. About 38% of investors are in cash. They're never going to be able to retire in dignity if that money is not invested. Right. You can't invest for the future in the future. And I think right now there's more demand than there are assets, which tells me that the stock markets across the globe are going to continue to rise. Interest rates are going to stay low for longer. And when you look at the picture and you'd say, what would be the dream team? Very low unemployment, growth across the globe, more demand than supply of assets. All of these things are check, check, check. It's just that people are having a problem because of so many other social and political issues of trying to feel optimistic. We want to keep our investors focused on the prize. It's about creating alpha. It's about returns. And if you just sit on the sideline and don't get invested for the future, with the longevity that people are having because of better health care, it's not going to be easy to be able to retire and live those extra 10 to 14 years. So I'm very optimistic, and I think companies here have told me that they're very optimistic as well. They're just a little nervous about pushing it too far.
Well, he was right last year. We'll see if he's right this year.
I like the optimism.
Rob Capito, president and co-founder of BlackRock. Thanks so much for coming.
Thank you very much.
Thanks.
Good luck.
All right, coming up next, two of the biggest names in AI and machine learning are going to be joining us. Stick around, that and much more coming up. Welcome back to our live coverage of the World Economic Forum here in Davos, Switzerland. We want to welcome to the show Carmine DiCibio, CEO of EY. Great to see you here again, Carmine.
Great seeing both of you.
So I understand you had some interactions with our president while you were here on the ground in Davos. I'm sure you heard the speech he gave yesterday. He was very optimistic, not only about the U.S., but seemed to be optimistic even about the global economy. What was your big takeaway?
Yeah, I mean, I only saw the first part of the speech, which was very pro-U.S., almost a campaign speech, is what most people are saying.
We've been saying that, yeah.
But then I was part of the International Business Council overall meeting, and he did come to the beginning of that meeting and really mingled with all of us, about 100 CEOs in the room. I would say he was in a very good mood. So when I talked to him, we talked about, frankly, talent and how do we retain more talent in the U.S., in particular talent that goes to top schools and so forth. So he was very much in favor of retaining that talent in the U.S. so EY could hire him. So that was pretty good. Yeah, that was pretty good, I would think. And that was actually my little conversation with him.
It's kind of ironic, isn't it, that the president gets such a great group of CEOs in one room in Switzerland.
Right,
but there's so many here, I guess it kind of makes sense.
Yeah.
So I want to ask you, Carmine, switch over and ask you about tax. And, you know, it's been 2 years now since tax reform. Has there been improvement when you talk to clients, and where do things sit there?
Yeah, so my predecessor was very involved in getting tax reform done in the U.S., and we think that actually looking back, that's probably this administration one of the things they got done and one of the best things they got done for American business. Now, looking back, and this was a concern of ours at the time. It was my predecessor's concern around share buybacks, and we're going to have a lot of share buybacks and not invest in CapEx and so forth. So there has been probably more share buybacks than we wanted, but there still has been investment. And when you look at investment, you can't just look at CapEx investment. You got to also look at how many people are being hired. And the job market in the U.S. is stronger than ever. That is true. It's hard to argue that. You could argue more about wage increase, but jobs are out there and companies are hiring and hiring in a big way. So we do think that tax and tax reform has helped that.
What about wages?
Yeah.
I want to just follow up on that, Carmine. I mean, are American companies paying people enough? I mean, they're complaining, well, we can't find any workers. How about giving people a big raise?
And that's a way to retain talent, too, right?
I agree.
To pay them
I
more.
totally agree, and so I think that's moving. I think companies are paying more and more, but it's moving slow. It's moving slow. And this is one of the metrics really around long-term value, and one of the metrics that we've been talking about here is around pay and pay equity in terms of people and so forth, and that's something that we're very focused on, as an overall group here in Davos, and so I do think wages are increasing in the U.S. They're probably increasing slower than what we thought.
Are you getting indication talking to your clients about what it's going to take for them to turn the corner on CapEx spending, on wages? What do they need to see or have happen to feel comfortable to sort of expand that?
Yeah, so if you roll back, to 2 months ago, the answer I would get is, well, there's always uncertainties. And
right, but there's more clarity now, right?
Exactly.
So between Brexit and trade.
You got it. Much more clarity, so there shouldn't be the uncertainty. So
right.
I do think that there should be more spending on CapEx going forward. There'd be no reason not to. Look, our business is doing very well because companies are transforming themselves. So they are investing in technology, for sure. I mean, coming in here, I just found out we won a big project and so forth.
You won a big project?
Won a big project.
Can you share it with us?
No, I don't think so. I think it's still.
All right.
But it's
you come back to us on that.
It's a very big project.
Good for you.
And what's it about? It's about a company transforming themselves, changing themselves, becoming much more digital from a front-end perspective and a back-end perspective, because they need to. They have to be more efficient. They have to be better with clients, and it's all about investing in technology.
All right. Carmine DiCibio, CEO of EY. Thanks so much.
Thank you.
It was a pleasure.
Thank you both.
Thank you. Still ahead, much more from the World Economic Forum. Stay with us.
Welcome back to our live coverage of the World Economic Forum. We are delighted now to introduce our next two guests. Erik Brynjolfsson, he is MIT Sloan School of Management, and Andrew McAfee, MIT Sloan School of Management as well. Hello, guys, and welcome. Thank you for being here.
Guys from MIT here.
A couple of guys from MIT.
Right.
What are your titles there? Erik, what's your title there?
I'm a professor and a director of the Initiative on the Digital Economy that we co-founded.
Awesome. And that your title?
I'm a scientist and the other co-founder of the initiative.
You're a lot smarter than us, though, Andy. I think is the long and short of it there.
I'm watching this
We're here to change that opinion on you.
Oh, well, I like that. I like that.
Excellent.
So I'm sure you heard I don't know if you heard the president's speech or you've heard about it after the fact, but he definitely talked up AI and 5G, saying that in his words, we should not shun technology, but support it. Just what are your feelings when you hear these kinds of things from your president?
Well, I think it's great to have the support of it. I would love to see us invest even more in AI and technology. The good news is the United States is the leader in developing these technologies and in commercializing many of them. But as you've probably also heard, China and other countries are catching up fast and also investing much more heavily with government support than we are in the United States.
So I think we're still in a good position. We are still in a really advantageous place in this race. I agree with Erik. The key is not to lose the position that we have. And for example, when the world's most intelligent, ambitious, tenacious people in this field want to come to America to build their lives and their careers, and we put these Kafkaesque barriers in their place. If our president is on board with AI, let's get on board with getting the talent here.
Well, I just wanted to double down. I think it's really important because I went down to the AI Summit at the White House, and before I went there, I asked my students, my team, what was the one message you want me to convey? I knew I wouldn't have a lot of time. And they said exactly what Andy said. They said, look, you've got to fix these barriers to immigration and people coming in. Most of our students came from other countries. I was born in another country, came to America, which has been a magnet for talent, but it's become less so recently.
And so, Andy, let me ask you, though, as a scientist, because you've heard a lot about the Trump administration cutting funding for research in science. Is that something that's impacted you?
It's something that's impacting, again, our competitiveness, our lead in this race. If you really wanted to handicap America, this is a marathon, not a sprint. If you really wanted to handicap a runner in this marathon, you would cut funding for basic research. And we're not talking about government picking winners and losers in industry, but funding basic research in these fundamental disciplines, cutting off the supply of this amazing talent that wants to come to America to build its career. These are things that you would do if you're on the other side of us in this competition.
Should we be doing more, though, about cultivating that talent that's coming from outside our country here within this country? And how do we do that?
For sure. Of course we should be. It's not a zero-sum game at all. In fact, Michael Kramer, who recently won the Nobel Prize, showed that when smart people gather together, they benefit from each other. So if we attract more smart people here, it makes our own smart people more productive.
That much smarter.
and then it makes people want to be part of that. Do you think Silicon Valley is successful because they've shut out all of the smart people? Of course not. And that's made the people who are already there more productive.
And the guy that co-won the Nobel Prize the year before was Paul Romer, who said that economies grow not based on energy, not based on natural resources, they grow based on human capital and based on ideas.
Hey, Erik, so you do one hears a lot of scary stories about how China's ahead, they're leaping ahead, they're getting ahead, they're ahead with facial recognition, et cetera, et cetera. Are there good stories here in the United States? Are we doing anything right?
No, we're doing a lot right. I'd rather be where we are than anywhere else. And the reason for that is that we have the best basic research. We just published something called the AI Index report, and it showed that actually China has passed us in the number of publications, but if you go by the citations, which is the gold standard of how much people care about the research, how much impact it's having, the United States still has a big lead. But there's no God-given right that we'll always have that lead. It comes because we've been a talent magnet, because we've invested in it, because we've had free and open communication, and we have to maintain those advantages.
And we may be behind in facial recognition. However, to come to Europe, I boarded a plane in Boston, and I had my boarding pass out, but instead they just said, stand here and look over there. The gates opened and I walked onto the plane. They boarded the plane via facial recognition. So we're not out of this race by any stretch.
Right, there are privacy concerns with that too.
There are. That's a whole other conversation.
But there are also security concerns.
Yeah.
And do I want everybody that boards the plane
Yeah.
to have their face scanned so the bad guys can't trade boarding passes?
Absolutely.
Yes, I do personally.
You know, it seems like there's this love-hate relationship with AI, especially as more people feel threatened by it and when it comes to their jobs. Yeah. And I understand there can be job creation through AI, but how do companies, economies sort of deal with this job polarization, if you will, to get the people who are feeling left behind up to the front of the line?
Well, now you're getting to our sweet spot. This is what we've been writing about. This is what we do research on mostly at MIT, is how machine learning and other technologies are affecting the workforce. And there's a big mistake a lot of people make that AI is going to wipe out all the jobs. We're going to have a jobless future. The reality is when you look at it, that AI is going to transform most jobs, but there's no shortage of work that only humans can do. What's happening is that AI is affecting specific parts of jobs. You know, they can read medical images for radiologists, but the radiologists still are working with other radiologists to diagnose things or to talk to patients. Likewise, for every profession we looked at, what we found was that there was radical restructuring underway, and that's not easy, and that can be very disruptive. But
that's different than destruction. That's not the same thing. Exactly. And Eric's being a little bit modest. He and his colleagues have done the best research on the coming wave of machine learning transformation in the economy. The right way to do it is to look at all the tasks that are done in the economy. How susceptible, how open are those to machine learning? Abstract up from there, what jobs does that involve? What companies, what industries, what geographies? We can answer all those questions once we start from the right base, which is looking at all the tasks that get done.
All right, well, it sounds very encouraging. Eric Brynolfsson from MIT and Andy McAfee of MIT as well. Thanks so much for joining us today.
Thanks, guys.
Real
Thanks
pleasure.
for having us.
Thank you.
And we'll be right back.
Welcome back to our live coverage of the World Economic Forum. We want to welcome now to the show Glenn Hutchins, chairman of North Island. Glenn, it is good to see you.
Great to be here, especially with you. I'm not sure about Andy. But
Oh,
great
he's
to
a
be
good
here.
guy.
Man.
We keep him.
Wow. Oh my God, I'm wilting here.
Yeah. I'm an Andy fan.
I know that you are. You guys go way back.
Okay,
I know.
which one's worse?
Thank you for making me feel welcome. I want to start off and talk about something we haven't heard a lot about at Davos yet. It's only day 2, but okay.
Donald Trump.
Oh, no. But I'll ask you about him in a moment.
No, that's okay.
But blockchain. You
Right.
are a big proponent of blockchain being a force as strong as we saw with the internet, the way it changed finance and communications. Where do you see the opportunity in blockchain, especially when it comes to payments, in the next decade?
So the word blockchain and the terms around the cryptocurrency world, which I usually refer to as digital currency or cryptocurrency, are not exact. But the way I think about it is there's one solution that I think has a chance to revolutionize payments, and it's a combination of the Bitcoin protocol, the Bitcoin token and the blockchain as an accounting tool. The blockchain, independent of those other two parts of the solution, is just a database. And typically people who just talk about the blockchain independent are really only talking about a piece of enterprise technology that's like the intranet. The transformative pieces are going to when the Bitcoin protocol connects all the world's blockchains into the World Wide Web of blockchains, and in which we use the token, the Bitcoin, to move things of value between them.
So, Glenn, I want to switch over to politics a little bit.
That was quick.
Yeah, just a boom, right? We just danced around here. You've had some harsh words for President Trump.
That's not true.
Yes, it is true. But the economy has done well. So has that surprised you?
I've had harsh words for his economic policies, not for the individual.
Oh, no.
That's my point.
Okay, fair enough. Harsh, that's fine. Fair enough.
Right. Love the sinner, hate the sin, love the sinner.
Okay.
So,
All right.
well, let's pick something. Phase one trade deal.
Oh, well, he talked about the economy first. Let's go into that first of all. So, the promises for the tax cut were 3 to 4% economic growth. I at Davos that year took the under on the 3% line in bets all around the dinner table, and I've won every single bet because it came in at 2.5%, which was very, very close to the level that of the Obama 8 years of a roughly 2.25 to 2.3%. He had very, very little increase, but spent $1 trillion of our kids' money to get a very modest increase.
In the tax cuts, you mean?
No, in the cost of the tax cuts.
Right. Yeah.
At least $1 trillion. It's probably with interest at least $1.5 trillion. So we added $1.5 trillion in debt and got almost no increase in economic growth from it. That, I think, is very poor economic policy. By the way, my concern, this is not a liberal critique, but for instance, the Democrats are every bit as willing to spend.
Right.
Not cut taxes, but spend. As the Republicans are. So this is a critique from the conservative side of Trump's economic policies.
So within his own party, you're saying this is a critique of the tax cuts?
Not party, just from a point of the ideological perspective of economic policy.
This is a
nonpartisan
ROI equation.
Yeah.
Right.
What about that phase one trade deal? Good business there?
So I was with this group of the greatest investors here at Davos this week, today, and they were asked to give it a grade, and the highest grade it got was a B-.
And other grades were lower?
Other grades were lower.
Why?
Well, but for two reasons. One, it doesn't accomplish very much. The real issue that the Trump administration was going after, and these are really serious issues, and they're, I think, absolutely right on the diagnosis, is that the Chinese economy, China has made a decision to not to continue down the path of privatizing the SOEs and have a private economy in China competing with a private economy in the United States. They made the decision to have a government-led and run and owned economy competing, government and business going to market together against our private economy. That major effort to get them to continue the process that had occurred before Xi of moving toward privatizing their economy was the key initial objective, plus the theft of intellectual property of the trade deal, and that was not accomplished. Simply buying apparently they are going to buy a lot of our nuts. Apparently that's the major thing, which means they'll buy less nuts, maybe, I think it's from Australia, but they'll buy something else from Australia.
Come out in the wash somewhere.
So secondarily, if you kind of really understand global trade, the notion that a bilateral trade deal will buy some commodity is going to fundamentally change things is I think, misguided.
I'm going to make a hard turn and ask you about the NBA because you're co-owner of the Boston Celtics. Right. I know that they recently approved ad patches on the uniforms. I believe the Celtics did something with GE, if I'm not mistaken.
Correct.
Of course, there are the purists out there who say this is horrific, can't do this. Do you think that it's just good business?
Well, we had in New York yesterday the funeral of memorial service for David Stern.
Yeah.
And if you look, we had occasion as a consequence of which.
And you knew him well.
He was a good friend of mine, in addition to being a business partner, and a good personal friend, and a wonderful human being. And having the occasion to look back over the 30 years of his turning around the NBA from a league that was a marginal part of the global sports business to being the leading sports league in the world. And the constant innovation that he put into the ethos, the DNA of the league, was extraordinarily important and valuable. And one piece of it is this jersey patch, It was an experiment. I think it's an experiment that's worked just fine. Next one is going to be they're going to start an NBA basketball league in Africa. Yep. NBA Africa, that'll be really interesting to see if you can bring that to that part of the world. The continuing engagement of the league in corporate social responsibility, using the term social responsibility long before any other organization did, and engaging the players in that. The new WNBA commissioner and breathing a huge amount of life into the WNBA and bringing women into sports and women into sports executive role in the NBA. All of that stuff is David's legacy, and it's also part of it can be seen, so the jersey patch can be seen as part of a long continuum of kind of innovation and progress that he was responsible for and Adam Silver is carrying out.
All right, Glenn Hutchins, Chairman in North Island. Glenn, great to see you. Thanks so much for joining us.
My pleasure to be here.
Excellent.
Up next, digital transformation with Salesforce co-CEO Keith Block. We'll be right back from Davos.
Welcome back to our live coverage of the World Economic Forum in Davos, and we're joined by Keith Block, co-CEO Salesforce. Keith, so great to see you.
Great, thanks to be here. Great to be here.
So you're here with Mark Benioff, and you guys have a big presence here, I have to say, doing a lot of stuff.
All on the promenade, right?
What exactly is Salesforce looking to impart here at the World Economic Forum, and what are you guys hoping to learn?
Well, it's always a great opportunity to come to the World Economic Forum. We're a big participant, we're a big believer. And it really goes back to the topic this week around stakeholder capitalism. So this is something that Professor Schwab started at the very beginning of the World Economic Forum. Our company has been around for 20 years. And we are big believers in stakeholder capitalism and giving back to the community. So any chance we have an opportunity to focus on our shareholders, our customers, our partners, our employees, the community, everything that's represented here, and participate and influence and make a difference, we believe that business is one of the greatest platforms for change. And that's why we're here. And we're hoping to do great things here.
I saw this article and I kind of couldn't believe it, so I'm going to ask you. An RBC analyst put out into the ether that perhaps Google would be interested in buying Salesforce to help jumpstart its cloud business. What can you tell us about that?
Well, we never comment on rumors, and Google's a great partner of ours. We collaborate with them on a number of fronts, but we're just happy to be here and focus on our customers and drive success, and Salesforce is doing some really good things right now.
But would a partnership, well, that would be a straight-out buyout, but would that be even something Salesforce would entertain, or are you just not interested?
Well, again, those are the sort of things that we would never, ever comment on. We have a great relationship with Google. We have a great relationship with Amazon and Microsoft and many others. And we believe in those partnerships because at the end of the day, they're really great for our customers.
Hey, Keith, we were talking the other morning about the next digital transformation. Yep. And you were talking articulately about what that meant for companies and in particular constituencies like employees. Why don't you talk about that a little bit?
Well, there's a lot of discussion about digital transformation. This was really teed up in 2016 here at the World Economic Forum. And when I speak to other CEOs, I talk about the 3 pillars of digital transformation. The first is really a tech refresh. So you think about moving from on-premise technology to cloud technology and moving workloads, and certainly onto itself, there are benefits to that. So you could think about agility, you could think about cost savings, et cetera. But just doing a tech refresh isn't digital transformation. You have to do all 3 elements of digital transformation. And the second is a business model change. So an example, last week I was with the CEO of a consumer packaged goods company, and they typically have a B2B, business-to-business model. They're looking for a direct relationship, a D2C with the consumer. So that is a business model shift. That applies to every industry. It could be the public sector, it could be the financial services industry. You think about a medical device manufacturer who, again, is a B2B, typically, business model. They want a direct relationship with the patient, right? So that is a huge shift. So business model is number 2, which also has organizational implications. And the third is cultural. So you're introducing new technologies into an organization. You have to ask, what is the ethical use of that technology? You have to ask about the impact on the workforce. And is your organization ready to accept that technology? What are the implications of reskilling, which is a big, big topic in the 4th Industrial Revolution? Absolutely, of course. It's very, very important. So at the end of the day, you have to have all 3 of those. And this is typically what we have our conversations with these CEOs.
To sort of bounce off what you're saying, you're growing at Salesforce in leaps and bounds. You're the #1 CRM. Where do you see opportunity, not just in 2020, but as you look out to the decade?
Ask him about his total addressable market.
Yes.
We love TAM.
I'm asking a lot to say look out the next decade, but we've just started a fresh decade. Where do you see opportunities near and far?
We're just at the beginning of this. This 4th Industrial Revolution, we talk about it 2016. This is going to go on for a long time. So these transformations will take some time. Everybody absorbs this technology at a different pace. The total addressable market, since you brought it up, is well over $100 billion. In fact, CRM is the fastest growing category of enterprise software. So we see a lot of opportunity to drive great results for our company, but more importantly for our customers.
All right, Keith Block, co-CEO at Salesforce. Thanks for spending some time with us while you're in Davos.
I was happy to do it. Thanks so much.
All right, still ahead, Cisco CEO Chuck Robbins joins us to talk U.S.-China trade, CapEx spending, and a lot more. Also, they could be one of the biggest winners in the Phase 1 trade deal. Tyson Foods CEO Noel White will be here. We're live in Davos for the World Economic Forum. Stay with us.
Alexis, yes.
Welcome back to our live coverage of the World Economic Forum in Davos. I'm here with Alexis Christoforous, and we're joined by guest Chuck Robbins, CEO of Cisco. Chuck, great to see you.
It's good to see you, Andy. Alexis, always good.
So let me ask you about the trade deal with China and where you stand competitively and how that impacts your business right now, Chuck.
Well, look, we are quite pleased that we have the first phase of a trade deal done. In addition to USMCA, in addition to hopefully progress on Brexit, I mean, these uncertainties that existed out there were, in my opinion, the biggest drags that we faced. And while the initial China trade deal doesn't have significant impact on us directly, it's very good for American companies, it's very good for the American finance industry and others. So we're very optimistic on it. I think it'll make our customers feel better. And so we're very pleased that it got done.
You were at a breakfast, I believe, this morning with President Trump and some other American CEOs. Yeah, we want the scoop.
Come on.
Did he talk at all? Because in his speech here, he sort of flippantly said a phase 2 trade deal will get started very shortly. He didn't give any kind of a timeline. Did he talk at all about that? Did you ask him about that phase 2? Because I'd imagine it's that phase that you're really holding out for that could contain something that could more materially impact Cisco.
No, he didn't talk about the phase 2 other than the fact that we've got phase 1 done, that the tariffs remain until we get phase 2 done. So I think there's a lot of incentive, I think, from both sides to get there, but he didn't talk about it specifically today.
Let me ask you about talent and attracting and retaining employees, and particularly wages. And so do you feel that you guys have pressure to raise wages right now, Chuck? And what's it like out there trying to get people to come work for Cisco?
Well, it's competitive everywhere, but it's very competitive in the Valley. And so we try to not only pay competitively, but we have an incredible focus on the culture of the organization. And I talk to lots of college students and young in career, and I tell them, look, if you're smart and talented, you're going to have a whole lot of places where you can make a great living and you can be very challenged. The real differentiator for them is going to be where's the place that you love and where's the place that has shared values with what you believe. And so we're trying to focus on both, which I think, we were fortunate in October to have been named the #1 global workplace by Great Places to Work. So, we're focused on just creating an environment in addition to paying competitively.
Good for you. That's a nice title to have, right?
It is.
The last couple of quarters have been challenging for Cisco. Results were a little weaker than expected. Guidance wasn't as strong as perhaps some had wanted to see. Was a lot of that because of China, a pullback in CapEx spending? And then what does the future look like?
Yeah, I think we've had some pressure in China, obviously, on our business there in the midst of all the uncertainty, which we've talked about, and we expected that. Our service provider business has been going through some weakness due to the transition to 5G, the focus on building out the radio network, and we actually play in the core once the radio network gets built out. And then over the last couple of quarters, what we talked about is the uncertainty with some of these dynamics around trade, around Brexit, et cetera. We think it felt like there was a little bit of a tapping of the brakes. It wasn't like massive, but we felt our customers tap the brakes. The activity with the customers, the commitment to the technology, the belief in the strategic value is still there, the pipeline's still there, everything else, they just slowed down just a bit, as we had talked about on our last earnings call.
Hey, Chuck, let me ask you about Huawei. I mean, you guys compete against them. Has all this trouble and headwinds that they've faced here in the United States benefited you?
I don't think so. I think that what it potentially has done around the world is caused lots of countries and customers to pause, trying to figure out exactly where's the stance in my country. What should I be doing? What should I be thinking about? But I wouldn't say we've seen anything material as a result of it at all.
In many ways, I think Cisco is a barometer of tech spending globally. People look to your company. What do you see, sort of long lens, talking macro now, on a global scale?
Oh, I think it's going to be healthy for a very long time. I mean, if you look at how customers think about the technology today, even versus 7 or 8 years ago. Today, if you go like 7 or 8 years, we used to say that, a company would build their strategy and then they would look to their IT teams and say, do whatever you do with that technology to enable it. And now they're having the discussions in the boardroom about how does my strategy actually evolve based on what technology does for me, and how the technology is driving the strategy in many cases. So it's become core to the business strategy of the organizations as opposed to just an enabler, which I think will means that it's going to continue for a very long time.
And just quick last question, Chuck. You mentioned 5G. Is 5G really going to be a game changer for all of us and for Cisco?
It will. I think it's going to be in phases, both from a consumer brand then into the enterprise. It's going to be a multi-year transition. And it will, much like 4G was, we look back and think of 4G.
It seems like a long time ago.
Was not a flip of the switch.
And what happened is we didn't know what it was going to enable.
Right.
And now we're all carrying around smartphones with hundreds of apps on them that didn't exist before 4G because that became possible. So I think it's going to be fascinating to see what gets developed and what innovation gets inspired by these new speeds that we have out there.
All right, Chuck Robbins, CEO of Cisco, thanks so much for coming here.
Yeah, good.
No questions about UNC basketball, which is having a challenging season. We'll let it go with that.
I appreciate it.
That's the next interview. All right, thanks, Chuck. Up next, Noel White, the CEO of Tyson Foods, gives his first ever television interview. We are excited about that. Thanks, Noel. Stay with us. Welcome back to our live coverage of the World Economic Forum. We are delighted and honored to introduce our first guest because Noel White, CEO of Tyson Foods, this is your first live interview.
Yes, that's right.
We're going to be kind. You're looking good, looking sharp.
Thank you. It's a pleasure to be here.
Thanks for being with us. You had a very busy morning. You were part of the President Trump breakfast, I understand, along with a lot of other CEOs.
I was.
Would like your take on the Phase 1 trade deal with China, because this affects your company as one of the largest meat companies, poultry and protein companies in the country. This affects you deeply. Talk to us about that trade deal and what it means for your company.
We were very pleased that we came to an agreement with China, that our government followed through and enacted, as well as the agreement with U.S. MCA. And then that follows some agreements we've had with Japan and Korea as well. So we've had, a series of successes our administration's done a great job with. So we're very pleased.
Let me, sorry to interrupt, Noel, let me ask you about Tyson stock, which was up a ton last year, I think 70%. Right. Was a lot of that because of the resolution of the trade deal, and or were your results just clicking, or what was going on there?
I think there's a series of things that contribute to that. Our performance has been strong. The global demand for protein continues to increase year over year. So it's not only the export opportunities, it's the execution. And over the long term, demand for protein continues to increase, and we're well positioned to be able to satisfy that demand. We have a solid domestic base. We've expanded internationally the past year and a half. We've acquired some assets in Asia that are performing well for us. So I don't think there was one specific thing. It's a series of things that's led to a very optimistic future.
You also entered the very hot right now plant-based protein industry. Tell us about the offerings there and how you hope to expand in that industry.
Yes, we rolled out our offering this summer, and it's gone very well. We are now in over 7,000 retail stores in the United States, and there's a series of products that we'll be rolling out over the course of the next 12 to 18 months in all different varieties, in all different forms, both branded, including some of our legacy brands that we have in the marketplace today, that will be both meat-based protein as well as alternative proteins. And then we'll be entering the food service arena as well.
Was Tyson an early investor in Beyond Meat, and you are no longer?
Correct.
And why did you pull out of that investment?
We recognize that it's a space that we intend to fully compete in, that we have all the resources available to us from a culinary standpoint, R&D standpoint, manufacturing, distribution. We have solid customer contacts. So it's a space that we want to fully compete in, use all the resources that are available to us, and be a strong competitor in the marketplace.
Why not just buy a Beyond Meat or an Impossible Foods and sort of take all their infrastructure in-house and do that?
We already had the infrastructure in place, so it's a fairly minimal investment on our behalf to be able to scale very quickly. And as I mentioned, we have all the resources already in place. So based on what the purchase price likely would have been, it was much more feasible for us to just develop all the further capabilities ourselves.
Mel, you talked a little bit about what happened last year vis-a-vis the stock. And so I want to ask you to state the case for buying Tyson stock going forward in 2020. What would be what you would tell the Wall Street analysts to look for?
Yeah, I think it's not just a story about 2020, but it's 2020 and beyond. And we take a longer-term perspective on where demand is, not only in the United States, but on a global basis. And as I mentioned, we expanded internationally this past year. We have a solid base now in Asia, which is where the most rapid growth is taking place. We're looking to expand our prepared foods business over the course of time. Our organic growth has been strong, very strong, over the course of the last 18 to 24 months. So it's more a story not only where we're at today and where we'll be this year, but out into 21, 22, 23, because on a longer-term basis, protein demand continues to increase on a global basis about 2% per year, with most of the growth taking place in Asia. It's outside the United States. So we are well positioned to take advantage of that growth over the course of time.
Noel, before we let you go, the theme here this year is sustainability and how we can tackle climate change. We know that the meat industry there are lots of greenhouse gas emissions that are produced because of this. How are you tackling that?
Right. Yesterday we announced the formation of a coalition that we're going to pull together industry participants, not only in the United States, but on a global basis. And we want to fully attack all of the issues and make meaningful change over the course of time. It's an initiative that we can't do on our own as an individual company. We're going to need others within the industry to participate with us, and that's what the meeting about is actually tomorrow to help coordinate that.
All right, Noel White, Tyson Foods CEO, first interview, and you've done great. So thank you very much for coming on. We appreciate that.
Thank you so much.
All right, stay with us. Much more from Davos, Switzerland, coming up next. Welcome back to our live coverage of the World Economic Forum in Davos, Switzerland, where the sun is starting to go down.
Thankfully,
And for this, I'm
because you've
grateful.
been frying. We've both been frying, but
suntan
especially
just on
her
the
because she's on the sun
left side of my body. I want to welcome to the show Manpower Group CEO Jonas Priesing. Jonas, great to see you.
Thanks for having me.
Now, you have a very unique perspective, I think, of the job market from your perch there as CEO of Manpower. And what are you seeing right now in terms of business confidence and hiring going forward? Because at least in the U.S., we know the job market is very strong right now.
And that's actually true also across the world. In most of the countries, certainly in the developed world, we're seeing unemployment at decade lows, and especially in the U.S., of course, at a 50-year low. Yeah. So the labor markets are healthy. Employment is high, unemployment is low. Wage inflation, generally speaking, though, is still relatively muted. So, every country thinks it's a country-specific issue, but it's actually a structural issue. It stays around the 2.5% to 3% wherever you look, even when the labor markets are very tight. But the labor markets, on the whole, are still very robust, and demand for workers is still strong.
So, Jonas, I got to follow up on that. I hear CEOs whining, quite honestly. We can't hire people. We can't. And then you say, well, wage growth is so tepid. Hello? Is there a disconnect? Don't these CEOs and these companies just need to pay people not just a little bit more, but a lot more to get people to come work at these companies?
Well, a big driver for wage inflation has to be productivity increases. And as you well know, across the world, we've not seen significant boost in productivity, which means you can't really afford to pay wages that are much higher. So that will be one factor. Okay. The other factor is averages are meaningless. So the average wage inflation is contained. But the underlying wage inflation for skills that are in high demand is actually very high.
Right.
The underlying demand and wage inflation for skills that are not as much in demand, either geographically or industry-based, is keeping a lid of it. And then I think the third point is you have global wage transparency to a degree that you've never had before. You're fully aware of where you reach a break-even point of having a worker in a physical location in the States, in a certain state, in a certain city, or having the work done somewhere else by a worker that is paid either in another country or in another geographic location within a country. So that, we believe, has acted as a dampener, and that is actually a new element in terms of how to think about the mechanics around wage inflation when labor markets are tight locally, how you can still stay muted, because today as an employer, you have other options in terms of where the work gets done, which you did not have before.
Interesting.
What about, especially in this latest jobs report, we saw a gap widen between managers and those who report into the managers. The pay for the lower skilled folks is growing faster than it is for managers. Do you think we're going to continue to see that trend, or will that pay gap start to close this year?
Well, I think that the pay gap or the inflation that we've seen started with higher skilled workers and managers. And so we saw more accelerated wage inflation for higher skilled people as well as management levels earlier on in the recovery. And now we're at the tail end of a recovery that can carry on for a long time, but you are now pulling people into the workforce, and you're doing so, you're attracting them in by making sure that you're moving the wages
up.
You're
catching up.
So we're catching up, exactly.
Jonas, I understand you're not a big fan of universal basic income, which is where people get a guaranteed sum of money every year. I mean, it sounds great, like a free lunch, UBI. What could possibly be wrong with that?
Well, universal, the basic assumption on work and the people working is that they're only working because they want to, get paid. The reality is work provides meaning and purpose to individuals. We have a lot of people, and in the U.S. lesser degrees, but here in Europe, people who are unemployed and have significant benefits. And some countries actually debate that you get more benefits and pay if you're employed rather than not. Yet those populations aren't any happier. So you have an issue around the motivation and the purpose and making people feel that they are contributing, which I think, basic income defeats. Also, when you look at all of the data that's been done and all of the tests, we have one here in Switzerland going on right now, Finland has done some, it's being tried in many different places. The outcomes are not that people use their time and resources to acquire new skills so they can re-enter. The impact of basic income in all its forms that has been tried has produced no result. And as such, the best thing we can do is enable people to get into the workforce by providing them with marketable skills. That's what's going to change their world. And
yeah,
life.
that's a great intro for my next question, which is automation in businesses. Do you see, when you're speaking to clients as well, are you getting the feeling that automation is creating more jobs than it is losing? And are companies really committed? They talk a lot about it, but are they really committed to upskilling their workers?
I think the data that we have so far is very clear. The impact of technology has increased the number of jobs. There are some sectors that have seen jobs being displaced, but more jobs have been created in other sectors. So if you think about all of the narrative around automation having a negative impact on job markets, none of the data that we have seen, and especially in the acceleration over the last 5 years, has proven to make that come true. You know, we are at the lowest unemployment levels we've had for decades in most places, yet the impact of technology is just increasing all the time. So speaking with employers and doing our own proprietary research, we've really seen that employers say, we're investing in technology and we will hire more people. By the same token, though, they are looking for people with specific and enhanced skills.
Right.
So that is where you get into the debate and the tension around skills shortages, which are at a decade high as well, because to be fully taking the benefit of technology, you need individuals and workers with higher levels and different skill sets than what they may have had in their prior occupation. So you have both of these dynamics that are working at the same time. But in my mind, there's no question that the impact of automation and technology is a positive driver for job creation as opposed to a threat.
Before we let you go, you're based in Milwaukee, big Milwaukee Bucks fan. You're going to be seeing a game coming up soon, I understand?
There's a big game where the Milwaukee Bucks are playing the Charlotte Hornets in Paris on Friday night. And it's the first NBA game ever played in France. And it's going to be a tremendous success because the Milwaukee Bucks are going to win as they've continued.
Convenient.
In that
right?
they've continued
So
to
you're going
do.
to fly, you're going to leave Switzerland and go to France and go to
catch
Paris.
my flight home from Paris on Saturday morning, but I'm going to get
Why
to
don't
see
we
the
do that too?
Milwaukee
Let's go
Bucks.
along.
I don't think
You
they're
should.
tickets. I don't think they're tickets. Anyway, clearly a man who's got it going on. Jonas Priesing, Manpower Group CEO, thanks so much for joining us.
Thank you. Thank you.
Coming up next, Rajiv Shah from the Rockefeller Foundation will join us to discuss one of the biggest topics here in Davos, wealth inequality. Stay with us.
Welcome back to our live coverage from the World Economic Forum in Davos, Switzerland. A beautiful evening here as the sun sets in the Swiss Alps. And we're joined now by Rajiv Shah, president of the Rockefeller Foundation. Rajiv, good to see you again. Saw you here last year. This has got to be kind of your Super Bowl for an organization like yours, right? What are the key things you're looking to accomplish here in Davos?
Well, thank you for having me. You know, we look around the world and we believe inequality and climate change are threatening the existence of capitalism and the lifestyles and aspirations of billions of people around the world who are deeply vulnerable. And so we seek large-scale public-private partnerships that can be a real solution so that people can be hopeful about their future. And our priorities here are efforts to build those partnerships, public and private, to help end energy poverty and to allow economies, especially emerging economies around the world, to make the transition to green and renewable energy.
Does that mean looking for sources of funding from some of these big companies that are here, and or having them partner with initiatives that you do? Both?
All of the above, and bring really exceptional new technology and the capacity to innovate. So for example, we launched a $1 billion partnership with Tata Power, one of India's largest companies and India's largest power company, to reach 25 million people who today live in the dark. These are families that effectively don't have access to reliable electricity. And what we found is that with an innovative new solar microgrid connected to a battery, which uses artificial intelligence and to manage the battery and manage the grid system, you can reach those customers at a market clearing price. And we're thrilled that we have a partner that's with us trying to build 10,000 of these grids throughout rural India so that people can have something we take for granted, which is the electricity to be more productive and be moving up in life.
No better place to make those kinds of partnerships than here, because everybody's at the same place at the same time, right?
Well, that's true. I also think, companies come here hopefully with some real commitment to the idea that they have to have more of a multi-stakeholder mindset and see, rural customers in Africa, India, or Latin America as stakeholders that they could be serving if they had the right technology and the right partners.
I'm sure you heard Greta Thunberg's speech here, 17 years old, addressing this crowd of some of the world's richest elite crowd. And she was here last year. She did say this year, though, that she felt no progress had been made since she had gotten behind climate change in 2018. Would you agree with that?
No, I think we've seen some progress. Yeah. But here's what's so exceptional about Greta, and I had the chance to be on the panel that she introduced. The reality is a lot of the efforts and announcements that are made here and elsewhere, while well-intentioned and sometimes inspiring, are often just not ambitious enough or real enough to actually protect our planet and secure life for future generations. And to have an articulate, courageous, brave 17-year-old leader stand up there and say, I appreciate you're all here. I appreciate you're all talking about all this stuff. But guess what? You're not going to meet the 1.5-degree target. You're not meeting your Paris commitments. Countries are not submitting plans that are consistent with those targets and aspirations after just agreeing to them just a few years ago. And that's not good enough. And I think that should be a real wake-up call to everyone involved, that we have to be doing much, much more. And frankly, if you're in the corporate leadership sector or the finance sector, that you have to probably buckle down and be much more serious about protecting the planet and creating a more inclusive capitalism.
All right, Rajiv Shah, president of the Rockefeller Foundation, thanks so much once again for joining us. Always good to see you.
Thank you very much.
All right, we'll be right back. More coverage from Davos, Switzerland. Thanks. Welcome back to our live coverage of the World Economic Forum in Davos, Switzerland. We're here with Cristiano Amon, who is the Qualcomm president. Welcome. Good to see you, Cristiano.
Good to see you, too. Happy to be here.
So I want to ask you, first of all, got to ask you about the stock. I mean, you had a monster year. What was that about 2019? Now, I know we're in 2020 already, but why was the stock up so much last year?
5G is good for Qualcomm. 5G is good for Qualcomm. It's been front and center here in Davos. I think, we had, if you look at our company, we've been to a lot. 18 and 19, we've been dealing with a lot of issues, but I think we made the right investments. It was good strategy to diversify the company. We build, from mobile, an automotive business. We're going into IoT. We're going to other spaces, PC, but also in mobile, 5G creates new excitement about the mobile segment, and it's been a good thing for the company.
Your chips are in the iPhone, and Apple has said they want to release that iPhone 5G in September of this year. Does that still look to be on track, that timeline?
Look, we can't really comment about Apple products, really for them to comment. I think what we say is we are very happy about the relationship we have with Apple. I think since, we settle.
The détente.
Yes.
Peace between Northern and Southern California.
We are in Switzerland, yes.
And we have a multi-year agreement with them, and we're very proud of that relationship.
Cristiano, I have to be honest with you. I mean, understanding Qualcomm sometimes can be difficult. I mean, your business model, you manufacture through sort of contracting, and then you've gotten some dust-ups with various companies. There's going to be takeovers. I mean, is there just drama at this company, or is it something you can clear out of the way now and move forward and just focus on the operating business?
Okay, look, if I may, I'll probably describe it in a little different way.
Okay.
I think we have all of this stuff is probably because what we do is very relevant, and people really care about what we do. I think the elevator pitch on Qualcomm. I think we're not just a chip company. We're different. We're a creator of ecosystem. We develop. We've been at the front stage developing every new wireless technology. 2G. That's what put us on the map, right? With CDMA, and then 3G, 4G, 5G, and with that, basically license our technology. It's different than what you see today when people are talking about one company doing everything. I think for us, it's just about a horizontal model that will enable other people to innovate on our technology and platform. And you should think about us about everything wireless, everything low-power computing, and that's kind of what we are. That's why we're from cellular, Wi-Fi, to cell phones, to now ADAS and cloud computing.
You're putting a lot of resources into autonomous driving, and you were at CES. You unveiled Snapdragon Ride, pretty cool. Tell us about your hopes for autonomous driving in 2020.
Very good. One of the natural evolution, I think, of our automotive business, we started with a connected car, transforming the digital cockpit, and then the next thing will be, can we go into ADAS and assisted driving and make it in a way that is actually commercially attractive, taking the same approach we took to all of our products we did in the phone business. So what we did, we created a platform not only for the $100,000 car, but for the $20,000 car as well, that you can basically focus on autonomy for assisted driver. And when we announced at the CES, we also announced that we had now an engagement with General Motors, which we're very proud about. And I think our view is 2020 will be a lot of development of the platform with automakers, and you started to see that in the roads around 2023. It just takes longer.
Around 2023, you think we're going to see these cars on the road?
I think the Snapdragon Ride, which is being in design right now to the many automakers, you see 22, 23 Model E cars with the platform in the road.
Starting price, have you given thought to that? What would that be? I know you'd have to do that in conjunction with the automakers, but would it be in that $20,000, $25,000 range?
I think what we're doing, which is different than some of the companies that are pursuing autonomy, we're focused on how to add this to every car, and we really pick level 4+. And the idea is to have the reason we announce a whole platform, not one chip but multiple chips, is to have a solution that you can add to the premium cars, but also the entry-level cars, and that's what we're doing.
Cristiano, I read that you joined Qualcomm in 1995.
Yes. I was much younger then.
Engineer, yeah, a little bit younger.
We all were.
So talk to us about the evolution of your career when you started out as an engineer, now managing, I'm sure, a whole lot of people. And how have you learned through that process?
Well, I think, one of the unique things about Qualcomm is its people. I think Qualcomm has been, You know, and even if you look at your question before about the stock, if you look everything that the company been true, we still show up with a leadership position in 5G. It talks about the talent and the capability of our people. And I think what I learned to this process, and I think has been my recipe to success in Qualcomm, is I always bet in R&D, I always bet in innovation. I think it's a company that has always done that in its culture, its DNA, and I think that's the recipe for success. And it's been a great ride, and looking forward to much more.
Great.
When does 5G go mainstream? I mean, is it going to happen this year? It's hard to get people to adopt and to move over. It also means getting new devices.
Yes. I have to use your question to say something which is fascinating to us. In every other generation of wireless, 3G and 4G, the questions were, who needs this? What are we going to do with this? Now what we hear in 5G is, when are we going to get it? Which is a great thing. It just shows that the market is really mature. We have a mobile, mature market. We should see 5G in all metropolitan areas in the United States, as well as in China, Korea, Japan, and Europe towards the end of 2020. The biggest obstacle to 5G right now is actually not the technology, is permits for new sites. And I think that's one of the biggest challenges as you add more sites. For 5G technology, the networks are more dense, and permits is actually the #1 obstacle right now.
Can you tell us about your relationship now, where it stands with Huawei, and what's going on with Qualcomm in China?
Yeah. Look, Qualcomm, and point back to the question you asked me before, Qualcomm is in a very fortunate position in China because our business model actually is a stabilizing force between the two countries. We have aspects of our licensing program, has respect of American intellectual property, which the United States like. It has import of semiconductors, United States like. A lot of our Chinese customers are expanding beyond China with the Belt and Road Initiative, which the Chinese like,
Right.
and its cooperation technology. During the whole trade dispute, actually our relationship in China got stronger because of the China transition of 5G. So it is a big, growth for Qualcomm. It's also a big growth for Qualcomm, and many of our customers expand outside China and take some of the positions that Huawei had in Europe, companies like Xiaomi, Oppo, and Vivo. With Huawei, we are a supplier and a partner of like many other U.S. companies, and we're kind of the same situation. We had applied for a license to Commerce, and we're waiting a response. But in the meantime, we just follow the requirements like everybody else.
All right, well, keep us posted on that and
All
all
right.
else with Qualcomm. Cristiano Amon, Qualcomm president, thanks so much for joining us.
Thank you, my pleasure.
And coming up next, how prepared are we for the next global shock to the markets? We've got Carlyle co-CEO Glenn Youngkin joining us, and Citi's Phil Drury on the state of M&A and the IPO market in 2020. Lots more ahead. Stay with us. Welcome back to our live coverage of the World Economic Forum here in Davos, Switzerland, where nightfall is beginning to fall upon the Swiss Alps.
Yes,
right?
nice.
Beautiful,
I like the way you
beautiful
put
night
that.
here. We want to welcome to the show Carlyle's co-CEO, Glenn Youngkin. Glenn, great to have you here.
Thank you so much for having me.
You had a busy day. It started early with a President Trump breakfast, I understand.
Well, I think it's been a busy day for a lot of people.
It has been.
Morning.
It has been. Tell us about the breakfast and what was sort of the big takeaway for you?
Well, I think that the big theme from the president's entire visit here has been, I think, the success of the U.S. economy. And I think the recent trade announcement is another step towards underpinning that success. But I think across the board, the U.S. economy has performed well this year, I think better than a lot of people had expected. As a result, the markets have been up, and I think there's a fair amount of momentum, and I think the president wanted to make sure everybody fully understood that.
Yeah, right. And there is a little bit of a disconnect, because when you talk to your European friends, they're maybe a little bit less sanguine, just because they just don't have the growth here, right, Glenn? And yeah. I'm wondering if we've got this America on an island, Fortress America situation we talk about from time to time, where really the growth in the developed world is almost 100% there. Is that kind of the case?
Well, I think there's been a big shift over the last 10 years, which was different than what people expected. So if we'd been sitting here 10 years ago, and we had taken a 3-person poll on whether we thought the U.S. was going to be a larger part or a smaller part of global GDP in 10 years, we would probably have voted slightly smaller given the growth in emerging markets. And guess what? We were wrong. And the U.S. is a larger part of global GDP today than it was 10 years ago. 25% today versus 23% 10 years ago. That just represents 10 years of pretty sustained growth versus ups and downs in other parts of the world. But I do think the opportunity for everyone does reside in the cooling of trade tensions. And I don't think anyone believes that this phase 1 deal is the end of trade discussions, but it does signal a constructive tone. And there's been one factor over the course of the last 2 years, which has really been the core cause of the slowing of growth around the world, and that has been trade. And so I think if there's a more constructive tone to trade, and we can in fact see a pickup in trade around the world, then we should see an increasing growth relative to the slow growth in the economy that most people expect. So I think there's some upside as long as we can keep a constructive tone on trade.
You know, at Carlyle, you have over $220 billion in assets. You're sitting on billions to invest. Given that there is more clarity on sort of the global stage right now, where are you seeing the best opportunities?
Well, one of the challenges that comes with slow growth and low interest rates is high valuations. And in almost every asset class, valuations are in fact high. I think the one area is energy, that it could be viewed as an opportunity for value today. But otherwise, everything around the world is expensive. And so what that requires is a lot less of we're just going to go buy everything and a lot more of we're going to be quite selective in what we do. And I think that's where Carlyle's at its best. We have great industry teams, and those industry teams focus on specific companies or specific projects. And that enables us to bring all of our capabilities to bear to try to take a good company and make it great, or a good project and make it better. And that's where we're going to have to get our returns over the course of the next 3 or 4 years. Asset prices are high. We expect them to stay high, but that just requires you to add a lot more value than historically.
Hey, Glenn, as the CEO or co-CEO of a private equity company, you have a portfolio of companies, and some of them have a higher profile and a lower profile, and sometimes you have to take some heat. But the Taylor Swift thing is kind of a whole nother level. And I want to see if you could give us an update on that situation. Taylor Swift asked Carlyle to intervene in a dispute with Ithaca, which owns her music rights and receives investment from Carlyle. And so you get Taylor Swift on line one.
Right?
That kind of thing.
Well, first, I think we all really appreciate just what a spectacular artist Taylor Swift is. To disappoint you, I can't give you an update. But I do think that it does represent, I think, a focus that private equity is getting today. And I think that focus is a result of the fact that we haven't done a great job of helping everybody understand really what we do and the full nature of the economic contribution that we make. And I think that's one of the things our industry needs to do better.
In fact, some people paint you as villains in terms of job destruction and tax loopholes and those kinds of things, right?
You're vilified, really. Alexandria Ocasio-Cortez was one of them recently who said something about that. So what would your message be to them?
Yeah, well, I think the good thing is there's a number of folks who actually quite appreciate what we do. And so I think what we need to do is more comprehensively help people understand that. I think first and foremost, the industry is a large industry, and we do make a substantial economic contribution. We make a contribution to the investors. So, I mean, we're highly regarded participant in asset allocation to pension plans around the world. And in fact, I think we've routinely been described as the best performing asset class. And many CIOs for some of the largest pension plans, in fact, have said publicly, we need more private capital, more private equity, because the returns that they generate are critical for us to fulfill our own obligations to our own beneficiaries. So that's basket number one, and we're hoping people can understand that. But I think more importantly is what do we do from an economic contribution standpoint? And again, I think we're not perfect as an industry. There are always going to be challenges along the way, but we invest in companies to make them better, not to hurt them. We invest in projects to make them better, not to hurt them. And as a result, the job creation, the economic contribution, and in fact, the slipstream that comes with it from supply chains and community involvement continues to be an area that when we sit down and educate people as to the order of magnitude of what that economic contribution really is, then they say, oh, well, I actually need more private equity in my district. I need more private equity in what's happening in business growth. And that's just on us to do more of.
You know, yesterday we spoke with John Tuttle of the New York Stock Exchange, and he was talking to us about the healthy pipeline of IPOs they have. On the flip side of that is what you do at Carlyle. Are you finding from clients that, are they saying, hey, look, we actually are considering the public market? Are you seeing that more than you have in the past, say, 2, 3, 5 years?
Yeah, well, I think the reality is over the last 20 years, the number of public companies versus the number of private companies has shifted completely.
Yeah.
Shifted completely. And we've had the lowest number of IPOs over the last couple of years in history, or at least in recent history. And that does reflect, I think, two big trends. One, there's lots of capital to invest in these private companies. And second of all, companies are enjoying being private, and they don't need to go public in order to access capital. In order to meet their growth plans. And so that's a big shift in corporate capitalization today. The public markets are there, and I think there's some wonderful companies that will list and go public, but there's also many, many companies that choose to stay private for a long period of time, and there's substantial capital to support them. And so I think there'll be a healthy tension between public markets and private markets as to where the best source of capital is, and I think that gets back to what I was mentioning earlier, that competition today is more than just do you have money. It's what can you do to support a company or a project in its growth ambitions, and can you help it become better? And that's where our returns come from, but also that's how we in fact compete not only against public markets, but compete against our peers.
All right, Glenn Youngkin, Carlyle co-CEO, great to have you here.
Great, thank you so much for having me.
Thank you.
All right, coming up next, Nancy Brown, the American Heart Association CEO, will be here, and her new Quit Lying campaign. And then the Wilson Center's Jane Harman, and the latest on the impeachment trial in the Senate today.
thought that. Welcome back to the World Economic Forum in Davos, Switzerland. I want to welcome now Nancy Brown. She is CEO of the American Heart Association. Nancy, great to see you.
Thank you. Good to see you.
So President Trump is all over the place here in Davos. He had a breakfast this morning. He addressed the crowd yesterday, and he's been very vocal about the dangers of vaping.
Yes.
And I would love your take as CEO of the American Heart Association on what the Trump administration has said about vaping, and is it enough action coming from the White House and from Congress?
Yeah. Well, first of all, I think it's really important to understand that 5 million young people today are vaping. 1 in every 4 high school student is vaping, and that's self-reported data. We have reason to think it's much more than that. So this is a public health emergency. If you think about the fact that combustible cigarette use was at an all-time low 2 years ago, and now these kids are vaping, we need to be concerned. We are concerned about flavors, we're concerned about menthol, and we're concerned about the lack of regulation. The Trump administration, from our point of view, has not appropriately addressed this issue. Their recent guidance that has come out has not dealt with menthol, and it has not restricted the open container vaping devices, which we believe will be the next generation. Industry will see that, they'll go create the next generation product.
I saw, Nancy, the statement that came out around that time from the administration saying, it may have been from the president himself, we want to look out for the people and the industry. Why should we care about the industry at all? The industry being the vaping industry and the tobacco industry.
Yeah. From my point of view, this is the industry that has addicted young people to cigarette smoking for decades. If you look at the fact that most adult smokers of combustible cigarettes and now youth with vaping, people have their first cigarette product before they are 18 years of old and they get addicted. The tobacco industry is using the playbook now with vaping, and we do not believe, for the health of people in this country, for the economy of people in this country, that protecting the industry makes any sense at all.
And that's the Quit Lying campaign.
Yes.
That's pretty strong.
Yeah, absolutely. No, those are sobering statistics. I mean, I have 2 teenagers who do not vape, but I hear that I know of, but
right.
I'd like to think it's true. But they come home and they tell me stories, and it is, as a parent, it's horrifying. And I'd love to know what you're doing in terms of partnering with technology, because when I think about the American Heart Association, I don't think tech, but you are partnering with some of the biggest names in tech to tackle things just like this.
We sure are. And, the American Heart Association enjoys a number of important partnerships. And on the vaping in particular, you mentioned Quit Lying, and I just want to come back to that. That is a campaign of the American Heart Association to activate youth against industry, and youth are outraged. In terms of our partnerships with technology companies, those include relationships related to vaping. For example, we were very pleased to applaud Apple for removing all of the vaping apps from the Apple web store back in November, so that was wonderful. And we really see that technology companies are trying to bring their expertise to solve some of the biggest health issues in America today.
Do other tech platforms like Facebook allow for vaping companies to promote their products?
Well, we are looking very closely at where the vaping industry is popping up with ads that allegedly are user-generated, but they're actually sponsored. Yeah. We were very pleased, when Google has done a complete cleansing of their system to try to remove any of the self-generated content that is being positioned, differently than it is related to vaping from their website. But I think the technology companies play an important role. They play an important role because of the reach. They play an important role because of how much young people are focused. And they also play an important role in the broader mission of the AHA in terms of helping people manage their health and health conditions and spurring new innovations in science.
Just to follow up, you don't know about Facebook, whether or not they have those ads on there or not?
I don't know whether Facebook has the ads on there or not.
And let me ask you just generally about hypertension and health statistics, which have been going the wrong way, quite frankly, over recent years, which is surprising, of course, because we think of progress as just inexorable. but in fact, there's been this downturn. Why is that?
You know, we are very concerned about the downturn. For decades, the past 4, as a matter of fact, we have seen a constant reduction in deaths from cardiovascular diseases and more recently strokes. That has had an uptick, largely because of uncontrolled type 2 diabetes, obesity, and this rising rate of people with uncontrolled hypertension. And it is a real health concern. And the reasons are many. You know, first of all, we have many people in this country without access to high quality, affordable health care. And we know that individuals partnering with healthcare providers is very important for tackling some of these issues. We also know that people in certain areas like rural America, as an example, really struggle with having the social environment that allows them to appropriately manage their health care. We'll be publishing a really landmark paper in about 3 weeks on the state of health care in rural America, and it is eye-opening when we think about the problems that we're facing.
Because heart disease is actually up among younger people,
yes,
right?
Yes, it is.
What age, when you say younger people, what is that?
You know, I think what we need to recognize is, you know, many people are at risk for heart disease. It is the #1 killer in the United States and globally. 17.5 million people a year.
For both men and women?
For both men and women lose their life to cardiovascular disease. We see younger people, because of these health conditions like sedentary lifestyle, obesity, and type 2 diabetes, being afflicted earlier with heart disease, younger women having strokes. And so this is a real call to action to our communities, to our healthcare providers, and to individuals of the importance of managing health, including mental health, you know, which is so important for individuals having, you know, not just good physical health, but good mental health.
Hey, Nancy, how does the AHA work? In other words, how do you get your fundraising? Do you have an endowment? Do you have to raise funds from private companies every year?
The American Heart Association raises and has revenues of just under $1 billion a year. Wow. And those dollars are generated largely from philanthropic sources. We are America's largest health nonprofit organization when we think about our sister organizations. We also have some product lines where we are bringing products to market, like CPR training as an example. And part of the beauty of the American Heart Association is we are creating the science that becomes the guidelines, so we're able to very quickly get appropriate products into the marketplace to help individuals and healthcare systems manage the health of people.
Well, Nancy Brown, CEO of the American Heart Association, thanks so much.
Thank you.
All right, stay tuned for more coming up next. The latest on the 2020 race for the president with the Wilson Center's Jane Harmon. Stay with us.
All right. Hello and welcome back. Welcome back to our live coverage here at the World Economic Forum in Davos, Switzerland. What a day it's been. We've been talking to lots of great people.
Yeah, I mean, the quality of people who come here in terms of their expertise is pretty amazing, quite honestly. And sometimes you can get a little cynical about Davos, and rightfully so. I mean, there's a lot of bloviating, quite honestly. But, you know, it is an impressive group of people, and they really are trying to get some stuff done. I like the fact that they were trying to get standards set for ESG for companies, so when they're investing in companies, they can tell whether or not they're meeting environmental goals, for instance.
Yeah, and we spoke to lots of great people today, and over the past couple days, the CEO of Cisco, CEO of Marriott, CEO of Tyson, lots of great minds here sharing their thoughts and what they also thought about President Trump, who has a big presence here, not here last year because of the government shutdown, was here the year prior, but really striking an optimistic tone.
I think he likes it here. You know, I mean, you might not think that would have been the case, but he seems pretty comfortable here.
Yeah, and you know, our own Julia LaRoche, she's outside. We've been here in our cozy studio, but Julia is outside on the promenade where all the action happens here outside of the panels and workshops. And Julia, you're outside, I think it's the Belvedere Hotel where a lot of those swanky meetings and deal making takes place, right?
Yeah. Yeah, Alexis, I am out here outside of the Belvedere, and you're right, and I'm starting to see folks who are passing by that I definitely recognize. But I just want to touch on something because I'm a first-timer at the World Economic Forum. I'm a millennial, and I got to say, I'm kind of feeling a bit more of that optimism here, especially when we're talking about this theme of stakeholder capitalism. And I think a lot of that is you're seeing a lot of young people drive that sea change. We had this conversation at an EY breakfast this morning where Paul Tudor Jones was being interviewed alongside EY CEO, who I know you all have spoken to, and a lot of it is the next generation that's pushing the changes. Like, look, we care about climate change. We care about sustainability. We want companies to actually take actions. You're starting to see that. But my question going forward is, will we see more companies, based on the conversations we're having here this week, actually go home and start to implement some of these practices? Alexis?
Julia, if we can ask, sorry about that. Julia, if we can ask quickly, who were some of the folks that you were talking to today, and what was your big takeaway?
Yeah, Alexis, we had a number of guests come on our program today. We had Troy Gajewski, the co-CIO at Skybridge Capital, really giving an interesting outlook on the markets. And look, he's really bullish. That's what I'm getting. But also kind of warning that, you know, people thought 2019 was going to be analogous to the market that we saw in 1999, but maybe that's a little bit delayed because we did kind of see some similarities. You could draw some parallels. So really interesting markets discussion. We're doing all of the breakouts coming up on Yahoo Finance online on our website. You can check out the articles there. Another thing I'll point out that was really interesting from our conversation was, yes, we're talking about climate change, but who's really going to lead the way? And there's an interesting opportunity for venture capital to unleash their potential when it comes to investing in some of these next generation technologies that can address some of these world problems like climate change. So we had Zach Bogue. He is the managing partner of DCVC. Really fascinating conversation. I mean, we got really deep on things like, I'm talking about fertilizer, something that really hasn't been updated. It's really difficult when it comes to technology there to improve that because you have a lot of CO2 emissions from something as common as fertilizer. So we're talking about people who are actually putting money to work to find real solutions. So that was one of the takeaways for me. But I got to ask you, Andy, Alexis, you all have just had a number of titans, captains of industry come through. What were your big takeaways?
Well, thanks, Julia. My big takeaway was when Ray Dalio dropped his glove in front of me, and I asked him, I said, hey, Ray, can I get that for you? And he said, sure, go ahead. So that was my little moment.
Deep thoughts with Andy Serwer.
All right, thanks so much, Julia LaRoche. Hey, let's go down to the floor of the New York Stock Exchange and check in with Ines Ferre and see what she has going on. Ines?
Andy, all three indices are in the green, and we touched records today on the S&P 500 and also on the NASDAQ. The best performer on the NASDAQ being Tesla, reaching $100 billion market cap. All-time highs for Tesla today. And then we're also looking at Dow component IBM. IBM is the leader on the Dow. It's also one of the best performers on the S&P 500 after beating on the top and the bottom line for its latest quarter, seeing a slight increase in its quarterly revenue, up 1% 0.1%, breaking a streak of declining sales. The acquisition of Red Hat had something to do with this. The fourth quarter cloud revenue was up 21%. That accounted for nearly 30% of total revenue for the company. Also checking out Dow component Apple. This is after a report that Apple may be offering a cheaper version of the iPhone, with Bloomberg reporting that suppliers have been instructed to start manufacturing these, assembling these in February, and that an announcement about these cheaper versions of the iPhone could come as early as March. Right now, you're looking at the Dow that's up 90 points, the S&P and the NASDAQ also higher. Andy, back to you in Davos.
All right, Inez, thanks so much for that. And we're delighted to be back here in Davos, Switzerland with our guest, Jane Harman, who is the CEO of the Wilson Center and longstanding member of Congress from California. Great to see you, Jane.
Thanks. You too.
So my first question is, what the heck is the Wilson Center and what are you doing there?
I'm astounded that you don't know.
I
and
should
that
know.
every
I'm
viewer,
remiss. Sorry.
He's educating
every
everybody
Yahoo
else.
person doesn't know.
Okay,
but
sorry.
just to remind you all, the Wilson Center was formed by Congress 51 years ago to celebrate the values of Woodrow Wilson, our 28th president and our only PhD president. Who knew that?
Right.
He was our first truly internationalist president, and everybody remembers that, both getting into World War I, but also trying to forge peace in the world through the League of Nations, which didn't succeed, but later we had the UN. At any rate, the Wilson Center is the living memorial to Wilson, like the Kennedy Center is the living memorial to John Kennedy. And we celebrate the connection between scholarship and policy, which neither of which is in high regard, or at least high respect, in the Congress right now. So it was easy for me in the middle of my 9th term to succeed Lee Hamilton, another a very well-known and respected member of Congress, as the president and CEO of the Wilson Center, and I've been there for almost 9 years.
You know, I don't know about you, but being in news, it's very hard for me to read about the news, to watch the news on TV and not be hypercritical because it's my industry. What's it like for you, having been a member of Congress and now seeing this Congress at work? What are your takeaways from what you're seeing happening right now on the ground there?
I'm just so despairing. Yesterday was all partisan all the time, the votes on the impeachment rules in the Senate, the trial rules. And can't we do better than this? I do remember a day when bipartisanship was prized. I certainly worked on a bipartisan basis with a lot of people, and I have on the walls of my office at the Wilson Center 8 laws. 8, that's a lot of laws, with the pens from the signing ceremony, where I was either the principal author or the principal co-author. And most of them are in the intelligence and security space, where we need better laws right now, and no signs of life.
And you were the ranking member of the House Intelligence Committee. But how do we get there? In other words, Republicans crossed ranks when President Nixon ran into Watergate.
Yep.
But it seems impossible for Republicans to do that today. Or from my perspective, what would even move Mitch McConnell and company off the dime to accept that President Trump had done any wrongdoing at all?
Well, I want to say Democrats are to blame too. I don't know about yesterday. I think actually Chuck Schumer had the higher road. He was trying to make a process that would at least allow the public to consider if there were new facts. And to remind, impeachment is a political remedy. It's not for the courts. It's for the Congress working through public opinion to decide whether high crimes and misdemeanors have occurred. And I went through this in the Clinton case. I voted against the charges because I didn't think they rose to the level of high crimes and misdemeanors, but I didn't think that what President Clinton did was admirable. So in this case, let the Congress decide, but let it decide in a way that is respectful of the Constitution and respectful of each other. That's what's missing. So how to get back to that, it's very hard. Because if you are bipartisan in either party, you get opposed in your primary from either the far right or the far left. I lived through that in my last few races, which I won, but nonetheless, it's not pleasant to have your own party say, she's a traitor and a spy, et cetera. It's all charming these days.
Just for crossing the aisle occasionally.
Yeah, and for supporting strong security policies after 9/11, which I thought would keep our country safe.
If you were a member of Congress today asked to vote on this impeachment of this president, how would you have voted?
In the House?
Yes.
How would I have voted in the House?
Well, or are those impeachable offenses? What Trump has done?
I think they're very serious offenses. I really don't want to answer that because I'm not in the House and I didn't see everything they saw. I didn't go to the classified briefings. But I think there are serious charges here, and they deserve serious attention and not just reflexive reactions that, no, he did nothing wrong, and yes, he did everything wrong.
All right, Jane Harman, CEO of the Wilson Center, thanks so much for joining us.
Thank you both.
All right, we'll be back right after this.
All right, it's a little bit after 11 a.m. in New York City. 90 minutes into the trading day. Stocks are trading higher right now. We're going to keep an eye on that. Getting crowded. Netflix adds nearly 9 million subscribers in the fourth quarter, but just how long can it fend off growing competition in the marketplace? Revving past a milestone. Tesla's growing market cap has it as competition for the title of world's largest automaker. And on alert as the coronavirus now claims at least 17 victims in Asia, the CDC announces the first case has reached the United States. Welcome to On the Move. I'm Adam Shapiro.
And I'm Julie Hyman. Thanks for joining us. Let's head to the floor of the New York Stock Exchange, where Yahoo Finance's Inez Ferez is standing by. Inez, a lot of earnings-related movers today, among other things.
That's right, Julie. Among other things, we're looking at IBM. IBM is one of the top performers on the Dow, also one of the top performers on the S&P 500, which, by the way, this morning the S&P hit record highs, as well as the NASDAQ. IBM is seeing a pop after beating on the top and the bottom line. The company saw a slight increase in its quarterly revenue, up 0.1% year over year, breaking a streak of declining sales. The acquisition of Red Hat had a lot to do with this. The fourth quarter came in the strongest for cloud revenue, up 21%. That accounted for nearly 30% of total revenue. Taking a look at another Dow component, Apple. This is after a report that Apple may be offering a cheaper version of the iPhone, with a Bloomberg report saying that suppliers have been instructed to start manufacturing these, assembling these in February, and that an announcement about this cheaper version of the iPhone could come as early as March. And then just looking at United Airlines. United beat on quarterly earnings, I was just listening in on the conference call. It's still going on right now, but executives highlighted that they reached their 2020 adjusted EPS target 1 year ahead of schedule. Also, executives said that they can't tell how long the MAX jet will be grounded for or the economic impact of the coronavirus, although executives have been in contact with the CDC to make sure that travel is safe. And so far, there are no travel restrictions when it comes to the coronavirus. Adam, Julie?
Inez, thank you. Our top story, Netflix. The streaming giant posted a beat on the top and bottom lines for its fiscal fourth quarter, though it wasn't all sunshine and rainbows. The company sounding the alarm on growing threat of U.S. competition, giving disappointing guidance for the first quarter. With us to discuss this is Bernie McTernan, Rosenblatt Securities Vice President. We also want to bring in our panel, Yahoo Finance's Brian Chung and Dan Howley. And the takeaway from all of this and the note that you sent us, you have a neutral rating on this stock. Revenue is slowing and content costs are growing. That seems like a potential recipe for problems. I didn't want to use the word disaster going forward.
No, but that's exactly it. And so as you mentioned at the top of the show, subscribers beat by about 1 million on the fourth quarter, but they came in 1.5 million light on the 1Q guide. And so we think subscribers, that's foreshadowing the revenue growth deceleration that's going to be happening with the company. 35% growth in 2018. We think you're going to be looking at high teens in 2021. We get our $275 price target by putting 4.5 times on that 2021 revenue. So we see downsides to shares from here.
At the same time, though, they said they're going to be spending less, right? That they're going to, or at least they're going to be burning less cash. That 2019 will be the highest in terms of cash burn. So are they being rational in terms of bringing down that cost or cash burn as the revenue growth is maybe slowing down?
Yeah, so cash spend continues to tick higher. It was just under $15 billion. Last year, it's going to be closer to $16, maybe $17 billion in 2020. But yeah, free cash flow is improving. That's scale, and that's because of revenue growth that's happening. We expect the company to go break even in free cash flow in 2023, but we think you're still years away. You have to go to 2025, put 25 times on free cash flow per share, discount that back to today to get to our $275 price target. But the big question is, where is cash content cost going? So $16 billion in 2020, are we looking in 5 years? Are we looking at 20 billion? Are we looking at 25 billion? That's the big question that's surrounding the free cash flow profile of the company.
But I think if you look at some of the shows that they've started to cancel, and they you know, this was kind of a tenet of Netflix for a while, where it was, let's just run the shows until we can get some traction with them. But recently they've been running a season and then just, axing a show if it doesn't work right off the bat. And I mean, their metrics are kind of wonky, the way they measure viewership. Obviously, if you get I get 0.5 seconds or something viewing, then it counts as a view, which is, all right. But I think, going forward, don't you see that we're going to get a consolidation of this entire market? We're going to have Peacock launching soon. We have Hulu. We have Disney Plus. It seems like CBS All Access. Everyone has a streaming platform now. It's getting to the point where it's, almost as onerous as cable was. So Netflix, do you see that as being the one that sticks around when we see that eventual consolidation of this market?
Yeah, so I think that what will end up happening is that there'll be two core streaming TV services in the U.S., and that's going to be Disney and that's going to be Netflix. And then kind of everything else will be on the edge. And what's going to happen, I think, is that all this choice, and I think that actually we're going to be broadening out, not coming in, and so more choice leads to more cord cutting. We did a streaming video survey that launched at the end of the year, and 30% of respondents with Disney Plus indicated that they unsubscribed to another service as a result for signing up for Disney Plus. So even though the market's growing with more cord cutting, we think it is, kind of Disney and Netflix.
But what did they unsubscribe from?
So 10% indicated specifically that it was Netflix. So our survey, it was 59% of respondents indicated that they subscribed to Disney Plus. That gave us confidence to increase our estimate for global subscribers for Disney Plus from 20 million to 25 million for the end of December, and we think you'll be looking at 35 million at the end of the fiscal year in September.
Yeah, and that story seems to go along with just, I think they inked a deal with Studio Ghibli, which is a huge Japanese distributor, to get some of their films in markets not in the US, but the global subscribers are a big story. But broadly, look, this is a stock that's got a PE ratio of 106 right now, and in a market market that's already frothy at 21, but that's still multiples of that. So when you look at the valuation right now, I mean, what is the next catalyst going forward? It seems like from a debt standpoint, there's still a voracious appetite. They, I think, got, what, the $2 billion offering last year. So is it the financing side, or really is it the quality of the programming and the contracts that they're able to deal from a content standpoint?
Yeah, personally, I don't even like to look at this company on an earnings basis because they only amortize 60% of their content costs. And that's why I look at free cash flow. And look, it'd be great if they only amortize 30%. They would look a whole lot cheaper on PE. But that's why I have to look at revenue growth and you have to look at free cash flow. Revenue growth is going to keep decelerating here. And it just, you know, trading at close to 6 times revenue now, I just don't think that multiple will hold up as revenue growth goes from the high 20s to the high teens.
All right, Bernie McTernan is the Vice President at Rosenblatt Securities. Thank you for being here on The Move.
Thank you very much.
Well, we're watching Davos, of course, as well. World leaders are gathering there to discuss the top issues around the globe. In attendance, JP Morgan Chase CEO Jamie Dimon. He highlighted his main market concern as we head into 2020. It's negative rates. We're joined by Yahoo Finance's Julia LaRoche, who's on the ground at Davos. And Julia, this is in sharp contrast, of course, to President Donald Trump, who said, give me some of those negative rates. Not just there in Davos, he said it multiple times.
Yeah, well, I think you have a lot of folks in the investment community who just say, look, it's a bad play because it's going to bring about long-term pain. But look, we have President Donald Trump. He's here in Davos, skipped last year, but made some rounds, doing some TV appearances, talking about the Fed monetary policy, those interest rate cuts that we saw in 2019. And look, he does like negative rates. So take a listen to what he said earlier on CNBC.
It raised too fast interest. They brought up the rate too fast, and they didn't drop it fast enough. And that was very, that was a lot of increases, and it was a lot of increase. And I think it's really the opposite of what you're saying. Now they've dropped it, but it was very late. And you look at other countries where they actually have negative interest rates, negative in a positive way.
Yeah, well, earlier, President Donald Trump in his opening session speech here this week was really touting the strength of the U.S. economy, the resiliency there, and he sees continued upside potential for the U.S. economy, citing specifically what he calls massive deregulations and also the trade agreements, the renegotiations that are going on there. Also talking about phase 2. We just came off the heels of phase 1. Adam, Julie, back to you guys.
Julia, thank you. We want to dive into Davos a bit more with the panel. And Brian, I am curious, a retail investor who's watching Davos, what is it that they're going to take from all of this? Is it the forward movement with sustainability and the environment, or is it the continuing discussion about central banks?
Well, if you were watching President Trump's speech yesterday, you probably wouldn't have heard very much on climate change. I think the bigger message from him was that the U.S. economy is looking strong, which in all fairness is true, right? I mean, you have unemployment at near all-time lows. You have job gains going pretty steady. Stock markets hitting all-time highs. But I think that there is definitely some concern behind President Trump's speech, right? A lot of these long-term problems about whether or not corporations can continue to consume fossil fuels at the rate that they're doing. Maybe that even presents monetary policy-related concerns, right? You hear about the green swan event. Maybe this is something that economists need to be paying attention to as another macro risk that people had never seen before. So I think that if you were watching President Trump's speech, you may have gotten a different impression than maybe the broader themes at Davos, which largely seem to be focused on climate change.
Okay. Are we moving on to China? We're moving on to China. All right, let's talk about another potential risk, perhaps a black swan, you could call it. Deaths from the nation's, that is China's new flu-like virus, have climbed to 17 with more than 470 confirmed cases. The news further heightening global fears of contagion, with cases now detected as far away as the United States. With us to discuss now is Chris Meekins. He's Raymond James Vice President and Healthcare Policy Research Analyst. Chris, thank you for joining us. He's in Washington. As we watch the spread of this flu-like, it's called a coronavirus, what can we take away from how it spreads, how we should think about it, and how big a threat it could potentially be?
First, on the threat front, I think it's important to remember that the U.S. government, through the Department of Health and Human Services, and underneath that, the Centers for Disease Control, are the global leaders in controlling infectious disease. So the threat to the U.S. is very, very, very small. And I want to start off with that. With regard to the spread, we don't really know yet from a scientific standpoint about why it spreads and how it spreads. What we've learned is initially it was believed it was just animal to human. So if you avoided the animal meat market in Wuhan province, you would probably be fine. But what we've since learned is you have more than a dozen cases where it was human to human contact, including the one of the patient that's now in Washington State. So there are normal things you can do, wash your hands, don't go to work when you're sick. But from a U.S. perspective, we haven't seen a spread within the U.S. yet.
And we should point out, if it's already been pointed out, forgive me for repeating this, but you worked at the Department of Health and Human Services. You were in charge of public health emergencies. What we witnessed yesterday in markets kind of implied that some people were worried about an emergency, and what I hear you saying is there is no emergency. In fact, coronavirus has been around globally for a long time.
I mean, there's no question we need to watch this. We saw in 2003 SARS, and we've seen the MERS virus, and it can disproportionately negatively impact folks. When I was at HHS as a deputy assistant secretary there, I worked in the area that dealt with public health emergencies and the declaration of those after hurricanes and other instances. And so it's something we need to watch. I think the market yesterday, when we saw movement in some of these equities, as soon as a company said, yeah, we may work on that, you saw the stocks go up 20, 30, 40, 50%, and that was overblown. Unless you get a supplemental government funding bill, as we saw during the H1N1 pandemic influenza, or as we saw with Ebola, I think it's unlikely you're going to see a major government investment into these companies. And with a virus only being confirmed in less than 500 cases, I don't see exactly a market for these products yet. And hopefully there never will be one.
Hey, Chris, Dan Howley here. Just to clear something up, this is something that I assume, since it's flu-like symptoms, most people probably don't have to be too concerned about this being especially deadly, right? It seems like it's people with compromised immune systems, likely the very young, the very old, things along those lines.
Yeah, at this point, I mean, you've had more than 400 cases and you've had fewer than 20 people, according to reports from China. And I do want to throw a big caveat there in that what we have learned historically is data from China on the number of people infected and the number of people killed is historically unreliable. But the CDC is tracking this in the U.S. You have a secretary in Alex Azar leading the Department of HHS that was there during the H1N1 pandemic, was there during SARS in 2003. This is an expert who understands how to respond to these types of public health emergencies if the U.S. needs to respond. We'll watch to see what the World Health Organization declares today, whether it's a public health emergency of international concern. But from my perspective, I think the bigger issue right now is the flu going into the U.S., which will kill far more people. And if you haven't gotten your flu shot, get it, because the second strain, H1N1, that's spreading right now, has a really good match for the vaccine, so the vaccine can really help you.
Hey, Chris, Brian Chung here. I got to go get mine for sure. But one thing I wanted to ask you is just, we saw markets blink yesterday. Do you think that was a bit of an overreaction given what you said about maybe this not being as big of a deal as maybe some people are worried about? And is there any sort of historical comparison to the way that markets blinked to the SARS outbreak, many years ago?
Yeah, I think the SARS outbreak was the first real spread of a coronavirus that surprised the world. The world has made dramatic advancements, including China, in their control of infectious diseases. So there's much better tracking of patients. There's much better control at airports. The U.S. just expanded screening at a handful of other airports. I wouldn't be surprised if a few more get added to that. But really, we've made dramatic advancements in public health. So from my perspective, the market overreacted yesterday. I think we're going to hear some additional cases come out, probably in the U.S., but the odds of you seeing a death in the U.S. are probably pretty low. And when you compare it to pneumonia or flu or heart disease, as you had a previous guest on, this doesn't really rate in the public health concerns I have.
Chris Meekins, thank you. Reassuring words. Raymond James, Vice President and Healthcare Policy Research Analyst. Appreciate it.
Thanks, Julie.
Let's have a little fun and turn to Tesla. The electric car maker now, it's become the first $100 billion public U.S. car maker, and that move extends a run that has taken the company past the likes of Ford, General Motors, even Volkswagen in less than a decade. What do you think? Can he sustain it? Because there's incentive for Elon Musk if he can keep the market cap above $100 billion.
I mean, yes, but I got to say,
incentive.
who would have thought that we'd be seeing Tesla at 580 in the middle of last year when everyone was concerned about the exodus of a lot of the high rank and file executives within the company, right? There were a lot of departures during that time. There were, concerns about whether or not they would be able to hit their production estimates, which some saw as maybe quite lofty. Since then, it seems like the China story has really taken over from a bullish standpoint and really shown that there's a lot of excitement about where they are positioned in terms of strategy in that Chinese market where all the EVs are racing to. You mentioned Volkswagen is one that they leapfrog. Well, that's a company that has a huge market play in China. If they can't get their EV to match up to Tesla, which already has their super factory open, I mean, that's going to be a huge loss for them.
Can I say something too, though? Let's not pretend this is all about fundamentals, right? Let's not pretend that this is all about what the real prospects of this company are. He hates on the shorts, Elon Musk, that is so much. That latest leg up in the stock is because of a short squeeze. If it wasn't for the shorts, who had shorted this company and then got squeezed out as it started to go up and then accelerated that uptick, the stock would not be where it is today. That's what I think. I mean,
it's just interesting to see that Tesla, as a company that doesn't produce nearly as many cars as any of the other automakers, and is really just, coasting on its technology at this point. Not even, the fact that the Model 3 or the Model S even hasn't been fully redesigned at this point is bizarre, especially when you take it in terms of a regular automaker. Other automakers would have fully redesigned this vehicle by now, and yet it still sells very well. I think for if I was at Ford right now, or if I was at Volkswagen, I would kind of be, biting my knuckles and thinking, this guy just keeps beating us.
Well, those companies, however, it depends how you measure beating, because those companies have the infrastructure and the foundations. Rivian and Ford, Volkswagen and Ford on EV, and they're much larger. They understand how to manufacture much better, perhaps, than Tesla, and they have turned a profit in their past. Tesla and Mr. Musk aren't really consistent.
To Julie's point, though, the short squeeze is definitely a big portion of it. It's almost like a pressure valve, right? You had all that pressure, but then it is a fundamental story, though, I think, that triggered it, that ultimately undid the valve that allowed the stock to just go higher from there.
For sure. So. It's a combination. All right, coming up, a mixed quarter for Johnson & Johnson. We'll talk to the CFO about the company's earnings straight ahead. Plus, 2019 was a year of high-profile IPOs, of course, with some notable bombs. But things have been turning up for some underperformers in early 2020. We'll talk about it.
Stocks giving back gains, but we still got the Dow in the green here. Welcome back to On the Move. I'm Jared Blickery. Dow's up 14 points or 5 basis points. Here's the intraday price action. We just had kind of a sell-off here. We weren't up that much, so it looks a little bit exaggerated on your screen, but really not many gains here for the Dow. The S&P 500 still holding on to about a third to a half of its gains. It's up 22 basis points. NASDAQ Composite up even more. It's holding on to a lot of its. Tech is very strong today. And the Russell 2000, once again a laggard, broke out last week and hasn't been able to continue that move. What could go wrong for the rally here? Well, let's take a look at this. This is a Barron's cover, and look at this, Dow 30,000. The method behind the melt up, why the Dow won't stop at 30,000, kind of a contrary indicator, so we do want to keep that in mind. Let's take a look at the 10-year T-note yield. That is now down 2 basis points, and it had been up earlier. That's an important reversal. We've been looking at that pattern over the last year. It has broken down below that, and so we want to keep an eye on that. Also taking a look at WTI crude, that is at a 7-month or 7-week low right now. It's off 2.5%. Haven't seen this price since the beginning of December. Let's take a look at the Dow heat map. We got a couple of stocks we're looking. First, let's take a category look here. Apple is up 0.5%, Microsoft is up just fractionally, and Visa is up 0.7%. All three of those stocks at record highs today. Intel, this stock up 2.5% ahead of its earnings. It is up to a 19-year high. Haven't seen this price since 2001. It's up 28.5% this year. Also want to take a look at IBM. Now, this stock has been on a tear recently. Announced earnings after the bell yesterday, and we can see it broke out of this several-month-long consolidation consolidation here, and it is moving to the upside. Stick around. We're going to be back in a minute.
Johnson & Johnson out with its fourth quarter earnings report this morning. They posted a beat on earnings per share, a slight miss on revenue, however. The company also saw both U.S. and international sales rise overall. Johnson & Johnson CFO Joe Wolk joins us once again to break down the report. Thank you for being here, Joe. Good to see you again.
Nice to see you, Adam, and thanks for having me today.
There's a great deal to talk about. I'm going to ask a question more specific for a retail investor. If I get the numbers wrong, correct me. But if free cash flow, and you talked about this in the earnings call, is around $20 billion, and you're one of the top companies globally for R&D, $11+ billion last year, with dividends of about $9.9 billion. But then you highlighted the unknown on some of the legal settlements. For instance, the opioid settlement with the state's attorneys general. That'll be perhaps $4 billion, maybe more. How do you sustain that kind of investment in R&D and also dividends without maybe a hit, at least in 2020?
Well, Adam, cash flow generation really starts with the performance, and we can point to all three of our segments in terms of what they were able to achieve in 2019. And as we look forward to 2020, we're on solid footing. With respect to free cash flow generation specifically, it's around working capital management, making sure we've got the right level of inventories that still meet customer needs and have product available to them that they need to live longer and better lives. With respect to the opioid litigation specifically, we did note that after the third quarter earnings, we actually amended our earnings to account for the $4 billion agreement in principle that we reached with the negotiating team for the state attorney generals. As you probably know, that not only includes states, but it also would include counties and municipalities. So we feel that that was a very fair and reasonable contribution to the overall settlement, get money into the hands of people who have been affected by the epidemic, and then move on with our business. That will be payable out over a couple of years, but we thought it was important for transparency to mention that to the investment community.
Joe, and we might delve back into that in a moment, but I do want to ask you about the numbers from this last quarter. You mentioned your three divisions, and for people who don't know, it's pharmaceuticals, medical devices, and consumer products. In medical devices in particular, you had a year-over-year decline in sales of about 0.5%. I'm just wondering what was behind that and whether you expect that to then rebound going into 2020.
Yeah, thanks for the clarifying question, Julie. We actually couldn't be more pleased with our medical device unit. We still have more work to do, but if you just take it in context, in 2017 we grew 1.6%, in 2018 we grew 2.7%, and this year we grew about 3.9%. What you see on some of the reported numbers is the impact of businesses that we divested. So we had two significant divestitures over the last 18 months, and then the impact of currency. With a stronger dollar, that does impact our business pretty significantly. So when you normalize for those points, our growth this year was about 3.9%, approaching overall market growth in med tech.
There was a headline yesterday coming out of California, Joe, about that state possibly passing a regulation that would label acetaminophen as a potential carcinogen. That's the ingredient in Tylenol, I believe. Again, correct me if I'm wrong. What kind of potential impact does that have for an over-the-counter medication and your sales if that actually happens in the largest state in the union?
Yeah, so rather than me jumping to conclusions, Adam, I would say let's see what happens there. Prop 65, which is, I believe, the proposal in California, has been around since 1986. They have, I think now it's up to 900 substances that are considered carcinogenics. The FDA, as well as consumer healthcare groups, have come out publicly and said there's simply no basis in science to call acetaminophen a carcinogen. So we'll have to see how that pans out. We'll monitor the situation, but at this point in time, there's no basis to believe it should be labeled as such.
And I want to follow up, when you say basis in science, there's something coming up with the FDA on February 4th. They're going to hold hearings on how to properly test talc. And we know the history of what's been going on with the company. There was the false test that came out in October, but then you had to withdraw the entire lot, I guess, of baby powder that was talc, and yet the test result was wrong. Where do you stand with baby powder? And I got to ask you, given that your major business is pharmaceutical and medical supply, why even bother with talcum powder?
Yeah. So, Adam, I think you're absolutely correct in terms of there's a lot in that question. Let me take the testing itself. So we conducted 155 tests. We voluntarily, out of abundance of caution, recalled one singular lot from the shelves of retailers. Those retailers have now come back asking for replenishment, given the confirmation of the safety of the product that those tests illustrated. And so we're in the process of doing that. With respect to pulling a product off the shelf that, while it's small to our business, we think that sets horrible precedent when we know the product is safe and efficacious and consumers value it. We continue to look at all options with respect to the product line, what makes sense for most stakeholders. But right now, we think the best course of action is to defend the product against misfounded allegations based in a misstatement of fact or innuendo.
To Adam's point, Joe, the smallest portion of your revenue comes from consumer products more broadly, not just talc. Baby care products within that, revenue they're down 26%, not just because of talc, but because of competition. There have been investors in the past who have said Johnson & Johnson should maybe break itself up or divest more businesses. What's the value proposition of consumer to Johnson & Johnson right now? Why keep it around?
It's a question that we get often, Julie, and it's one we actually ask ourselves. Our board asks that same question. What is the value of all three of our segments in terms of being a healthcare company? But that's exactly what we are, is the world's largest global healthcare company, and we kind of see it as an end-to-end spectrum of well-being. If you think about some of our consumer products, it's related to skin care, it's over-the-counter medicines, it's oral care. Oral care, we know, leads to better cardiovascular health. Skin care can prevent certain types of cancers. And over-the-counter medicines have saved a number of trips to emergency rooms. So we kind of see it playing very much in the space of health care, the way our products are positioned. But that's not something that we consider a birthright. We want to make sure each of the units are performing to meet at or above market expectations for their respective peer group. So we always challenge ourselves each and every year to make sure we've got a game plan in place that's executable to make sure we achieve that goal for shareholders.
Joel Wolk, the CFO at Johnson & Johnson, thank you for being here on The Move.
Thanks, Adam. Thanks, Julie.
Well, coming up, we'll have more coverage from the World Economic Forum in Davos, Switzerland. You don't want to miss that. Plus, more trouble for retailers particularly in the UK. Shares of Ted Baker and Burberry both trading lower as those companies face several issues in their home nation. About 11:30 a.m. here in New York City, 2 hours into the trading day, stocks are rising with the NASDAQ at a record. Let's look at oil prices as well as we see some money coming into stocks. It's coming out of oil, down 2.5% there at $56.89 the barrel. Costly battle. Top names like Apple and Amazon are forced to spend big on lobbying amid increased hostility from lawmakers. Back to the Alps as the world's elite descend on Switzerland. We're live in Davos for day 2 of the World Economic Forum. And the captain makes the Hall of Fame. Yankee great Derek Jeter heads to Cooperstown, but not without controversy. We'll have more on the baseball greats election ahead. Welcome back to On the Move. I'm Julie Hyman.
And I'm Adam Shapiro. Thank you for being here. 2020 is starting off well for newer stocks like Uber and Lyft, who made their public debut in 2019. The Renaissance Capital IPO ETF is also seeing record highs as the IPO market heats up to start this year. Here to discuss what's to come in 2020 is Renaissance Capital Manager of IPO ETF, Kathleen Smith. Good to have you here. We all get excited by the tech IPOs, but there's a good old-fashioned thing that we can all relate to. Aluminum foil is one of the things that's coming our way and very soon.
Some investors like a lot of free cash flow. So Reynolds Consumer is going to tap the IPO market. It'll be a large IPO, $1.3 billion. And yes, it's not a growth company, but it has very strong brands and a lot of cash flow. So in a defensive market, that stock should do fairly well.
And yet the stocks that are already out have also done quite well. I mean, you have an ETF that tracks recent IPOs. And despite all of this sort of doom and gloom that we talked about last year with the canceled WeWork IPO, with Uber and Lyft not performing very well, your ETF actually touched a record in the last few days. So what's going on here? Is it that the others are pushing it up, the ones that are not those big names? But we've also seen a little bit of a recovery in Uber and Lyft, right?
Actually, Uber is one of the top holdings in the Renaissance IPO ETF, and the stock's up over 20% so far this year. So I think the best explanation for how does a basket of newly public companies do so well when everyone's crying the blues about the IPO market, it's a rules-based, it tracks a rules-based index and takes the emotion out of holding these IPOs, and it rebalances every quarter. So you have a little bit of the diversified portfolio. It takes away the single stock risk. It's companies, for example, Uber is going to go into major indices. And so we'll hold it for 2 years is the typical holding period for the portfolio. And at that point, for example, Facebook was picked up by the S&P 500 after 2 years.
So Kathleen, help us understand, I guess, the mechanics of this ETF, because it seems like liquidity might be a natural question, right? I mean, those IPO shares are usually subject to a lockup anyway. So how does the ETF work? You mentioned it rebalances every quarter, right? So how do you try to manage the holdings within it?
I think liquidity is a very good question. The way we designed this was to include the largest market cap, but to weight based on tradable liquidity. So Uber, for example, was not the large holding it became until the end of December when it was included in, more fully included in our index. The lockup release came and we could see those shares were freely traded in the market. So that's a very important concept. Everyone that's running an ETF these days is looking at, the liquidity. If there is a rush to sell, can you get into the underlying liquidity? And these are very liquid companies that are in this portfolio.
I want to talk about the, kind of, this is sort of part of that raft of big name tech adjacent IPOs that went public last year, but Airbnb coming this year maybe. So when do we expect that, and what can we expect out of that?
First of all, I think Airbnb did want to come public in 2019. So they are targeting definitely this year. And all companies that are looking to go public, and there are a lot of them, are going to try to get out the door in the first half. And the reason is the election's coming up, and a lot of companies will want to be hesitant about making a plan around what the stock market's going to look like around the election. So we're fully expecting to see Airbnb in the first half. The significance of it is it's one of the largest privately valued companies at 30-some billion in its last round. And also they're interested in kind of bypassing the traditional IPO process and do a direct listing. So besides being a very interesting company, the issue is going to be, does that 31 billion valuation hold up in the private market? And also there are comps to Airbnb. So Booking.com is another, there are other comps, and with all these companies, there are other competitors. And so it's going to have to fit into the IPO landscape, and it could end up being, depending on how it goes public, maybe the IPO market is more disciplined than the private market, and we'll get more attractive valuations for it.
Well, Kathleen, one of the themes that we talked about a lot in 2019 was the public versus the private market, and I want to ask you about that. But first, I want to play you some comments from Glenn Youngkin, who's the co-CEO of Carlyle. He talked to us in Davos, and he talked about why he feels companies don't feel like they need to go public as much as they used to.
We've had the lowest number of IPOs over the last couple of years in history, or at least in recent history. And that does reflect, I think, two big trends. One, there's lots of capital to invest in these private companies. And second of all, companies are enjoying being private, and they don't need to go public in order to access capital.
Of course, he's a prime provider of that private capital, right?
We're on the other,
that changes at all?
We're on the other side of the equation here. Mm-hmm. Our viewpoint is that investors must make money in the IPO market or it doesn't work. And private companies, it's true, there's a lot of liquidity, perhaps excess liquidity in the private market that's pushing up these valuations. Private equity is not in business to stay private forever. They're looking at a liquidity event. Now, maybe they can sell the company, but the companies get big and they need a path to liquidity in the public market. So although we are seeing this flip-flop, there is another side to this, and I think it's important. Companies that stay public too long may not have the best, private too long, correct, may not have the best exit strategy than if they were run. And unfortunately, the private companies are being run without a view to profitability, many of them. So to be big and private and unprofitable is not a good equation for getting to be a public company.
That's a headline. Kathleen Smith from Renaissance Capital, thank you very much.
Thank you.
Thanks, Kathleen. Good to see you. Well, tech giants are boosting their lobbying spending. Apple and Amazon both spent record amounts in 2019 in an effort to see a federal privacy law adopted and pursue large government contracts. Yahoo Finance's Melody Hom joins us from Playa Vista, California, with more on this growing trend. Melody?
Yeah, and Julie, when you think about the four largest tech giants, that's Apple, Microsoft, Amazon, and Alphabet, they actually had a decrease if you look at the cumulative spending since 2018. It's a decline of 12% over the last year, but the main reason for that is because Alphabet did a lot of rejiggering and internal shuffling when it came to their lobbying practice and strategy. So Alphabet's Google declined 44% to $11.8 million in 2019. Meanwhile, as you point out, Apple spent a record $7.4 million. And then if you think about the context of this is a big chance for tech to consider the return on investment of these sorts of efforts. So take Amazon, for example. They spent a record $16.1 million last year, but they still managed to lose out on that $10 billion Pentagon cloud contract that they were really vying for. Microsoft instead took that deal, and they also increased their spending to $10.2 million, but somehow have managed to really stay out of the political battles that we're seeing plaguing a lot of Silicon Valley. Of course, this is as the FTC is looking into Facebook and Amazon. The Justice Department is investigating Google and Facebook. So we should expect a lot more creative, sort of out-of-the-box strategies, in my opinion, with the way in which these folks interact with government leaders. Take, for instance, Tim Cook of Apple, right? He has kind of, outside of the lobbying efforts at large, he's been able to tap Trump and deal with him one-on-one and be able to manage these sorts of family-related relationships. So it really depends on who's in office. And I think this time around, we've seen a lot of interesting ways that lobbying has been working, even outside of these filings.
Melody, thank you. Coming up, prosecutors plan to call Lori Loughlin's daughters to testify at the college cheating trial against their mother. Plus, Derek Jeter's headed to the Baseball Hall of Fame as fans ask, who is the one, just one holdout who denied him a unanimous vote? House managers will lay out their cases to prosecute and defend President Trump. The U.S. Senate passed rules for the trial late yesterday, delaying a decision on calling witnesses until after managers make their impeachment cases. The White House is expected to make a motion to dismiss the charges, but it is not expected to pass. Us Weekly magazine reports federal prosecutors plan to call Lori Loughlin's daughters as witnesses to testify in the college admissions cheating case against their mother. The prosecutors want Loughlin to accept a plea deal. The magazine reports Loughlin was told to change her not guilty plea to guilty after asking if she could do anything to prevent her daughters from testifying. The Environmental Working Group says U.S. drinking water contaminated with chemicals is more widespread and far worse than previously reported. The environmental watchdog says the highest levels of contamination exist in Miami, Philadelphia, and New Orleans. The group bases its claim on unpublished EPA data and says 110 million of us, 110 million Americans, may drink contaminated water every day. Yankee shortstop and former captain Derek Jeter was elected to the Baseball Hall of Fame yesterday, but the vote, 396 out of 397, fell one short and deprived Jeter of being only the second player to be elected unanimously. That distinction belongs to Mariano Rivera. Outfielder Larry Walker, who played for the Cardinals, Rockies, and Montreal Expos, was also elected to the Hall of Fame.
Well, let's head to the UK for some fashion fallout. Fashion brand Ted Baker is warning investors that an issue with overvalued stock is twice as bad as initially expected. Burberry also in the red today, despite raising its outlook. Yahoo Finance's Edmund Heafy joins us now with London. Let's start with Ted Baker here. It's had some troubles for quite a while.
Yes, Julie, and if the past year is any guide for Ted Baker, things will go from very bad to worse. Its woes started when its founder and chief executive, Ray Kelvin, was accused of harassment, and he had to step down in March 2019 following an independent review. Then the fashion chain has issued 3 profit warnings in the past year, and then said near the end of last year that it had overvalued its clothing inventory, so basically phantom stock, by $25 million. And that was bad enough since Ted Baker had not explained how this had happened. But today now it says that actually it had underestimated the extent to which it had overvalued that phantom stock, and now thinks it's around £58 million. That follows an investigation by Deloitte and is an embarrassment for Ted Baker's normal accounting firm, KPMG, which had suggested that the phantom stock issue wouldn't affect the company's bottom line as much.
Okay, business leaders around the world gather in Davos, Switzerland each year at the World Economic Forum. Yahoo Finance's Brian Sozzi had the chance to sit down with Schneider Electric President and CEO of North America.
I'm Brian Sozzi. I'm here with Annette Clayton, the CEO of Schneider Electric North America. Annette, good to see you.
Yeah, thank you, Brian. Thanks for having me.
I was going through your latest results, and your North America business has been very strong. What are some of the drivers of that business right now?
Yeah, actually, there's a number of drivers. I mean, one is the economy is doing obviously quite well, although I would say generally we're outgrowing our competitors. A lot of it has to do with our customers' sustainability agendas. Actually, they're all trying to drive their own net zero ambitions. And of course, we know Klaus Schwab here at the World Economic Forum has challenged all companies to come here with, at a minimum, a 2050 net zero ambition.
The U.S. business for Schneider Electric is one of your fastest growing in terms of energy management. Why is the U.S. outpacing a lot of other regions overseas?
Yeah, I think the economy obviously is strong, but also one of the things that we're really focused on is how to help our customers do more with less. I mean, if we go into, how is energy actually consumed, 30%, 40% in buildings, 40% in industrial, and 20% in transportation. What we do for our customers is we help them save energy, right? So we go in, we drive our offer, our technology stack, which is called EcoStruxure. And EcoStruxure for a building would typically save 30 to 50% of their energy costs. So customers love this.
I'm sure. How would you characterize the industrial economy? It has been a little soft. Has there been an inflection point in the business?
Yeah, we're seeing a pickup in the industrial side as well. I mean, we are seeing a lot of local manufacturing and a need certainly for automation. And again, we make a lot of devices that are connected. They produce data. And that data drives insights, again, into energy efficiency. So we're able to drive, again, 30% typical operating efficiency inside our industrial customers.
Do you think all the talk about an industrial recession in the U.S. is overblown?
I think today, yes. We don't see signs of that in the near term, but TBD, I suppose.
One of the biggest themes at the World Economic Forum this year is obviously climate change. How does Schneider Electric play into that theme?
Yeah, I think if you step back and think about what is the burning platform here, the world is really needing to control, the climate change by 1.5 degrees. I mean, that's what will help protect, tens of millions of human beings. The reality is we're consuming, carbon at a rate that would produce maybe a 3 degree. So we have to cut our greenhouse gases in about half. So at Schneider, we call this the new electric world. That's how we solve this problem. We need to decarbonize, we need to decentralize, and we need to digitize. Decarbonize is what we do for our customers. We help them use less CO2. We are a thought leader in the area of microgrids, which is obviously decentralized. And then, as I mentioned before, our products produce data, and that data produces insights, and we take those insights and drive, less energy. So ultimately, we think we need twice the amount of electricity. We need to be using twice the amount of electricity that we're using today.
This is your 5th time here at the World Economic
It
Forum.
is.
You also sit on the boards of Duke Energy and Polaris. How serious are these discussions around climate change in the boardrooms, in the C-suite?
They're very serious. I mean, all the companies that I deal with today, and frankly, most that I'm aware of, even most of our customers, have some kind of sustainability goals. They are trying to, drive to some goal. And again, Schneider has a net zero 2030 goal. But I think Klaus Schwab, in his wisdom, has asked all companies to come to Davos with, at a minimum, a 2050 goal.
And last but not least, the 4th industrial revolution, I think an area you're watching very closely. How big will that be for a company in the manufacturing space over the next decade?
Is very, very important. And actually, we've worked with the World Economic Forum and the future of manufacturing. It's actually the work stream that I'm co-chairing. And one of the things we're doing is creating lighthouse factories. And these factories are using the very best of technology, the very best of decarbonized technology. And, in Schneider alone, we have 12 factories that are net zero, 12 factories, and we have 4 lighthouse factories. And this is what we do for our customers. We help them turn, their 1960s factory into the factory of the future, a lighthouse factory that uses less energy.
So when you hear Microsoft CEO Satya Nadella say they are going to be net zero, that's a possibility. It's not just a pipe dream.
It's a possibility. With technologies like ours, our technology stack of EcoStruxure is the way, actually, to get there.
Well,
so this is the solution we provide for our customers.
You're definitely working on some cool stuff. Annette Clayton, the CEO of Schneider Electric North America, thank you for joining us.
All right, thank you.
Coming up, a cheaper iPhone. Apple is reportedly assembling an affordable iPhone as soon as February. Dan Howley has details about that for us. Plus, David Solomon defends WeWork, why the CEO believes Goldman Sachs did not get it wrong.
get some trending tickers for you from YahooFinance.com. Boeing is in your sights once again. I'm showing the 5-day chart because we've really had a rollover here. It's down about 8% over the past 5 days and down nearly 3% today. That's after the company pushed back the return of its Boeing 737 MAX to mid-year at the earliest. This is something that a lot of perhaps analysts had already suspected, but the company confirming, and so the shares falling further. I want to look at Abbott Labs as well. It's one of the companies that reported its earnings today. Those shares up about 3%. The company in particular reported growth for its cardiovascular rhythm business, in contrast with competitor Boston Scientific that recently reported some disappointing numbers there. Overall earnings came in ahead of estimates. Still yet to come on the earnings front is Texas Instruments. Those shares are up 3% after ahead of its reporting after the closing bell today. You can see the shares are up about 40% over the past year, and I believe they are trading at a record. Adam?
It's time for Word on the Street, where we check in with our panelists and find out what stories they are watching. Brian, you are looking at David Solomon's comments on WeWork.
Yeah, so David Solomon, the CEO of Goldman Sachs, which was part of the WeWork process, he said that the process worked with WeWork, even though that whole disaster really was a huge focus of the IPO market in 2019. He said that the quote, the banks weren't valuing, and then added later, you say to the company, well, if you can prove to us that the model actually does what this does, then it's possible it could be worth this in the public market, which, by the way, sounds to me a lot like valuing. But he basically said that the bankers may not have done a good job at Goldman Sachs, but the process itself works. And then later on in the same appearance in Davos, he said actually low interest rates were also a reason why maybe we're seeing some of these frothy IPO valuations. So there's still a lot of finger pointing in this whole WeWork saga. Not a question that should be just kind of thrown aside, especially since we have a number of high-profile IPOs this year as well.
Yeah, that sounds a little bit like bias. Like, it's not confirmation bias. I don't know what kind of bias you would call that.
Deflecting blame, I guess.
Yes, I guess that's what you would call it. All right, Dan, you're looking at Apple really making a cheaper iPhone, reportedly.
Yeah, they're expected to make a cheaper iPhone. They're supposed to be putting it together now, could launch in March. That lines up similar to what we had with the iPhone SE when that originally launched, if you remember. That was a low-cost iPhone that they had years ago. They cut production of that, and they haven't done a low-cost iPhone recently. This one would run the same chip as the current iPhone. They could put the chips in any device they want at this point, and it's not gonna make a difference on margin for them. But what they're not putting in is Face ID. Instead, this would have the regular old touch button, the Touch ID that you would have from the original phones. And it's going to be expected, I think around $400 maybe, because the current iPhone 11 sells at a surprisingly low cost of $699.
There's talk, by the way, when you say get rid of Face ID, that the next expensive iPhone will get rid of Face ID and even the Lightning cable. Is that, do we know anything for facts on that?
I don't think they're going to get rid of Face ID. I think they're going to keep it. It's a really good technology, and it's actually more secure than it's more secure than the fingerprints, because you can spoof fingerprints, and there's more matches to your fingerprints, surprisingly, than to your own face. As for the Lightning cable, I think they're going to. That was kind of a misnomer of what was actually going on. The EU was talking about, well, all these people have to use USB-C, and Apple already has a Lightning to USB-C. They're going to keep using it because that means you got to pay that money for those cables. So
good point. All right, Dan Halley, thank you for being here. Brian Chung, thank you for being here. In the next hour, a climate showdown at Davos. The battle over sustainability has taken center stage at the World Economic Forum. But what does the rest of the world have to say about it? Plus, Jeff Bezos gets hacked. The latest as Saudi Arabia denies it had anything to do with hacking the Amazon CEO's phone. about noon here in New York City, 2.5 hours into the trading day. Stocks are rising across the board, with the NASDAQ having touched a record. Let's take a look at the 10-year Treasury yield as well here as we see buying in stocks. We've got a little bit of selling in Treasuries, but a very little, relatively unchanged. 1.77% is where the 10-year stands. An immediate investigation. The United Nations calls for swift action amid reports that Amazon CEO Jeff Bezos, that his phone may have been hacked by Saudi Arabia. Getting crowded. Netflix adds nearly 9 million subscribers in the fourth quarter, but just how long can it fend off growing competition in the marketplace? And on alert, as the coronavirus reportedly claims 17 victims in Asia, the CDC announces the first case has reached the United States. Welcome to On the Move. I'm Julie Hyman.
And I'm Adam Shapiro. We're going to head to the floor of the New York Stock Exchange because IBM is the top Dow performer today after beating on the top and bottom line for its latest quarter. Inez Frey has more for us. Inez?
Adam, IBM's revenue for the quarter came in it grew by 0.1% compared to the same quarter a year ago, breaking its declining sales streak over a 5-quarter period. The results had to do with its acquisition of Red Hat, with its strongest performance, with its cloud revenue growth up 21%. That accounted for nearly 30% of total revenue for the company. Also, we're looking at United Airlines this morning. This is after the company beat on earnings. In their conference call, executives highlighted that they've reached their 2020 adjusted EPS goal 1 year ahead of time. Now, analysts peppered executives with a lot of questions about the MAX, and they weren't too specific on the impact of the MAX, but they did say that the MAX has been a setback, and definitely the company would have benefited on revenue and on CASM, that's cost per available seat mile, if they did have the MAX. And also, executives on the call said that given Boeing's statements from yesterday of when they expect the ungrounding of the MAX to begin by mid this year, that they will be pushing back their schedule. And also executives saying that right now they do not anticipate that they will be flying the MAX this summer. Adam, Julie.
Inez, thank you. As the global financial elite gather in Davos for the World Economic Forum, a lot of attention is being paid to the global wealth gap. The irony, though, having billionaires discussing things like income inequality is facing criticism from a lot of people. Joining us this hour is our panel, Emily McCormick and Pras Subramanian. And also here to discuss the role of socialism in today's political climate is Maria Svart, the National Director of the Democratic Socialists of America. And it's a pleasure to have you here.
Happy to be here.
Let's jump right into this. We are all paying huge amounts of attention to billionaires who are gathered in Davos, Switzerland, talking about one of the key issues of our era, income inequality. Is there irony in that?
It is nothing but ironic, yes. The idea that a bunch of millionaires will come up with solutions to solve the problems that the rest of the planet is facing is impossible to conceive. Last year, they came up with the idea of job retraining, but they aren't talking about taxing themselves to create jobs. So again, they can't face the reality of what it will take.
Another thing that has been a part of that conversation about income inequality has been this notion of stakeholder capitalism, right? That when you are talking about making a company profitable, that you have to think about not only your shareholders, but also your employees and the broader community. And that has really gained traction in the conversation. So why discount that? Because it's, when you talk to these CEOs, they certainly feel that they are making a difference. Why do you think it's impossible for them to do so?
I think it's wonderful when there are individual people that have that kind of power, that realize that there's a lot of responsibility that comes with that power. But I think it's structurally impossible for them to truly find solutions. They're benefiting so much from the system as it is. And it's great if they choose to do something that benefits their workers. But really, their workers need to have the right to organize in their own self-interest. They're producing the goods. They should really have a voice in the production of those things. So, it's important. I think people are realizing that with the climate crisis that we're facing and with the rise of income inequality, people are standing up and are sick and tired of it. But I don't think that they're ever going to truly be able to come up with the right solutions. We need actually a democratic economic system.
I'm wondering then, Maria, what your view is on how this should actually come about, where it should come from, if not from events like Davos, where the elite, where the wealthy, the powerful are gathering. And ultimately, you know, those are the people who are controlling society right now. So how do you get them on board with some of the missions that are coming from the ground level?
I don't think that them being on board will help. I think what we need is, across the globe, we need people to build people's movements like Bernie Sanders is doing here in the United States. Nobody's going to give us what we need. We need to organize ourselves. We need to elect new politicians. We need to organize in our workplaces. That is actually going to be the source of any kind of change. It can't come from the top.
I want to talk about Bernie Sanders in just a second, but first we spoke with the historian Neil Ferguson, and here's what he had to say about the uneasy relationship between President Trump and the people attending Davos.
The dirty little secret of Davos 2020 is that they all need him to get re-elected. Nobody wants to say that out loud, but I think the consensus view is A, that he will be re-elected, and B, phew, that's probably a good thing if the alternative is shudder Bernie Sanders or Elizabeth Warren.
Okay, you heard him say in his accent, shudder Bernie Sanders. The first time we ever met, I asked you a question based, I was at Fox, and I always thought it was courageous of you to give me that interview. But I said to you, you know, my generation hears that word socialism and Bernie Sanders, and we have a negative reaction. I mean, my stepdad was a Cuban exile. How do you respond to that? And what do you make of the fact that Bernie Sanders is not only popular, but getting huge blowback? Hillary Clinton yesterday.
Yeah, I do not know what possessed Hillary Clinton to say that yesterday. So yes, it's no secret that many, many very wealthy people would like Trump to win again because he's restructuring the entire country and our entire economy and government to further benefit the very wealthy. So, you know, they might think he's uncouth or embarrassing, but the reality is they're very happy with the results of what he's doing. Meanwhile, obviously, people in the United States are looking for an alternative. Working people, the 99%, are very upset. And Bernie Sanders is unsettling Trump because he is very popular. He is giving people new ideas to think about what kind of society we want to have. Do we want a society where 45,000 people die every year because they don't have health care? That is not what ordinary people want, and that's why Trump finds it very concerning what's happening in, for example, the Rust Belt. And that's why he sees Bernie as a challenge, and it's why other people see Bernie as a challenge, and they're starting to see that.
And as we wrap up, there was that Harris poll over the weekend. 4 out of 10 Americans now are open to the ideas of some of the proposals that you and Bernie Sanders are putting forward. Unfortunately, we'll have to continue the discussion another time. Maria Svart, National Director of the Democratic Socialists, good to have you here on The Move.
That's great.
Well, the first U.S. case of the deadly new coronavirus was found in Washington state. That victim is in his 30s, and he had recently traveled to China. The news is heightening global fears of contagion, with 17 reported deaths and more than 470 confirmed cases. With us now to discuss is Yang Wang. He is director of the Center for Global Health Studies at Seton Hall University. Thank you for being with us. As you look at the spread of this virus and what we know about it so far, at what point can you determine how dangerous it is? Is it still too early to really have a good idea and be able to get your hands around it?
Well, we still need to, there's still a lot of information we don't know about the virus, for example, the animal source of the virus. But now it's increasingly clear that this is no ordinary virus. It has achieved a relatively efficient human-to-human transmission, and it has increased its virulence, as we have seen when the 15 healthcare workers in China were infected.
Hey, Pras here. How does this coronavirus, how does it differ from your regular viruses like the flu, for instance?
Well, the flu virus, they have a relatively low, actually quite low case fatality rate, and we have effective treatment to regular flu virus. But this case for the coronavirus that found in Wuhan, we still don't know much about the virus. We only know probably the trajectory of its spread seems to mirror what happened during 2002-2003 SARS outbreak, and there is really no effective treatment to the disease.
I'm glad you brought up the 2002-2003 SARS virus because I know that's a comparison many are making at this point. But with what we know now, knowing that many of the fatalities of this disease have been older individuals, those with pre-existing illnesses, is that too early of a comparison to be making and potentially fear-mongering, just given what we know so far?
Yeah, we're still sort of in the early stages of the outbreak. What I'm saying is that if you look at also the trajectory of the spread of SARS in the early stages, seems to be quite similar to what we are seeing now.
What about the sort of psychological effects of all of this? Because there's, whenever you have a potential global health situation, you have the reality of it, and then you have the psychology of it and how it affects how people move around, for example. There's been a lot of talk about how this could affect travel around the Lunar New Year. As someone who has tracked these kinds of epidemics in some cases before, how does that usually work, sort of the waxing and waning of panic, for lack of a better word?
Exactly. Well, our problem is that because this is an unknown virus, so this is what we call the dreaded risks. We tend to exaggerate the risks posed by the virus, and that is going to be associated with all kinds of fear, panic, if not hysteria. That probably is going to cause more damage than the virus itself.
All right, well, let's hope that all of it calms down one way or another. Thank you. Yan Huang is director of the Center for Global Health Studies at Seton Hall University. Appreciate it.
Amazon CEO Jeff Bezos was the victim of online hackers with a twist. Cybersecurity experts hired by Bezos found that the person behind the hack was actually Saudi Crown Prince Mohammed bin Salman, and a UN investigation agrees. In an earlier tweet, the Saudis denied involvement, saying, quote, recent media reports that suggest the kingdom is behind a hacking of Mr. Jeff Bezos' phone are absurd. We call for an investigation on these claims so that we can have all the facts out. Joining us to make sense of all of this is Dan Howley. And okay, the UN investigation said the 2018 hacking was an effort to, quote, influence, if not silence. It was Kamal Khashoggi and the Washington Post's very aggressive reporting of his murder at the hands of Saudi principals who were acting, as we know, at the direction of MBS, the prince.
Yeah, it seems like that's all this leads to, was the prior reporting that they were doing on Saudi Arabia and the prince, and then, you know, infiltrating Bezos' phone. And now Bezos and MBS had a prior relationship. They had exchanged phone numbers, as one does with Jeff Bezos and princes. Yeah, you become BFFs, yeah, biffles. So then they ended up exchanging numbers, and then this video came through. And this is something that is easily happen to any of us, but you would think that someone with a secure device like Jeff Bezos, it wouldn't have happened, but it was through WhatsApp. It was a video, infiltrated his phone, got malware on there, and then boom, the amount of info that was coming off there, I think they said it was a 300-fold increase of data that was leaving his device. So they were grabbing everything they could, and that obviously was to either influence Bezos. We know obviously about the affair, and then the we'll call them
photographs.
Photographs. I was going to say exceptional images of Jeff Bezos. I don't know why I said exceptional, but good for him, I guess. But so those images of Bezos that he then kind of copped to and was like, I'm not going to be pushed around. It seems that this all just came from there. And so now you have the Saudis saying, guys, it wasn't us. But you have this data showing that that's exactly where it came from. I mean, if the data shows that this is where it came from, where the video came from, how the data started flying off the phone at that point, I don't know who else it comes from but them.
What does it mean for WhatsApp, though? How are they infiltrated? How was he infiltrated via that app? Exactly?
So Facebook is actually, so this app comes from an Israeli security company, or not the app, but the software, the malware, right? That's originally where the impetus is for it. And this is something that has affected WhatsApp before, and Facebook is actually suing this Israeli company to say, hey, stop doing this. Because it's going to hurt our brand. Now, the reason why Bezos and MBS would use WhatsApp is because it's end-to-end encrypted, and so nobody in the middle can get access to that data. Unless you're on one or the other end. So that's where this comes from. That's why you want to infiltrate the phone. But I think for WhatsApp, it doesn't hurt them as much because this is a major player, and heads of companies and presidents have different issues.
You just hit on something, and maybe I'm in left field here. You've just this is almost an Achilles heel to everybody who thinks that because they have a WhatsApp or an encrypted service, that okay, if you're paying for these kinds of things, in that case, it's not necessarily, as you just pointed out. If someone's infiltrated at the beginning,
you have to trust the person
at
on
the
the
end,
other end.
Right. Yeah. It's not. There's no kind of man in the middle capabilities here, where you send it once it leaves your device, it's scrambled into whatever. It can only be decrypted by the software on the other end. So that means it's safe while in transit. And that's really what people want, especially high-profile figures like this. But I got to say, the fact that, again, this was Jeff Bezos' device, we talk constantly about how President Trump doesn't use a secured iPhone. Now, if the head of Amazon can get hacked like this, you would think the President of the United States would be a little bit more of a target. What does that say about his device then?
Right, and I'm wondering what the ramifications for this actually could be, if that's even being discussed right now. I know Saudi Arabia is, of course, denying all of these claims, but I don't know if there's a precedent or something that we can go forward with in terms of, a crown prince hacking the iPhone of a very prominent business leader.
Well, tech companies obviously rely a lot on Saudis for not even tech companies, but a lot of VCs and up-and-coming startups look to the Saudis for some funding. Look at Uber, right? Uber couldn't come out and really admonish them because of their connection. So I think there will be a kind of distancing publicly, but I don't see this as, a faucet will be turned off to the tech industry at large. I think really this is just an instance of, maybe we'll play our cards a little closer to the chest, to our chest.
Well, if there were no repercussions from a U.S. citizen being murdered,
right, exactly.
Probably not going to be any from them hacking Jeff Bezos' iPhone.
Exactly.
Or WhatsApp. I'm assuming he had an iPhone. All right, thanks, Dan. Coming up, more bad news for Boeing. The 737 MAX jets are not expected to fly until at least this summer. We're going to tell you how much that's costing the company. Plus, we'll bring you more coverage from the World Economic Forum in Davos, Switzerland, right after this.
Dow sliding into the red. This is On the Move. I'm Jared Blickery. S&P 500, for its part, up 13 basis points still. We'll see that it's holding on to its gains, at least some of them. No, this is one-year chart. Let's take a look at the intraday price action, and we can see that it is slowly and steadily giving up its gains for the day. NASDAQ Composite had been up quite a bit more, but it's holding on to most of its right there. Russell 2000 still underperforming for several days in a row here after breaking to the upside last week. We'll take a look at the 10-year T-note yield. It has reversed again, so it had been up and down and up, but not a big move here, not even 1 basis point. That's a fraction of a basis point right there. We'll call it a wash. And then we're also going to look at gold, if we can find it. There we go. Gold is holding above 1550 right now, but it is down slightly for the day. And here's the NASDAQ 100 heat map. Apple is up 0.6%, Alphabet up 0.5%, Microsoft and Amazon slightly in the red here. But I want to take a look at Netflix. We've been talking about that stock after it reported earnings yesterday. We have a nice uptrend in place right here. It's been breaking above its 200-day moving average, which is right about there. We want to see that hold, and if it does, I would expect it to go higher. If you want a cheap stop, probably put it under 320. We're also going to take a look at American Airlines. Now, this airline has been underperforming quite a bit over time, and we can see over the last 2 years here, it is finally breaking out of this base that has been forming here in 2019. Stick around, we're going to be back in 1 minute.
Business leaders around the world are in Davos, Switzerland at the World Economic Forum. Brian Sozzi caught up with the president of Dell Services.
I'm here with Howard Elias, Dell Technologies president of Dell Services and Digital. Howard, good to see you.
Hey, great to see you.
So this is your third World Economic Forum.
It is.
How have the discussions changed in corporate America over the past couple of years around technology and climate change?
Well, technology overall is, we believe, a force for good. We're technology optimists. You've probably heard Michael talk about that on multiple occasions, and we think technology is a force for good, including in helping on sustainability issues and for the environment. We put out our 2030 goals. We'll talk a little bit more about those, but we're very serious about technology playing a very important role, and all of the conversations we have are how digital and technology can help improve the world.
Do you think tech has gotten a bad rap? There are a lot of good stories in tech, but all we've heard the past year is things are bad.
Well, sometimes you come to the World Economic Forum and you get into a bad mood when you hear about all the woes in the world. And, not to put a damper on it, I mean, certainly there are some very big challenges in our world. But technology, as I said, has been a force for good. If we think about today, there are more families out of poverty. There are more kids less hungry. There are more educated people in the world. There's more women in the workforce. So, a lot of things have happened that are good that we should talk more about and then turn our attention to how those things we're doing, how they can help the things that are needing to be improved.
What do you think one of tech's biggest challenges are looking out over the next decade?
Well, just making sure that we play that important force for good role. Tools can be used for bad or for good. We've seen that with every tool ever invented by man and woman around the centuries. And so we want to continue to keep the spotlight on where technology is helping people improve lives.
You are a key player in the integration of EMC and Dell, which I think we could still call it the largest tech deal of all time, $70 billion?
$67 billion to be exact.
But who's counting?
Who's counting?
How will that combined company play? What is their role looking into the fourth industrial revolution?
Well, we really think about technology playing a role, as we call it, from the edge to the core to the cloud, where everything that's got electricity is going to have an IP address. We're going to be able to leverage all things happening at the edge, bring that back to core data centers. And by the way, those don't mean big data centers. Those are, hospitals and schools and factories and buildings. And then, of course, cloud, where you do your artificial intelligence and machine learning. So we provide the spectrum of technologies from the edge to the core to the cloud.
I've started to talk to a few execs already saying that the CapEx environment has started to improve just a little bit in 2020. What's your read? I know you deal with a lot of big clients.
We feel the same way. We actually just chatted about that as a team, that, coming into the end of last year, there were a lot of warning signs on the horizon around the macro. We actually see the macro incrementally improving. That being said, technology investment will always be ahead of GDP as companies continue to digitize their businesses, evolve their business models, and technology is a key part of that.
Why do you think the macro environment has improved?
I'm not an expert, but when I talk to customers, I think there's just growing comfort that the world economies are not headed for a recession. Growth may slow in some areas, pick up in other areas. I think some of the trade uncertainty is starting to settle. Brexit has got a path forward.
You sound like a macroeconomist.
Well, I read the headlines pretty good.
All right, fair enough. We'll leave that here. Howard Elias, good to see you. Thank you for joining Yahoo Finance.
Thank you.
Well, trouble is mounting, continues to mount for Boeing. The company's 737 MAX planes will remain grounded until at least June or July. That's months later than the company expected, although a lot of observers perhaps were aiming for that time frame. Joining us now with more is Alexis Keenan. So, Alexis, what are we hearing from the company? And I assume there's still some level of uncertainty even around this forecast.
Absolutely there is. This is not a hard and fast rule that this will happen mid-2020. That's what the company is saying. And I've actually lost count now, Julie, of the number of times that Boeing has changed its estimate for the MAX to return to service. But this time, the market reacting much more significantly, sending the stock to a new 52-week low. The company says it now expects that ungrounding to begin mid-2020. That puts us around July. United Airlines president also saying today during the company's earnings call that it does not expect to fly these planes this summer at all. In a statement, while trading was halted yesterday, Boeing said the FAA and other global regulators will determine when the 737 MAX returns to service. However, in order to help our customers and suppliers plan their operations, we periodically provide them with our best estimate of when regulators will begin to authorize the ungrounding of the 737 MAX. The company also said that more details will come when it announces its fourth quarter earnings on January 29th. That's Wednesday next week. News of that delay did come on the heels of reports that Boeing was seeking $10 billion in loan financing. Some analysts predicting that the company's MAX-related liabilities could balloon all the way to more than $25 billion. Now, so far, the company has reported its MAX-related grounding liabilities through the third quarter, reaching $9.2 billion total amount through that third quarter. And of that, $5.6 billion went to those customer concessions. Now, the grounding, any delay, it just adds layers and layers of additional costs for Boeing, not only the delayed payments for the undelivered planes, but also that compensation that Boeing is going to have to pay to each and every airline that has both undelivered and ungrounded or out of service planes, rather. So also then you have the stop down of the production line for Boeing 737 MAX. That happened on Monday. That ultimately makes these planes more expensive to produce. And added to that are those simulator costs. Boeing suggesting to the FAA, though the FAA has not said yet whether it will mandate simulator training, but Southwest Airlines today telling me that those simulators for the 737 MAX are not even yet certified by the FAA, though they have been ordered.
Sounds like a lot of hurdles still to come. Thank you, Alexis.
Many, yeah.
Coming up, riding to the top, Tesla surged past $100 billion in market cap, and the company is also a crowd favorite for car rentals. We're going to talk to the CEO of Turo about that right after this. Plus, before we go to break, take a look at some of the winners on the Dow right now. We've got Intel as well as IBM. IBM rising on its earnings.
little bit after 12:30 in New York City, 3 hours into the trading day. Stocks mixed right now. The Dow has fallen into negative territory. Gold was trading down lower this morning, and right now gold is still heading down at $1,557 an ounce. It does not take long. Netflix's viewing stands raise questions over just what it means to watch a show. Airbnb on wheels will talk to the company that's disrupting the rental car business just ahead. And time to act, what you need to know as the deadline to file a claim against Equifax over its massive data breach has arrived. Welcome to On the Move. I'm Adam Shapiro.
And I'm Julie Hyman. Thanks for staying with us. Well, Turo is a car-sharing marketplace where guests can book any car they want from local hosts across the U.S., Canada, the U.K., and Germany. Tesla vehicles, one of the top-earning models and top-searched cars on Turo's list. Andrew Haddad, CEO of Turo, joins us now via Skype from San Francisco to talk about the company and growth of Tesla models on your platform. It's good to see you again. You know, it's so interesting. As we talk about, side note, Tesla getting to a $100 billion valuation, I wouldn't think Tesla owners would want to share their cars, and I would think they would have the means to not need that extra income. So it's interesting that there are Tesla owners on your platform. How many are there, and what kind of demand are you seeing for those cars?
Well, Tesla is really hot on the Turo platform, both on the supply and the demand side. So on the supply side, last year, the total listings of Teslas on the app grew by almost 80%, and it's one of the fastest growing makes in the app. And then on the demand side, you know, the searches for Tesla continue to be in the top 3 most popular searches on the app. So we continue to see Tesla as a very hot brand. You're right, it can be surprising that if you own a Tesla, you know, why do you need to share your car and earn some money with it? What we're finding is, like for other premium brands, Turo has become a great place where you can car up. You can start affording a car that you otherwise wouldn't necessarily be able to afford because you can earn some dollars every month to compensate for the cost of ownership. So last year, the average Tesla listing generated a little bit over $850 for their host, for the car owner, on a monthly basis.
Andre, let me interrupt you for a second. Because, Andre, there's a lot to talk about here, and my mind is spinning because I love this idea. My brother has a Tesla. He won't let me drive it. But, let me ask you
he's not going to let any strangers drive it for money.
No. But let me ask you, this data that you're collecting, not just on Tesla, but the search for other automobiles, are you able to monetize that? Are there markets to sell that information? Because it seems to me you are on a treasure trove with the data you get through the app.
We are not monetizing it beyond using that data to just improve the experience for the people who are searching for cars. You know, if we know that you're interested in premium cars, we're starting to personalize, the search experience so that we show you premium cars ahead of all the other cars. But we're not actually monetizing this data externally, the company. Our primary focus is really continuing to build the marketplace and grow the number of people who are sharing their cars and people who are booking these cars. We think it's a tremendous opportunity, and we're still in the very beginning. There's almost 1.5 billion cars around the world. And even if your brother would be unwilling to share his Tesla with you, there's others that will be willing to do so. And so we think there's an opportunity for us to bring to the platform, millions of cars over time. And we think that can be revolutionary in terms of the impact on the economics of car ownership.
Hey, Andre, Pras here. So we actually, at Yahoo Finance, we rented a Model 3 via Turo to review, actually, for Rick and I, 2 dudes in a car. It was a great, smooth process. But I wanted to ask you about airports. You guys are involved in some litigation at SFO right now. What's going to happen here? Are you guys able to have cars that we can actually rent and pick up at the airport soon?
We're actually fighting the traditional rental car establishment, Enterprise in particular being the largest player in the incumbents. We're fighting these players at airports. And you're right, we're suing both the airport in San Francisco, the airport in Los Angeles, which are 2 of our major markets. We're suing to be able to obtain a permit. We would like to actually pay these airports fees to be able to operate at the airport so that our hosts can drop off the car to their guests curbside and offer, a 5-star service to their customers. Unfortunately, it has come to litigation because airports, are very concerned about anything that, can put pressure on their rental car revenues and fees that they're charged to rental car companies. Enterprise has been instrumenting airports against us. So unfortunately, it has had to get to litigation. In the meantime, we continue to operate at airports, but we're not paying them any fees. And we'd like to pay them fees, but we'd like to pay them reasonable fees, not the rental car fees.
Andre, who do you view as your biggest competition? Is it these incumbents like Enterprise that you're talking about, or is it companies like Uber that also are competing with customers or with drivers for their vehicles and the vehicles that they own?
Great question. We have two really different poles in our business. The first pole is the kind of travel segment. We call it the traditional travel, where you maybe live in New York and you're headed to San Francisco, or, you live in the UK and are visiting the US, and then you need a car because you're, going to be staying a few days in a city in a country where you don't have access to your personal vehicle because it's back home. So that's a big part of our business. That's the, what we call internally the travel market. And then we have another market, which is very different, very distinct, and is really fast growing, which is the market that we call local mobility, where we see many of our customers, especially younger, more urban customers, who have decided to let go of car ownership altogether or downsize their car ownership.
And that's where we're going to continue the conversation with you, because it's fascinating what your app is doing, especially for all of us who might not have cars or live in places where it's just not economical. Andre Haddad, thank you for being with us.
Thank you.
The Trust Act would establish a process to save some of our most important programs like Social Security, Medicare, and highway spending. Joining us with more from Washington, D.C. is Mark Goldwine, Senior Vice President for the Committee for a Responsible Federal Budget, which is a partner of the Funding Our Future campaign, a group we feature each week only on Yahoo Finance. Good to have you here. I don't want to get too wonky here. There is legislation making its way through the Time to Rescue United States Trusts Act. Essentially, if this all works as some senators want it to work, we would have fast-track authority once this committee makes its recommendations on ways to, for instance, save Social Security, which by 2032, is looking at paying 72 cents on the dollar as opposed to $1 for a dollar.
That's exactly right. I think what folks don't really understand is we have several trust funds that are really imminent danger. The Highway Trust Fund is projected to run out in just 2 years. The Medicare Trust Fund in 5 or 6 years, and Social Security in 15 years. That's when today's youngest retirees are 77 years old. We don't need to save Social Security for our grandkids. We actually need to save it for our grandparents. And the Trust Act would take a first important step by establishing several commissions to help us save these important programs.
So it looks like you have some bipartisan support for this, but even that is not a guarantee, right? So how likely is it that you're going to see this get through?
Well, what we saw with the 2010 Simpson-Bowles Commission, which I served on, is that it was actually the child of several legislative proposals that really started back in 2006. So I don't expect Congress to enact the Trust Act into law tomorrow, but it's getting more and more co-sponsors every week, and it's building momentum. And I expect that ultimately that momentum is going to lead to some action.
When we talk about fast track, the last time we had anything like that was the base closings in the 1990s. But when you're talking about spending of money for these kinds of programs, can you fast track?
So you could. The Trust Act does not get rid of the 60 vote threshold for the filibuster, like, for example, the Super Committee did in 2011. But what it does do is assure that any policies that come out of these commissions, and by the way, they need majority bipartisan support to come out, any of them get a fair hearing on the floor without poison pills, without amendments that are designed to ruin them. And I think that given how important these programs are for people's retirement security, for being able to drive to work, for people's health care, I think they've earned, if we can come up with a solution, a fair shake in the House and Senate floor.
Mark Goldwine, Senior Vice President of the Committee for a Responsible Federal Budget. Good to have you on the move.
Thank you.
Well, coming up, it's the last day to file a claim for the 2017 Equifax data breach. How to beat that deadline is next. Plus, former NFL linebacker and Super Bowl champion Carl Banks will join us right after this.
Let's take a look at the top trending stories on Yahoo Finance right now. Prince Charles is speaking out on climate change, calling it the greatest threats humanity has ever faced. The Prince of Wales warned world leaders at the World Economic Forum in Davos, Switzerland, of the implications of climate change and announced his new project aimed toward putting sustainability first. The 2017 Equifax data breach that affected nearly 147 million people coming to an end. Today is the last day to file a claim. As part of the $425 million settlement, consumers were originally offered free credit monitoring or up to $125. But in September, the FTC made it harder when it required people to share documentation for credit monitoring.
Well, former Super Bowl champ and New York Giant Carl Banks was not only great on the field, but he has developed a successful career in the sports apparel business as president of G3 Sports. Joining us now is Carl Banks. Yahoo Finance's Dan Roberts is also here. Carl, G3 I think of also as sort of a jeans company, and it makes other clothing, but it also has this sports business, right? And it's a big business. So talk to us about it. It's branded apparel, right? Jerseys.
It is sports branded apparel. So G3 is kind of the leader in, well, not kind of, they are the leader in fashion, from anything from apparel to handbags to swimwear with brands like Velbreken and Calvin Klein and DKNY. And for me, I was a young player in the NFL looking for an opportunity to really get into the fashion business. And I wanted to do it through sports. And I saw an opportunity to create these leather jackets, and the NFL gave me an opportunity, and the NBA gave me an opportunity to create a line of big and tall leather jackets. And who better to partner with than G3 Apparel, because at that time, and this is going back 30 years, they were the leader in leather. So I had to do some convincing because G3 was not really not into sports as a company. They knew black and brown commodity leather, and they did it very well, better than anyone. But as it turned out, it became kind of a path for future branding. Licensing is now the key to real estate at retail.
And Carl, I know you were instrumental in bringing back the starter jacket too, and working with
Yes.
the NFL to make the starter jacket an NFL kind of piece again. And I want to ask you while we have you, retro is really back in sports and fashion. You know, we've talked so much over the last couple of years about how Adidas has really made a comeback in the U.S. thanks to bringing back its original sneakers. It's all about retro right now. Why do you think that is? Kind of the sneaker collection explosion. What's driving all that?
Well, it's an emotional connection. And the beautiful thing about sports is that it intersects with just about every sector of society. And, you know, I have the starter brand, and it's been my passion to bring that brand back to the relevance that it was, because before there was Nike, before there was Adidas, it was the starter brand. And what I loved about starter, and that's what got me interested in sports apparel, is David Beckerman, the founder, was the guy who was able to take fandom and turn it into a wearable experience. And so for me, in having a platform and the resources of G3 Apparel and all of their fashion, I have an advantage over my competitors because I know what's trending. I know the fabrics. I can create fashion apparel where my competitors can't because I have the resources to do it. And Starter has always been at the forefront of fashion, even in its unique styling, its unique silhouette. So we have several different silos of business, but Starter is one of our main pillars.
Mm-hmm. And then while we have you, I want to always make sure we ask about the state of the sport when we get guys like you in. Let's talk about the NFL and where you see it right now. I mean, we've got the Super Bowl coming up. 2 seasons ago, the NFL kind of weathered this political storm that hurt ratings. Now that's over. But we also just had this big Aaron Hernandez documentary come out, and it ends with talking about head injuries. And I think it's kind of bringing that discussion back to the fore about CTE. Where do you see things with the NFL in terms of how the league has handled that, how much of a concern that is for people?
Well, I think the issues, the social issues that impact players when they leave the game, I'm not talking about the health, but the social, that's a microcosm of society. So we can have people that we work with here in this industry or any industry that find themselves on the wrong side of the law or whatever their circumstance may be. So that's just what it is. The NFL does a great job, and all the major sports leagues for that matter, do a great job of being socially responsible in a lot of areas and encouraging players with the resources that they have available to them to seek the mental health resources or whatever it is. So, but when we talk about the health, in football in particular, it's a violent sport, right? So I'm not a CTE denier, but I don't have enough information or no living athlete as of today, they don't have the research because it's all done after a player has been deceased. But I can tell you as a former linebacker, and I play it very violently and it was a big collision every time I hit. There are aches and pains, but I don't know enough about CTE, and I'm not experiencing any of the memory loss or things like that. And this is another thing that the NFL has done. They've provided resources for us all to get tested. So I had all of the testing done about a year ago. I just got my results back, and I'm thankfully in great health there. So I don't know enough about it. I'm not going to deny it because I know it exists. It's a collision sport. It's a car wreck, head-on collisions every time. But what the league has done, they've made the game safer. Right. They've taken some of those things out. And the rule changes, for me, are good. Old school people say, you need it to be. You don't. You really don't. There's enough incidental contact to where you don't need to get your head involved in. It's been dangerous. I never learned football using my head. I use football using my shoulders and keeping my head out of the way. And I think that's what they're re-emphasizing now with the NFL.
Carl, we wish you continued health. Thank you for
so
being here.
much.
Carl Banks is president of G3 Sports. Appreciate it.
Coming up, Hillary Clinton takes aim at Bernie Sanders. Find out what she had to say about the 2020 presidential candidate. That's next. Plus, Netflix changes its definition of viewership, what the streaming giant counts as a view, right after this.
Netflix, as part of its earnings release, also said it's redefining a viewer or a view. In the streaming giant's fourth quarter earnings report, Netflix announced a change in how it calculates what it means to be a viewer. Users now only have to watch 2 minutes of an episode versus the prior 70% of the episode, which is obviously a lot longer than 2 minutes in the vast majority of cases. Emily, this is something I think they hinted at before when they were talking about that Adam Sandler movie. They talked about the views of that being high based on this 2-minute metric. Is this the way it should be?
Well, what I think needs to really happen is there needs to be just some standardized metric across these new streaming platforms. I mean, Nielsen is imperfect because it doesn't count laptop viewing, it doesn't count mobile phone viewing, which is where a lot of these streaming platforms are getting their views. Netflix with its self-reporting, that's been called into question over and over again just because it is such a low bar. But as we have these new streaming services coming in, it's really imperative that these companies have an apples-to-apples metric for investors and viewers to be able to see the popularity of these shows.
Those metrics, as we wrap up, can also be useful if they should ever start selling advertising.
That's true.
But with that note, thank you very much, Emily. Thank you very much, Pross.
All right, and thank you all for joining us. Stick around for YFI PM. That's coming your way next.
It is 1 p.m. in New York City, and the NASDAQ and S&P 500 are hitting fresh records, with Boeing dragging on the Dow. On tap for today, President Trump extending his Davos victory lap by boasting about the strength of the U.S. economy, while he's doubling down on his playbook by announcing a potential tax cut and threatening more tariffs on the EU. Plus, the death toll from China's deadly coronavirus rising to 17 as the virus makes its way to the U.S. We'll have the latest on that, and getting out of student debt by shopping. We'll chat with the startup behind a first-of-its-kind cashback program to help people spend their way out of student loans. All that and more. This is Wi-Fi PM. Good afternoon, I'm Zack Guzman, and joining me today on Wi-Fi PM is Yahoo Finance's Sabeel Marcellus, along with Big Eyed Wish founder and host of Adweek's I'm With the Brand, Ian Wishengrad, back with us in studio. Good to see you again, man.
Thanks, good to see you. Thanks for being here.
On today's show, we're starting with the market action. Right now, green across the board. As we noted, the S&P and NASDAQ touching record highs today. The Dow there, as you can see, is up now 36 points, though Boeing still continues to drag on the overall index. But first, what we're discussing, the World Economic Forum is underway in Davos, Switzerland, where President Trump discussed everything from trade relations to the global economy, but he also had some harsh words for some of the past actions of the Federal Reserve during a CNBC interview. Let's watch.
The Fed was not good, as far as I'm concerned, and that was a big blip that should not have taken place. It should not have happened. Had we not done the big raise on interest, I think we would have been close to 4, and I could see 5,000 to 10,000 points more on the Dow. But that was a killer when they raised the rate. It was just a big mistake, and they admit to it.
So 5,000 to 10,000 more points on the Dow, guys. There you go. That's his call there. What is interesting is kind of the dichotomy of saying that the U.S. is so strong, the economy is pumping all cylinders, but then also calling for more rate cuts. I'm not sure how you square those things.
Yeah, so President Trump is definitely looking for a scapegoat. So the White House projected 3% GDP growth in 2020. It's an election year, and it looks like it's going to be closer to 2% growth. So he's laying the blame on the Fed, but those actions were taken back in 2018. 2019 has been a very strong year. We closed very well. So President Trump is just trying to figure out who he can blame should he possibly not win the election. But the U.S. economy is growing, so those are all positives.
And it's good to know he's going to take the country private with 10,000 more points.
Yeah,
if we get it up there, it's done. It just set the target. He's going private.
I'm not sure. As we've noted on the show, not all Americans take part in the stock market. So there are people to think about here, even though we might be at record highs, as the Democrats have highlighted throughout the campaign trail, that the economy might not be working for everybody. So even though we're at record highs, it's not necessarily everyone enjoying it the same.
Yeah, Zach, I'm so glad you said that. So if President Trump wants 4% GDP growth, then focus on income inequality. Focus on helping the middle class have more prosperity. That's really what's going to help GDP. If you really want to see that grow, give people more buying power when they go to the stores. Wages, those have remained flat. President Trump is not addressing that. Those are the kinds of things that are actually going to make a bigger difference for most Americans.
I think the election will be a real referendum on the truth behind all these things. I think ultimately elections, they say all these different things, but it comes from their wallet. Even if it's healthcare, it's wallet related. If you have a good job, you don't need healthcare. It's people that don't have great jobs, that don't get it from their employer, that all of a sudden healthcare becomes a big issue. And so I think what we'll really find is, does the stock market and all these records mean anything? Because most people do not participate in this, and this is just some scoreboard we point to, and Americans will really let you know, the ones that he talks to, whether they feel it or not come November.
And no one's complaining about the stock market reaching highs, saying, oh, it should have gone higher. We're celebrating that it reached 29,000 recently. So that's not a major complaint that the Dow's not going up another 10,000.
And the other one, every president calls it, but like the jobs report. Jobs are not all the same. And I think the quality of jobs is what we'll actually find too, because you can look at numbers and make them all look great for whatever reason.
Yeah, and to your point, Sabeel, when we talk about maybe trying to boost the middle class, he did hint at another middle class tax cut. That would be in his playbook. But his other piece of the playbook, of course, as we've highlighted through the battle with China, is tariffs. And he doubled down on that as well when he was talking about imposing tariffs on the EU. Want to play what he said on that front? Take a listen.
If we don't get something, I'm going to have to take action, and the action will be a very high tariffs on their cars and other things that come into our country. Now, saying that, I don't want your audience to get nervous. They're going to make a deal because they have to.
There you go. He's threatening their potential more tariffs with the EU. I mean, we've talked about that before. He's proven it, that he'll do it. We saw that with China, and now with EU, potentially the same tact being taken.
Yeah, President Trump is playing hardball, but it's with our allies. So with Italy and France, these are countries we can reliably depend on, also Britain. So a lot of this has to do with this digital tax. So they want to impose an extra tax on Google and companies like Facebook for them to be able to do business in those countries. And President Trump is basically saying, well, if you want to put that digital tax in place, then I'm going to put tariffs on your imports to sell your goods here in America. And it actually worked with France. So France's President Macron, he actually backed off that digital tax because President Trump wants to impose tariffs that are way too high. It's like 100% tariffs on roughly $2 billion in imports from France. So like French wines and all that good stuff that Americans love.
He does some really bold moves, and I think so much of his personality colors a lot of the things, but some of the things he does is kind of interesting and seemingly unprecedented, but I don't think are that horrible.
Well, certainly it wouldn't be horrible if he got his middle-class tax cut, this version, the second version through here that he hinted at it during an interview with Fox Business. So President Trump making the media rounds at Davos, he noted what could be in store, though a lot of people are skeptical that this middle-class tax cut would get through. Take a listen to what he had to say on that.
We're going to be doing a middle-class tax cut, a very big one. We're going to be doing that. We have to win the House, and I think we can. I think we will win the House. I'm going to make a tax cut, and we're going to probably make the other permanent. It's got a long way to go, in all fairness, but we're going to make that permanent for the middle class. So we'll be doing that. We'll be announcing it over the next 90 days. That's, to me, very important.
I'm not sure. I mean, he can announce it over the next 90 days, but as he said there, he even admitted, have to win the House to get this through. And I don't think anyone's expecting that to happen, so I'm not sure if there's any benefit to talking about a tax plan that won't eventually come to fruition.
There's definitely benefit in terms of a soundbite. Middle-class tax cut, middle-class tax cut, middle-class tax cut. Just keep repeating that. And he thinks that somehow Americans are going to think they're actually getting it when they're not. I mean, when you look at your wallet, there's a very slim chance that he'll actually be able to pass a middle-class tax cut before 2020, before the election.
I think he was aware that the calendar switched to 2020 and the light bulb went off and goes, it's an election year, because his look and his tone and the way he's doing things is back into campaign Trump and that thing. So it doesn't matter. Build the wall, they pay, doesn't matter. He knows what he's got to do.
Right,
I got to sprint right here. I made it this far. Oh my God, let's keep going.
Yeah, and he's back to his old base building tactics, really trying to appeal to the right wing.
I would like to see that middle-class tax cut. I mean, I would like to see it happen, right? Exactly.
So what happened with the first one and how that worked out. Of course, the Democrats will point out that a lot of those tax cuts went to people that maybe shouldn't have gotten them. That has been what they've said on the campaign trail. But of course, unlikely that will come through in the 90 days with the way that the House is set up right now. President Trump, though, also did discuss some troubling developments in terms of the coronavirus, and investors have been taking cues from previous outbreaks to assess how the pneumonia-like virus from China could impact the economy this time around. The Wall Street Journal reports that prior epidemics suggest markets can fall short-term but usually bounce back relatively quickly. So far, 17 people have died with more than 500 confirmed cases, and yesterday the CDC announced the first domestic case of the virus in Washington state. We brought you that news on yesterday's show, but President Trump said America has nothing to worry about. Let's watch.
We have it totally under control. It's one person coming in from China, and we have it under control. It's going to be just fine.
As we noted yesterday, during the SARS outbreak in the early 2000s, stock indexes in China, Hong Kong, and the U.S. all fell and then recovered thereafter, pretty much to where they were before the news kind of came out. But do you believe what President Trump's saying here, that they have a full handle on it, that we're down to just this, as we noted, starts with one case, Seattle, Washington. But as we saw with SARS, it spreads quickly from there.
Yeah, I have faith in the CDC. I think they can contain this. I was actually a reporter covering the Ebola crisis, and there was this one doctor who was in New York City who had treated Ebola in Africa, came back to his New York City apartment, and then it was like a big deal. There was so much hysteria. It's like, where did he walk? What subway did he take? And there was like investigators trying to figure that, retrace his steps, and also like who he contacted. So we had a fiance. She had to be quarantined. So this kind of situation, it's just not good. It creates a lot of hysteria. People get worried, get
scared about talking to their neighbors, scared about, catching some kind of virus. So this is important in terms of what China is doing to deal with the situation. We have one case so far is not a pandemic.
Yep.
It's not an epidemic. And in terms of China, why so many investors are concerned is because if there actually is a pandemic happening in China, then they might cancel business meetings. They might not want to travel as much. And it's actually a very busy travel season for China right now because the Chinese Lunar New Year is coming up. So in terms of shopping, so that's the concern there, is that the Chinese consumers might not be out there spending.
I agree. From an epidemic standpoint, I think I've seen enough and read enough that we have some really cool systems in place after Ebola. So I do think this one might be contained, but I think we're going to see this happening all the time going forward, and some will slip through and be really nasty. But right now, I think this one's all right.
I mean, certainly the case here is a little bit more improved than what's going on in China. We've been highlighting the deaths and cases there. Right now, we have the one in Seattle, Washington, but over there, the Olympic boxing qualifying tournament for Tokyo 2020 has been canceled due to the virus outbreak. According to CNN, they were slated to take place in Wuhan, where all of this kind of started. And we're now seeing that tournament get canceled. It is interesting, too, though, to highlight some of these stocks correlated to outbreaks before that we've seen pop back in Ebola. What you're talking about, Sabeel, Lakeland Industries, one of them was a stock that was up about 40% yesterday. They make protective clothing for things like this. We're seeing shares down 8% today. So kind of seemingly showing that there was an impulse spike in terms of people wondering about this and now kind of dying off a little bit.
This is every time. If there's a big cyber attack, any of those, I forget the names of the tickers, but those ones, they always spike up after a 60 Minutes episode or whatever, someone talks about it. There's a huge emotional component to the stock market. And I think in general, the one thing President Trump's done is because he fashions himself as the cheerleader of America and the rallier of the economy, he's able to kind of cheer it along in some fashion. And so I think the same time when you have an outbreak, you're like, let's get rubber gear. And it's a cyber attack, let's get Norton. And I think those things those go hand in hand because we're just humans.
Yeah, and we just highlighted the airline stocks too that were hit with a 1-2 punch yesterday off the news of this first case, as well as the Boeing news that we got yesterday too, that some of their 737 MAX recertification plans might be delayed till the summer as well. So a 1-2 punch for the airline industry, and no doubt eyes will be on this as we continue to track developments with that first case in Seattle, Washington. But coming up, Netflix shares are in the red after reporting results from its first quarter of competition with Disney+, why Wall Street is shrugging off the streaming giant's miss. The shares, as you can see there, off about 3%. Plus, after a lackluster year of IPOs, we'll chat what's ahead this year with Deloitte right after this. Welcome back. Netflix shares are on a wild ride after the company reported quarterly results. The stock, as you can see there, is in the red, off more than 3% at the moment. The streaming giant posting earnings of $1.30 a share on revenue of $5.47 billion. And it comes as Netflix's forecast for subscriber growth in the current quarter fell short of Wall Street's estimates. Guys, increasingly they focus on international growth here over U.S. growth, though we know that the U.S. subscribers are where this company makes their money. Not exactly a super strong quarter for Netflix here.
No, so they're focused on their global growth, so that story is rosier than the domestic story. So they were able to add 8.7 million subscribers in the fourth quarter, which was more than they had expected. But when it comes to what's happening in the domestic area, you're seeing they were expecting to add 600,000 roughly, and they only added 420,000 in the US and in Canada. So Netflix is basically just owning up to it, saying, yeah, we've had more competition. Disney Plus has launched. We have more competitors in this space, and also raising prices. Netflix would love to raise prices consistently, but clearly now is not the right time when you've got all these competitors bringing down the price as much as possible and adding ads so that it can be free.
Well said. There's nothing to say. I agree, unless they don't do AVOD. And everyone's coming in with these crazy offers. And so with the ability to turn on and turn off, unless they have enough hits where you're like, God, there's like a queue of everything I want to see. They have a lot of content, but a lot of content's not a lot of hits. Right. HBO over the years has been able to just, oh my God, when one thing ends, the next one picks up and it's so good. And a bunch of Bs are not going to get you there. You need some As. And I don't care how many awards The Irishman wins. It's not it's not something we're all talking about. They need those mega tentpole, oh my God, campfire moments to keep people, or else it's like, Netflix is just killing time. It's Instagram.
Yeah, they also highlighted the fact that some of their shows have been outperforming some of Disney's and Apple TV's shows in terms of Google search trends. Though some of that was a little bit misleading because they were including global search trends versus just in the U.S. The Mandalorian actually beat out Witcher when it comes to search trends. So that was interesting to see in their earnings report. But also they noted the fact that we've been following their net cash position. Q4, that was down about $1.5 billion. We've continued to track how they're going to be spending moving forward. They said that this will be a peak year in terms of negative free cash flow. And that's what they've been telling investors for a while. But the question becomes, if you believe that moving forward, if they have to spend more to make A content instead of settling for B content, and there's no real correlation. Sometimes you could spend a lot of money and have it be flop. Then I don't know if you need to buy this theory that they're going to actually peak in negative free cash flow as they say they are. And I'm not sure the trends have been pointing in that direction.
Yeah, I think that's why Reed Hastings is under so much pressure to put commercials in Netflix. Like, some investors would actually like to see that because they think that could be some kind of revenue stream for Netflix. But he's right. He's like, commercials are not the be-all solution that many people think it's going to be. Because if Netflix actually puts ads, then that destroys the whole Netflix and chilling and the whole experience for the consumer. They really can't afford to do that. And then how are they any different from Comcast or one of those other broadcast networks that have a lot more content, a bigger library?
I'd say what I find in digital, coming from like the media space, what a lot of people do, I was with a client today and they talk about, well, we're like 85% male. The only reason they're 85% male is that the algorithms keep going to where people are purchasing. It's not necessarily where you're positioned and who you're targeting. And Netflix loves to talk about its data and how they make stuff. So they start making a lot of true crime. They start making a lot of these things that they think work, as opposed to where the Plepler of the HBO days was a tastemaker and would say, I need these things. And it wasn't letting the algorithms dictate, because algorithms don't make successes, they just make hours watched. And I think they have to de-algorithm and go back to auteur. And if they can make a few tentpole auteurs like a Stranger Things, they're in really good shape.
And you mentioned Plepler, he's at Apple TV now, so
yeah,
there's that. He's going up against that. But you also mentioned the metrics, and Netflix did tweak how it defines viewership. The company now counting a view after just 2 minutes rather than their previous method of streaming 70% of a total episode or film. The new movie is expected, the new move, I should say, is expected to boost their numbers by about 35% when it comes to viewership. That's not necessarily so closely watched, though. On Wall Street, they pay more attention to subs. And as I was saying, I think increasingly more attention to how much money is being burned through here. Just want to highlight again, the forecast for 2020 is $2.5 billion in terms of negative free cash flow. In 2019, they say the peak, which was the full year, was negative $3.3 billion. So it is projected to come down a bit. If they miss that, though, I don't know what happens to Netflix.
One strategy they could employ that used to be anti, the other thing that says Netflix is no ads, is the idea that you could binge everything. What you could do is you could start to stretch your windows, and when you know you have something really hot, go every few days. Start to just change it so you
Right.
stretch people on and make them keep coming back for something. But when I rip through it in 3 days, you got to make so much A content to keep me, because the good stuff, I'm going to go till I can't do it anymore.
Right, and then I'm going to cancel my subscription. And Disney gets that with The Mandalorian. I don't watch the show, so I forget exactly how they roll it out, but I think you can't watch the whole season all at once. I mean, there's a limit to what you can watch, and they kind of hold you to it. So you got to keep the subscription because you want to see the next episode.
Same thing with HBO too. I mean, I'm watching some of that stuff now too, and that's episodic, and you got to stay on.
HBO's really good.
But it does. I mean, the longer term though, Netflix is up 27,000 since its IPO. So I mean, this is one of those companies that did give investors a chance to ride it all the way up. IPOs of late have not necessarily done that. 2019 was kind of a dud year for high-profile IPOs like Uber and Lyft, which are still trading below their respective IPO prices. But overall, last year actually broke a 3-year streak of rising IPO activity in terms of the number of companies going public, as overall IPO proceeds fell as well. So joining us for more on what to expect from the IPO game this year is Previn Wass, U.S. IPO and software leader at Deloitte, and Touche. And Previn, I mean, heading into 2019, we highlighted some trends, and what we noted was that big unicorns were waiting longer and longer to go public, and that a lot of the gains had already been made, and that public investors would be better suited to wait about 3 months or so to buy some of these names. Any reason to suspect that the trend of companies staying private for longer won't continue this year?
No, I don't think so. I think the trend of staying public, staying private for a longer period of time is here to stay. I think if you look back 10 years when companies went public, it was generally going public, with an idea, with an idea, let's say, 20 years ago. 10 years ago, it became, as soon as I approach 100 million in revenue, then let's, think about going public. And perhaps 5 years ago, it was, 200 to 500 million revenue, but not necessarily looking at profitability or cash flow metrics in order to go public. Therefore, I think the trend of staying private for longer and right-sizing, getting your revenue numbers up, getting your profitability metrics up is here to stay.
It's interesting, though. I mean, when we look at the numbers themselves, 2019, the average total return for IPO companies, new public companies, was about 20%. Most of that, though, 18% came on day one. So really, after the first close, you're really only looking at an average aftermarket return of about 1%, according to Renaissance Capital numbers. So, I mean, if that's the case, it kind of does go along with the same theme that a lot of these are so big, they're built up. You're not exactly expecting growth from some of these IPO names, so they're just going to sit there for a while. And that's proven out when you look at Uber and Lyft. So, I mean, what is the expectations? Are there certain markets? I know healthcare was huge in 2019 for some of those bigger gainers. Is that going to be the same trend to expect in 2020?
I think that, if I think of industry trends, I think, enterprise software comes to mind. I think, based on the companies that we're talking to and dealing with, there are some very nice enterprise software companies that are looking at 2020 favorably. They have the right metrics from a growth perspective, cash flow, being cash flow positive, break even, or in some cases profitable. So I actually think that there are some, enterprise software companies that are going to look to 2020 as a year to exit.
Got it. So those to follow in Zoom's footpath.
Right. And when we talk about the IPOs that got like the most flash, the most attention this year, a lot of them were attached to CEOs that are famous and the cult of personality there. WeWork comes to mind right now. So do you think we're going to move away from that, where investors are going to focus on the fundamentals, or is going public a very important aspect of that, really being the type of CEO that's a star that really inspires people?
I do think, for every company that gets mentioned with a strong CEO or, some sort of governance issue, there are hundreds of companies in the Valley or startups that have, regular board meetings, CEOs who play nice, let's say, with the board. So I do think that going public is still, the right way to approach it. And I think that there are a lot of companies out there that have the right look and feel to be a public company.
Well, it's interesting that you use the term going public, because that would also include direct listings. We saw that again in 2019 with Slack.
Sure.
Some people are expecting that out of Airbnb, with some of these companies that are so large and so well known that you don't really need to hire an underwriter and really pursue the full IPO route. Do you think that's going to continue as well? Just one last trend question to get in front of you for what to expect there overall for some of these bigger tech names.
Sure. So direct listings is not for everyone, right? Direct listings are for companies that are, have a strong balance sheet, are potentially cash flow positive, that they don't really need the capital infusion. So, again, going into 2020, do I expect direct listings to be a trend? I don't think it's going to be a trend, but I do think, based on the conversations we're having, there are a lot of companies that are exploring whether a direct listing is the right exit model for them. And I do expect to see more companies take on a direct listing. I just don't think it's going to be a trend. Again, it's not a capital raise. It's really liquidity for investors, for founders, and for employees. So it really the company has to fit the model in order to do direct listing. So again, I just think we're going to see. I think the trend is going to be more IPOs with more people looking to direct listings and having to have the right business model in order to execute on a direct listing.
Yeah, and as we saw in 2019, the list of companies that are startups that are actually profitable, very small. So the people that would actually want to go that direct listing route, not a lot of them on that list. Previn Wasta, thank you so much for taking the time. Appreciate it, sir. All right, well, just after the break, Washington's Attorney General suing Trump's inaugural committee over improper use of funds at Trump properties. Why he says the scheme included paying for event space that wasn't even used. When YFI PM returns. Welcome back. We are checking the market action we're seeing right now. Still green across the board with the Dow up about 78 points, the S&P and the NASDAQ up as well, with the NASDAQ leading the way higher for now. All right, well, the D.C. Attorney General is suing President Trump's inaugural committee alleging improper use of nonprofit funds. Joining us now to discuss is Yahoo Finance's Kristen Myers. And Kristen, his office is looking to recover $1 million here.
Just over $1 million for abusing, as you mentioned, these funds. So the inaugural committee, which a lot of people might not have known, is actually a nonprofit. And as such, and according to DC law, they are not allowed to use funds to essentially enrich, well, the president. And that is exactly what the DC's AG's office has said. So I want to read these three allegations. One, they said that they were abusing nonprofit funds to enrich the Trump family. Two, that they were failing to seek out fair market value for event space and services rendered. And third, the third allegation is that they were using nonprofit funds to throw a private party for President Trump's family. Now, this all is centered around the Trump International Hotel, which we have talked about a lot because it's not exactly doing very well. But they say that they paid way above market rates to use the ballroom space. And one of the allegations, they said that, a prayer breakfast not associated with the inaugural committee only paid $5,000 to use one of the event spaces at the hotel. But the inaugural committee, paid over $150,000 for the same space.
Yeah, if anything, you would have expected it to be less if you're thinking about connections there.
Well, that's the other thing. They said that they actually had been given discounts and were given actually lower than market value, opportunities, and they didn't explore them. They didn't explore potentially getting something for cheaper or just paying fair market value, that they actually paid above that. And then the third thing was that they actually used these funds to throw a private party for President Trump's children, that the president wasn't even there, which is clearly not a part of his inaugural events.
Yeah, and the response so far from the Trump International Hotel's side has been mostly that all of this is politically motivated by the DC AG that is a Democrat.
Well, that's a good question. Okay, that's the response, the standard response. It's politically motivated. So does that actually hold sway with the Attorney General's office? I mean, can we actually expect that this will blow back on President Trump possibly?
So the district attorney has said, frankly, he's sued other people because of violating this law before. He's gone after schools, he's gone after nonprofits within DC. So clearly he's very willing as well to go after the president's inaugural committee themselves. They actually said in a statement, which I want to read, it says, district law requires nonprofits to use their funds for their stated public purpose, not to benefit private individuals or companies. In this case, we are seeking to recover the nonprofit funds that were improperly funneled directly to the Trump family business. Now, we've discussed this before. Actually, this summer, I talked to you guys about how there's actually a nonprofit, or not a bipartisan watchdog group, not nonprofit, that found that President Trump is in violation of over 2,300 ethics violations. So this is something that we've talked about a lot.
Conflicts of interest.
But there are many conflicts of interest within the presidency. And
this has nothing to do with the impeachment trial.
No,
this is a separate issue.
This has nothing to do with that. He could probably even say, look, the inaugural committee did things that I was unaware of. I'm not tied to it at all.
Yeah.
But again, this is the DC AG's office going after just his inaugural committee.
Yeah, so potentially one more problem there for the Trump family to worry about. But shifting
Are they
away,
worried?
I don't know, maybe not, who knows? Shifting away from that though, a new study out from PayScale highlights new data on the gender pay gap, and I know that you have been looking into that one as well.
Yeah. Okay, so PayScale came out with a new report early this morning, actually, that found two pretty big things, right? On the first hand is that for women, at least younger women actually have a smaller gender pay gap than their older counterparts and some of their older generations. So I want to give you some of those numbers. As you guys can see there, essentially for women under the age of 30, and what we're looking at right now is the uncontrolled gender pay gap. Those women are paid about 84 cents to every man's dollar, but that number, as you can see, if you are over the age of 45, falls to 71 cents for every dollar that a man earns. Now, there's also, I want to tell you guys here the difference between the controlled and uncontrolled numbers. Uncontrolled means the median salary, and a controlled number actually considers people in the same field, the same job, same education, same experience. So, but as you can see there, even with the controlled gender pay gap, obviously much better than the uncontrolled one. Younger women still doing a little bit better than older women. The reason for this is that what they found is that transparent pay processes, so essentially when everyone knows what everyone is making, when I know what Ian's making, when Sabeel knows what Zack's making, it makes it easier for us all to say, hey, that's not fair that, he is making so much more than I am for the same job. So essentially a transparent pay process neutralizes that pay gap. However, some industries and also some different jobs, you could say, are actually very resistant to that transparent pay process, namely jobs at the director and executive level, and we've talked, about this before, they're very resistant to neutralizing that pay gap. So as you're going to imagine, older women are probably more likely to be holding those director, those executive level positions, and unfortunately for them, that's actually where that pay gap widens.
Yeah, I think all employees can pretty much agree that pay transparency is a good thing, but the question is to achieve, to close that pay gap, who does the burden fall on? Is it on employees to ask their other colleagues, how much are you making, how much am I making, and then, then speak to the boss? Or is the burden on companies to somehow make those salaries more transparent to all employees?
Right. I think that's a really good question. I think most people would say it's on the burden of the company to make sure that all of their employees are being paid equitably. There's a few reasons for that. One is just a good business practice. You want to make sure that all your employees feel like they're being paid fairly for fair work.
Yeah, there's a lot of concerns that a lot of employers have raised, though, about pay transparency and what that means for the actual office mentality.
Data
when you start posting
is power, guys. Data is absolutely power.
Knowledge
is power. Data is power. The moment, as we can see, that women get it, they are able to effectively use it to make sure that they are getting paid just as much as the men in their workplace. So I'm going to need to know your salary, Zach.
Yeah, we'll talk about it after.
Yeah,
we can also talk about
that.
We can also talk about how it makes for some very awkward. I mean, once it gets out there,
Feeling awkward.
Are you
right now?
blushing? I think he's blushing.
I'm just saying that either way, you can have an awkward conversation because you find out there's a pay gap, or you find out there isn't. Either way, Kristen Myers, thank you so much for bringing us that. Very interesting stuff. Let's check in with Ines Ferre on the floor of the New York Stock Exchange, though, for more market action. Ines?
Zach, the major averages are in the green. Today, the NASDAQ and the S&P touched new highs with technology leading the gains. The NASDAQ, percentage-wise, is gaining the most, and the best performer on the NASDAQ being Tesla. Tesla reaching new highs and also reaching a $100 billion market cap. If we take a look at the Dow, the best performer on the Dow today has been IBM on the heels of its earnings. Also want to mention that Apple reached new intraday highs today. And then just looking at United beat on earnings for its latest quarter. During their conference call this morning, executives said that they have reached their 2020 adjusted EPS goal 1 year ahead of time. Now, analysts during the conference call peppered questions about the Boeing 737 MAX jet, which continues to be grounded, and executives did not give many details as to the economic impact of this grounding, but they did say that it has been a setback for the company, and had they had the MAX, this would have benefited their revenue, also their CASM, their cost per available seat mile. And also executives said that given the announcement that Boeing made yesterday that it's expecting the ungrounding to begin mid-2020, that United will be announcing soon a pushback of its schedule, and executives do not anticipate to be flying the MAX this summer. Zach?
All right, Ines Ferre on the floor of the New York Stock Exchange. We'll check back in with you later on in the show. But next on YFI PM, ESG investing is gaining in popularity, but can you actually make money investing in the social causes you care about? We'll head out to Davos to chat with BlackRock's head of sustainable investing to get the answer. More YFI PM right after this. Good afternoon and welcome to YFI PM. I'm Zack Guzman, and join me today is Yahoo Finance's Sabeel Marcellus, along with Big Eyed Wish founder and host of Adweek's I'm With the Brand, Ian Wishengrad, back with us in studio. Guys, what say you we check the markets right here? How about that? We're checking it out right now. It's green across the board. The Dow up by about 82 points. The S&P and the NASDAQ up as well. The NASDAQ, as you can see there, leading the way higher, up by about 0.6% for the time being. Well, business leaders from around the world are meeting in Davos, Switzerland for this year's World Economic Forum, and Yahoo Finance's Julia LaRoche sat down with Brian Deese, BlackRock's global head of sustainable investing, and he explains why climate risk is investment risk. Take a listen.
We're joined by Brian Deese, the global head of sustainable investing at BlackRock. Brian, thank you so much for joining us.
Happy to be here.
All right, well, sustainability, specifically environmental sustainability, is just such a huge topic here at the World Economic Forum. I just want to back up a bit and get your take on how you define sustainable investing.
Absolutely.
And it's the right place to start because there's a lot of confusion in this space. So we define sustainable investing as combining the best of traditional investing with insights about the environment, about society, about governance, in order to generate a better long-term outcome for our clients. And so it really is about taking the best of what we know about investing and improving on it by better understanding these recent trends.
And how do you approach the understanding of some of these recent trends? Like, walk us through how that works.
Sure. So we take the issue of climate change. Our research and the work we've done really reinforces to us that climate risk is investment risk, like any other area of understanding investing. And so it's about measuring those risks, whether they are the physical risks of increasing wildfires or storms and how those will manifest themselves in the value of companies or the value of assets, but also the transition risks. As the world transitions to a low-carbon economy, it creates incredible opportunity for companies that are pioneering carbon-efficient technologies, but also threats for companies that are reliant on traditional fossil-based production. And so it's really understanding those risks, better measuring them, and then integrating them into the investments we make.
Well, BlackRock CEO Larry Fink, he sent out his widely read letter talking about how climate change is going to be at the center of BlackRock's investment thesis going forward. I guess, he always sets the tone for CEOs and how they should be thinking about different issues, but do you think that people are just discounting the magnitude of what climate change could mean for business, how it could, be detrimental to the economy?
Yes, and the principal message from Larry's letter this year and our message is that we are on the verge of a fundamental reshaping of finance. We're going to see a massive reallocation of capital, and that most financial models and most financial market participants are not fully grasping the magnitude of these changes.
I want to also understand how BlackRock is going to lead the way here, because you all do a lot of passive investing. How do you kind of take that role and create that sea change? Do you need to be more active, or I'm curious how this would work?
Absolutely, and one of the things we did this year was, in addition to Larry's letter, we put out a letter to all of our clients saying, here are the things BlackRock's going to do. So first, in our actively managed portfolios, about $1.8 trillion where we have discretion, we're integrating these risks, and it will affect the positions that we take. For example, we've made a commitment to exit thermal coal from our active positions. Second, with respect to the index investments we provide, we've made a commitment to provide sustainable versions of all of our flagship indices so that we can offer investors choice and encourage them to look at the sustainable versions, because it's our perspective that those sustainable versions are likely to do better, if not the same, across time.
It certainly seems like we are in a moment in time. I mean, we're hearing not just BlackRock, but other companies coming out, wanting to be carbon neutral. What do you think is making this such a viral moment right now? It seems like climate change is just front and center. Why do you think it's gone viral?
Well, the first is the science and the increasing salience of these physical risks, whether it's the wildfires in Australia or in the west of California, or the incidents of flooding that we're seeing around the world affecting farmers and crop yields. These physical risks are becoming increasingly salient. And the second is, I think, the reaction to society's unhappiness with the way governments and companies are responding. And so the populist movements and the student-led movements that we're seeing are, society has different expectations of how companies operate and how governments operate. And that's part of why we, as investors, believe that we're on the front end of a big reallocation of capital, because ultimately those expectations will be manifested in capital allocation decisions in the future.
And what do you think will be the biggest challenge going forward?
The biggest challenge is whether the financial industry and the models that we use can keep up with the rapid pace of change.
Brian Deese, Global Head of Sustainable Investing at BlackRock, thank you so much for your time.
Thank you.
All right, stay tuned for more live coverage of the World Economic Forum in Davos right here on Yahoo Finance all week long. Well, coming up, how shopping can now help you pay down your student debt. We're chatting with a startup dishing out cash back tied to student loan payments. For more on how it works when YFI PM returns. Welcome back to Wi-Fi PM. Exciting developments in the student loan space to talk about today. One new startup will give you cash back from online shopping that consumers can use to pay down student debt. Future Fuel users can earn up to 30% in cashback rewards if they shop at more than 450. I was going to say 150. No, 450 retail partners, including stores like Macy's and Walgreens. And joining us now is Laurel Taylor. She's the founder and CEO of FutureFuel.io. And Laurel, this is called the Give Back Program. It's a new program.
It's a new program. It's a new program, and we are so thrilled to announce the 450 participating brands. Every time a consumer purchases with those participating brands, a percentage of that purchase will be directed to pay down and crush their student debt. And we're inviting all of your viewers today for the first time ever. Any consumer, any household can go to futurefuel.io, click Crush Debt, sign up. It takes 20 seconds for early access and an early preview to Give Back by Future Fuel.
How does it work, too, though? Who's paying for the cash back to go towards the student loans here? Is it the retailers? Is it you? Is it half and half? And how does that work in terms of the cashback aspect?
I'm so glad that you asked that question. Thank you. So the elegance is really in the simplicity of the user experience. So we're borrowing learnings from Honey and Ebates, both in business model as well as user experience. So how it works, in the spring, in March, users will be able to download our Chrome extension, and then they just shop as they normally would, day in the life. My groceries that I spend $300 to $500 a month. Maybe some sneaks, my Bobby Brown for when I put on my lips.
Yeah.
A Ralph Lauren jacket I check out at Macy's, right?
Yeah, you add that up. That's pretty substantial cost.
It's pretty substantial. And so now we are empowering users to leverage their own purchasing power to pay down student debt. So the retailers pay us a modest commission, which is why it's free for the user. And then the rest of that goes to directly pay down their debt. No checks in the mail. We actually automate the entire user experience. You check out, you got your groceries, you're putting food on the table for your family, you're crushing debt. We figure out where to send the money based on the highest interest rate student loan. The user doesn't have to think about it. They don't have to know which student loan, interface with the servicer.
You choose for it as well. Very interesting
do it for
stuff.
them.
So there's that.
So is today the first day that you're rolling this out, and how much interest has there been among consumers?
I love it.
Because if I'm getting a Ralph Lauren jacket, I'm not necessarily thinking about my student loan debt.
Okay, so great point. We have brands. These brands are really at the heart of America, right? And these are the largest retailers in the country that have signed up to participate in this program, the full spectrum, right? And so the demand has just been spectacular. We literally announced this about 4 hours ago. So this is the first time that we're ever talking about this right now. And so, you know, when you have student debt, we know our purchasing power is suppressed, right? We may not be thinking about a Ralph Lauren jacket. We may if we've got a big interview coming up. We are thinking about the staples and everyday brands that we interact with in the fabric of daily living. And now it's literally free money, right? If you don't sign up, you're leaving about $27 to $50 a month of cash that retailer will pay for you on the table that can be directed to your debt. On average, that's going to shave about $4,000 in almost a year off the debt of the users. When you bundle it with Roundup, we're talking 4 to 5 years. That's our mission. Let's get half a decade off the back end of that loan.
Wow.
So question, I appreciate the Chrome extension. What happens in brick and mortar?
Brick and mortar. So great question, Ian. We are starting with online shopping, but similarly in terms of our maturity and evolution, that online to offline experience and the continuity, there are some brands that are a little bit more sophisticated than others. So we will be rolling out that online to offline, but we're really starting, some of these brands have $100 million annually in purchasing power just online. So that's really the initial experience.
All right, there you go. Laurel Taylor, big news from Future Fuel. Thank you so much for joining us. Appreciate you sharing that with us right here on Wi-Fi PM. Well, after the break, the shocking new report that claims Saudi Arabia was behind the hacking of Jeff Bezos' phone by using a spyware malware sent in WhatsApp messages. Top cybersecurity expert joins us next to break down the details. Wi-Fi PM is back in 2. Welcome back. The United Nations is calling for an immediate investigation after Jeff Bezos' phone was allegedly hacked by Saudi Arabia. The bombshell report from The Guardian details the Amazon CEO received a message on WhatsApp from the number used by the Saudi Crown Prince back in 2018. And that message included a malicious video file that infiltrated Bezos' phone. The Saudi embassy responded to the report earlier today, tweeting recent media reports that suggest the kingdom is behind a hacking of Mr. Jeff Bezos' phone are absurd. So joining us now to discuss is cybersecurity expert and chief security advisor at Sentinel One, Morgan Wright, joins us. And Morgan, it's good to see you. The report says this was discovered through the results of a digital forensic analysis. Right. Your take on what's really going on here? I know there's spoofing technology out there that could kind of hide who's sending messages or whatnot. What's your take on whether or not Saudi Arabia is telling the truth?
You know, the good question about that, I used to do some advising for the State Department Anti-Terrorism Assistance Program, and look, words mean things. The country of Saudi Arabia is saying the country is not behind it. That may be factually correct. The Crown Prince is probably behind this, and for a couple reasons. Obviously, Jeff Bezos is a target because of the Washington Post, which factors in later into the covering of the killing of the reporter Khashoggi. The other thing, too, is he manipulates opinion and world opinion. Saudi Arabia is very concerned about this. So it's very likely the prince could have been involved in it without the implicit knowledge of the kingdom. But make no mistake, when you're the richest man in the world, you are always a target. And I'm just surprised it took this long to get into his phone.
Well, you say you're surprised it took this long, but what about the technology to do that? Are you surprised at all at the simplicity of a video file sent through WhatsApp? I mean, no. Seemingly that happens to a lot of people. We're talking about the world's richest man here. You would have thought that the protection would have been larger, or the fact that he would have had two separate phones to separate personal from business needs. I mean, what about the defense by Bezos?
Yeah, look, first of all, to your point, he should have had a separate phone. Anytime you do stuff like that, you know, you just need to have a separate phone without all of your personal information on it. But the other point, it's actually gotten easier because, look, through the use of, we've learned a lot about how mobile apps work. Facebook now owns WhatsApp, so it's not to say that they've missed the ball on this, but there are a lot more. They have a lot more bases to cover between Instagram, Facebook, you know, their messenger. So these vulnerabilities are existing. They're being exploited by nation states like China, like Iran, like North Korea. So we're finding out about these vulnerabilities, and this one came back from 2018 is when this originally happened. Now, what's interesting is that it was actually easy to do because he had a trusted relationship with the prince. They were messaging back and forth. What's interesting to find out is what was the actual spyware used. Some people saying it was from a company in Israel. They've come out and said, absolutely not. It's not us. We don't target U.S. phone numbers. But in any event, to your point, Zach, it's very easy to send a file. And in fact, one of the vulnerabilities, all you had to do was make a call that wasn't answered, and that would actually implant the spyware. So we're finding it every day is a new vulnerability in a lot of these mobile apps.
Yeah.
You know, what really fascinates me is the whole geopolitical play around all of this. So the UN stepping in and saying there should be an investigation, basically pointing the finger at Saudi Arabia, saying that this was an effort to influence or silence Jeff Bezos in the Washington Post because he owns it. What can the UN actually do without President Trump or the U.S. government actually backing up any kind of measure or investigation?
Nothing. The UN could do absolutely nothing. All they can do is make a statement. They can grandstand. Look, we don't need to be told to investigate, you know, a crime that has occurred. Here's the interesting thing, though. Why did Jeff Bezos, shortly after this happened, decide to get his phone examined? I think there were some other things that we are not aware of, maybe tied to his divorce, maybe to the exposure of the compromising material. But he felt the need to get his phone examined shortly after this happened. So there's some circumstances. Look, the UN can call for it, and I get it. They're tied into it was actually the special I forget the title of the name, but the person who is responsible for looking into extrajudicial killings, which Khashoggi was. So they're saying you need to investigate this to see if it played a part, because if you believe in coincidence, which I don't, they got into his phone months before Khashoggi was killed. Now, was that just a mere coincidence? Or did they know that they were going to take him out and they wanted to make sure they had access to Bezos' phone to compromise him, to influence what the Washington Post might write, because they had been critical of the kingdom for a long time.
Yeah, and all this playing out while Jeff Bezos knew what was on that phone, and some of those images leaked out as well. I imagine would have been a stressful couple of days. But Morgan Wright, thank you so much for joining us. Appreciate you sharing your opinions there. Sabeel Marcellus and Ian Wishengrad, thanks to you guys as always. Appreciate you joining me here on The Couch. Coming up, Netflix slumps after reporting quarterly earnings. An expert will weigh in and explain why he thinks the negative impact of rival offerings is exaggerated. The Ticker, digging into that, starts in 2.
afternoon and welcome to The Ticker on Yahoo Finance. I'm Seana Smith checking in on the markets, and we are seeing green across the screen. The Dow is up 57 points. The biggest gainers in the Dow today, IBM, Nasdaq up over 3%. We're going to talk a little bit more about why that is in just a few minutes. We're also seeing some gains from Intel, American Express, and Goldman Sachs, and Cisco. Those 5 stocks are the top performers in the Dow. The S&P and the Nasdaq are also moving to the upside. Let's start with our big 4 tickers. We have Netflix falling into the red after a mixed picture on subscribers in its latest quarterly results. We also have Tesla blowing through a $100 billion market cap for the first time in its history. And Boeing's new CEO is making headlines with fresh comments on the 737 MAX jet crisis. And there are reports about a new type of iPhone in the works. Well, first, let's get it started with Netflix. The shares today are under pressure, and taking a look at the stock, they are falling into the red as investors digest the streaming giant's fourth quarter earnings results. Now, light guidance for its current quarter and a domestic subscriber miss has the street's attention. Joining us now is Santosh Rao, head of research at Manhattan Venture Partners. And Santosh, when you take a look at the numbers, it wasn't weak at all, really, when you take a look at earnings and revenue, but it was that guidance and the domestic subscriber miss that has the street's attention. What do you make of these numbers?
Yeah, I think on balance, the numbers were pretty good, like you said. Pretty much in line. If you look at the guidance for the first half as opposed to the first quarter, there's some seasonality in it. It was pretty much in line. So I think that was not a miss. But overall number for 2020, they expect cash flow losses to decrease. So the fundamentals are good because that's a big concern with Netflix. Are they going to need more cash? How are they going to fund all their new shows? So I think that fear is getting less and less. So overall, I would say there was enough for the bears and the bulls in this, and that's why you see the stock going down. And it was kind of in a holding pattern for a while. It's fallen down, but there's enough for bears and the bulls to hang their hat on.
Santosh, what do you make of the comments that Netflix made about the competition? So that was obviously something that the street was watching very closely. And when it came to competition, at least outside the U.S., they were saying that they didn't really feel any material impact, at least yet, from some of its rivals. Do you think that will continue to be the case for the rest of the year?
I absolutely believe so. I think if this quarter's results are any indication of the competitive landscape out there, I think it was a pretty good quarter for them. It was very muted, the competition was. We thought the subscriber growth would fall off quite a bit after Disney and all the others came on. So I think overall, I think that's good. International is their strength right now. They are the incumbent leader. They're a huge lead on others. So we'll see. It'll take a while for others to catch up on. So it's very popular outside. The ARPUs are up. Everything is up. So I expect a good international growth and overall growth in general.
When we take a look at the pricing that Netflix has been dealing with, one of the things that was cited in this earnings release that recent price changes were one of the reasons for low membership growth in the U.S. and Canada. When you take a look at Netflix prices compared to some of the other rivals that are out there, does Netflix still have the same pricing power that it did maybe a year ago?
It still does, and that's the beauty of this thing. I think the bulls can hang their hat on that. The pricing power is still there, and they can point to their Oscar nominations, the quality of the shows that they're producing, and all that stuff. So I think overall the experience of Netflix is still there, so the pricing power is still there. So I think we'll have to wait and see how it plays out. The competitors are coming in, but they have their own nuances, their own twists and turns in terms of how they're going to price it and how they're going to go. The content is still weak on all of them, so I think Netflix is ahead on that. It's their lead to lose in this race for the superiority.
Santosh, when we talk about what differentiates Netflix from some of the other rivals out there, one of the things is that Netflix is sticking to its current subscriber path, I guess, right now. And they're saying that they're not going to incorporate any sort of advertising into Netflix's streaming. When you take a look at that, do you think that that is a smart move, or should that be something that maybe CEO Reed Hastings considers down the road?
I think that's a very smart move. I think advertising is a whole different ballgame. I think that you're competing with the majors, the Amazons and the Facebooks and Googles and all that. So I think to stick to this subscriber model is the right way to go at this point. Down the road, I don't know. But at this point, I think he's right in sticking to his DNA, which is really subscriber growth and really growing the business in that space.
All right, Santosh, thanks so much for joining me today.
Thank you.
Well, let's take a look at Tesla because shares are moving to the upside, pushing the company's market cap above $100 billion for the first time. You can see the stock up another 6% or almost 6% so far today. Now, that $100 billion market cap is the highest valued U.S. automaker of all time, surpassing the market cap of not only Ford and GM combined, but really doubled that of GM. Heidi Chung is with me. And Heidi, this is quite a milestone for Tesla.
Hey, Seana, yeah, this company has been on such a tear, and I just want to really hone in on that right now because the stock is up a whopping 130% over the past 3 months, adding $60 billion in market cap. Now, $60 billion in market cap, Seana, that's larger than the market cap of Target, it's larger than the market cap of AMD, and it's larger than Lululemon and United Airlines combined. So that just gives you some context as to how much and how big this really is. Now, Toyota's market cap is $232 billion. So Tesla is sitting up there right at number 2. And Tesla stock actually hit an intraday high today of $594.50, just inches away from that $600 per share milestone as well. And a lot has really happened since Tesla since Tesla reported that surprise profit back in October. A lot of things have happened. They've exceeded their production and delivery estimates. They also opened that Shanghai Gigafactory, and most recently, it got a pretty big win over in Michigan. Now, Tesla has been in a years-long battle with Michigan in order to sort of sell their cars there and open up facilities. Well, that has certainly come to fruition now. The state is allowing Tesla to open these repair facilities as well as sell cars in the state. So certainly good news for Tesla, and that actually sent shares up higher today. Now, Wall Street has really been playing catch up, though, because 8 analysts just this year boosted their price targets by more than $100 per share. Now, the average price target on the street right now, though, is $363.96 per share. So it's well below where Tesla is trading right now, which is about $580 per share. And I have to mention this as well. We can't talk about Tesla without talking about those short sellers. And Tesla short sellers have been getting burned. According to S3 Partners, Tesla shorts lost a whopping $2.3 billion in 2019 and has already lost about that same amount this year. And this year has only started less than a month ago here. Now, Tesla does report earnings on January 29th after the closing bell. So certainly a lot of eyes will be on that report.
Yeah, Heidi, we also can't mention Tesla without talking about Elon Musk, because we have to mention the fact that the stock has outperformed so well, the fact that the market cap is now over $100 billion. Could be a huge payday not too far in the future for Elon Musk.
Absolutely. This is not just about bragging rights for Elon Musk. Now, we have to remember, Elon Musk does not receive a salary at Tesla right now, but he does get rewarded when the company hits these big milestones and benchmarks. Now, if Tesla's market cap stays above $100 billion for a sustained period, he's eligible to get the first tranche of an all-or-nothing pay award. Now, that first tranche would be about $346 million in stock, where the stock is trading at today.
All right, Heidi Chung, thank you. We are also watching Boeing. Now, the company's CEO spoke on a conference call with reporters saying that the 737 MAX's return is delayed due to pilot simulator training, and the airplane maker will keep paying its dividend. Jared Blickery is joining me from the Wi-Fi Interactive board. And Jared, when we take a look at Boeing stock, you would think that maybe it would trend a little bit higher on this, but it's still under pressure, off just around 1.5%.
Yes, it is. And amazingly, this is the first CEO conference call about the MAX 37, the 737 MAX since the beginning of the crisis. But here we go. So the stock was trending down throughout the day. We're talking about once it had breached 320, which it did yesterday, we have this huge air pocket all the way down to 150, 160. That would be a tremendous loss in terms of share price. It got down almost to 300, but then CEO jumped on the call, and we can see that the stock rallied throughout that conference call. And I took some notes during it, some headlines. I just tweeted a summary of it out. And here are some of the things that he had to say. He said there's no shareholder value without safety first. And then he talked about the timetable change. They said that it's going to be back in the air by midsummer. And he said that's due to pilot training. And they're saying this is now a conservative estimate. The previous estimates that were December, January, February kept getting pushed back. Those were not conservative at all. And he said Boeing had been its own own worst enemy because of how it released information. And he said employee confidence in the company is shaken. But then he said the company is all in on the MAX. And he says he thinks the FAA is too. And as you said, there's no discussion by the board of cutting the dividend. That should help the stock price as well. And then about the rebranding, which had been discussed by President Trump and others at length, he said that would be just sort of silly. Also, he plans to work well past the age of 65.
Hey, Jared, I want to talk about another Dow component here that is on the move. And this side to the upside, we have IBM. Now shares are moving, really trending higher for the entire day, with the stock up just over, 3% right now. Now, the company beat the street's earnings expectations on the top and bottom lines. IBM's revenue grew in the quarter, following 5 straight quarters of declines. And Jared, when you take a look at this earnings report, do you think that $33 billion acquisition of Red Hat is finally helping IBM turn some things around?
I definitely think so. They needed a diversified product mix. Red Hat, their growth is accelerating now to 24%, which is leading to cloud revenue increases of about the same amount. We can see the stock is up nicely today, up about 3%. It was up about the same amount yesterday. If we take a look at the one-year chart, we had this consolidation pattern going back to about July of last year. And we can see that a couple days ago it broke north, and it's just continuing here. So it should be able to retest that 145, 150 level. That's where it has this resistance, and maybe power through it. On an extended basis, on a measured move basis, should be able to get to probably close to 180, 190 based on this breakout.
All right, Jared Blickery, thank you. Moving on to Apple, they may roll out a cheaper iPhone. Now, Bloomberg is reporting that the tech giant will start assembling a low-cost iPhone next month, and it could reportedly be released as early as March. We have Dan Halley with me. And Dan, the big question is, what are the details, and do you think this could actually work out for Apple? Is it smart?
Yeah, there's been this trend that's kind of going on where you saw these peak prices for smartphones where $1,000 for the iPhone, I believe 10 it was, and then it kept kind of rising. But now you're seeing kind of a backtracking of that. Not that we're going to see those prices for those high-end phones dip, but we're seeing more pricing infiltrating the mid-range area. So you're seeing that with Samsung launching a mid-range version of its Note 10 and its S10 recently at CES. You're also seeing that with Apple itself with the iPhone 11 starting at $699. This looks to be more of a budget phone than anything else, not necessarily the $699 for the 11, perhaps maybe as low as $499, maybe around $399. It's going to be a device that has a 4.7-inch display. It will have the home button, so you'll have Touch ID, no Face ID on this, but it's still going to have the same processor as the current iPhones, so it'll be just as powerful. It looks like this is really the device to get more people into Apple's ecosystem, less on the margin side, more on the, hey, once you have the device, once you're with us, you're going to stick with us. Maybe you'll get an Apple Card, maybe you'll get Apple TV Plus, maybe you'll get Apple Music, and that's really what they want to do. They don't so much want to get as much margin out of this as expand the number of users who will start getting into Apple services, and obviously that's been a big point for them. And don't forget, once you have an iPhone, you can get those AirPods.
That is true. And yeah, we speak to the power really of Apple's ecosystem all the time, just in terms of what type of advantage that gives them over some of the other tech giants out there. But Dan, do you think that this is something that's necessary in order for Apple to gain some market share outside of the U.S., specifically in emerging markets, where there are many national companies that talk about China, for example, with Huawei, which has their phones, which are much, much cheaper than what the iPhone is selling for.
Yeah, I mean, that's a really good point. If you if you look at China, what they're able to do with those devices is they're able to have them with kind of the best specs around at lower prices. And that's, that might just be specific to China as far as the markets go. But what's interesting is a product like this perhaps going to India. Now, they do sell lower cost iPhones in India. They have repurposed versions. And there's also the issue of, well, if you want to sell in India, you have to construct it in India. But they are doing that currently. If they can get this phone, whatever they end up calling it, and be able to build it out of India and have it at a lower cost, that would be huge for Apple in an emerging market like that. Now, the economy obviously is kind of not the best right now in India for the emerging middle class that's there. But I think if Apple can get in at the right price point, for a lot of people, their smartphones are their only form of compute. So this would be important for them.
All right, and Dan, I also want to get your thoughts on, so Amazon Music was out with some numbers today, and they were saying that they have 55 million subscribers globally. And when you take a look at how that stacks up against some of the other music offerings that are out there, they're closing in on Apple, but they're still far away from Spotify. Do you think they have a chance really on, I guess, one, surpassing Apple, and then two, closing that gap with Spotify, which is the leader in the space?
Yeah, I mean, you have Amazon Music when you have Prime. You have access to all of these different services. So, really, you could say there's that many, users are using it for free, or, I'm not sure how they're breaking this down exactly, but with Amazon Music, it feels like it's the forgotten child of the company, right? You talk about Amazon Prime, you talk about Prime Movies. That's because it's so much easier to access through something like a Fire TV, and I think that's why that is a more successful service. As far as this compares to Apple Music and Spotify, look, when you buy a new iPhone, you get Apple Music right there, and you can sign up immediately, you get the 3 months for free, and then oops, you forget, and you're still signed up, and oh my goodness, there's a $9.99 charge. What is that? Oh, Apple Music, I guess I'll just keep it. And that's kind of how the services like that perpetuate. It happened to me as well. Spotify, I think, is going to continue to be the leader, but really, if Apple can continue to build on what the momentum it has with Apple Music, it would be really, really impressive to see. I don't know how much more Amazon can build out with music. They've offered different tiers. They've talked about, using different types of compression technology to ensure that you have a better sound quality. But it's not going to be Spotify anytime soon.
All right, Dan Halley, thank you. Well, coming up on the ticker, President Trump claiming that U.S. GDP will be near 4% if the Fed would change course on interest rates. A top expert weighs in next. Welcome back to the ticker. President Trump is not backing off the Fed, renewing his attacks on the central bank in Davos.
The Fed was not good, as far as I'm concerned, and that was a big blip that should not have taken place. It should not have happened. Had we not done the big raise on interest, I think we would have been close to 4, and I could see 5,000 to 10,000 points more on the Dow. But that was a killer when they raised the rate. It was just a big mistake, and they admit to it.
All right, well, this comes as the markets continue to trade in record territory despite concerns of a global economic slowdown. Joining us now is Brian Jacobson, a multi-asset strategist at Wells Fargo Asset Management. And Brian, when you take a look at what the president just said, he was saying that we could have seen GDP growth rate of close to 4%, the Dow continuing to rally even further. What do you make of his arguments, and do you think there's any truth to that?
Yeah, well, thanks for having me. And when my team, we were kind of looking at things, if you rewind back to around December 2018, when the Fed did their last rate hike. At that point, they were talking about hiking further, and the market wasn't really seeing the same thing that the Fed was at that point. You know, we were seeing that the economic data was slowing, inflation really wasn't rising all that much, and so on my team, our view was that they weren't really all that well justified in hiking, so maybe they took it one hike too many. And they did backtrack fairly quickly. You know, we did just experience they called it a recalibration of monetary policy, cutting about 3 points. Or about 0.75 percentage points. And, you know, we think that the market could have done a little bit better if the Fed hadn't hiked one too many. Maybe the economy could have grown a little bit more, but we're saying little, not necessarily 4% GDP growth, especially at a sustained level. I don't think that the economy really has that capacity to run at that level on a sustained basis going forward.
Brian, what do you think the Fed's likely next move will be?
That's what I think what a lot of people are wondering. They have shown that they are willing to change their tune pretty quickly, just like they did December 2018. Suddenly the market sells off, the economy slows down, and they pivoted rather abruptly to cutting rates. And how quickly are they willing to pivot again if we do see a little bit more economic strength? Thankfully, it seems like Chair Powell has gotten the message from the markets to not be so reactive to the data, that if we do see an increase in GDP, and we on my team, we do believe that we're going to see an acceleration in growth, capital spending should pick up, at least temporarily, that we really need to see that on a sustained basis. So we think that there's actually a fairly high bar for the Fed to change their tune again. We think that they want to put things at neutral and try not to upset the apple cart too much here.
What do you think about just where the markets are trading today? We're within record territory. There's lots of talk about whether or not U.S. equities are too expensive at this point. But when we drill down and take a look as to how we got here and whether or not that's justified, do you think the fundamentals in the market and in the economy are still strong?
We do, and actually our team is positioned to take advantage of what we expect will happen of an increase in the S&P 500. Our just kind of ballpark figure with my friends over at the Wells Fargo Investment Institute, we think that we could see further gains from here, probably let's say around 3,500 on the S&P 500 by year end is our target. Now, do we get that sooner or do we get that later? Because the key thing here is that corporate profits have been fairly strong. Despite sluggish growth for the overall economy, you've actually seen S&P 500 corporate profits be pretty strong, pretty resilient. We did have a year-on-year decline for 2019, but the expectation is that we're going to see that reaccelerate again. So even though on a year-on-year basis, as far as for earnings, valuations might look a little high, when you take that longer-term view and say that corporate profit margins are still pretty resilient, companies are still pretty adaptable to the changing policy terrain, that we could see risk assets, that is like equities and high-yield bonds, continue to rally.
Brian, we got the jobs data out a few weeks ago, and one of the things that some economists and some analysts were talking about on the street was just in terms of the fact that we're seeing this slowing trajectory in terms of the jobs that were added. So 145,000 jobs were added to the U.S. economy. Does this concern you at all?
Not particularly. Actually, what would concern us is if we saw another reacceleration about how sustainable is that, because that would catch the Fed's attention, and then they might be likely to change their tune or actually change course. And so when it comes to growth in the labor force in the U.S. economy, if you kind of do some calculations, really sustainably, that jobs number, we'd be looking at something closer to maybe 80 to 90,000 as being the the sustainable run rate for job creation. So anything above that is saying that we're having pretty decent growth. So yes, it was a deceleration from the previous month and actually relative to the previous 12-month average. It's still a pretty healthy clip.
When we take a look at, one of the headlines that were out today was the big win for UK Prime Minister Boris Johnson. He was able to get his Brexit deal passed by UK Parliament. And we talk about time and time again just some of the global risk that is out there. When something like this happens, do you think that helps take at least some of the global uncertainty off the table?
We do, and my team, half of my team is in London, the other half is in San Francisco, and so we get to talk about this stuff all the time. And as far as, it wasn't really that big of a surprise that it passed the Parliament. So as of January 31st, they're going to be leaving the European Union. Now the tricky part is they need to now negotiate what sort of trade deal do they want. Boris Johnson has set a rather aggressive timeline to negotiate a trade deal, especially if it's going to be comprehensive to cover not just goods, but also services. Services tend to be the stickiest point when it comes to negotiating these trade deals. And if he wants that wrapped up by December 31st, that's a very aggressive timetable. But it does remove some of the uncertainty. And I think that it helps focus investor attention on some of the details as to what steps are necessary now to make Brexit a reality and not necessarily turn it into a nightmare for the United Kingdom. Because from our team's perspective, the UK and the EU, they're no longer they're not equal parties in this negotiation so much anymore. Now that they need to negotiate the trade deal, it is a matter of what sort of concessions are each side going to make in order to make this work, because by all appearances, the UK wants a Canada-style trade deal with the EU, and we're not 100% convinced that the EU is going to be offering that to them.
All right, Brian Jacobson of Wells Fargo Asset Management, thanks for joining me today.
Thank you.
Well, coming up, existing home sales are leaping close to a 2-year high. The president of One Sotheby's International Realty joins us on what it means for the sector's 2020 outlook next. Welcome back to the ticker, checking in on the markets. We are still seeing green across the screen. The Dow up 42 points. Ines Ferre is standing by on the floor of the New York Stock Exchange. Ines?
And Shauna, we're watching United. This is after United beat on earnings. They did hold their conference call this morning with executives highlighting that they met their 2020 adjusted EPS goal 1 year ahead of time. Now, this is despite headwinds last year, but analysts had peppered the conference call with a lot of questions about the grounded Boeing 737 MAX jet, and executives said had we had the MAX, it definitely would have benefited our revenue, also our CASM, our cost per available seat mile. And given the announcement that Boeing made yesterday that it's expecting the ungrounding to begin in mid-2020, the company says it plans to push out its timeline, its schedule, and it does not anticipate flying the MAX this summer. Shauna?
All right, Inez. Thank you. Well, existing home sales finished 2019 on a strong note. Sales of previously owned U.S. homes increased 3.6% in the month of December. This is according to the National Association of Realtors. Joining us now is Daniel De La Vega. He's president of One Sotheby International Realty. And when you take a look at what's going on in the housing market, we did have those rather strong sales numbers out today. What do you make of where we stand and what's your outlook for 2020?
So thank you again for having me, Seana. Overall, the macroeconomic trends are positive. Unemployment is at 3.5%. That's down 50 basis points year over year. New trade deals are being inked. The outlook overall is good. The stock market's at an all-time high. You saw United just reported their earnings a little bit early. And that trickle-down effect is really affecting the real estate market across the country very positively. So not only are existing home sales up 3.6% month over month, but they're up 10.8% year over year. That's 94 straight months of growth. So it's been very, very positive, and I think that that's going to continue on into 2020.
Dana, would you say now is a buyer's market, or is it still a seller's market at this point?
So it really depends which market you're in. I think some of the more major markets like New York City, Miami, LA, they've become more of a buyer's market, and that's simply because prices have just skyrocketed. So sellers' expectations are a little bit off. As you go into other markets throughout the country, it is a seller's market. We're dealing with an affordability issue because a lot of the inventory online has been absorbed. I think you're going to see some of the home builder stock prices rise, Lennar, KB, because the demand is there. The demand is extremely high, and one of the main factors of this is interest rates. Interest rates being low is definitely playing a key role.
Daniel, what about luxury homes? Because I know at One Sotheby's, you guys are a lot of times focused on the higher end real estate. Are we seeing demand for those types of houses? Because there was a trend there that some of the higher end houses were not being able to be sold.
So there's a tremendous demand, but buyers have access to so much more information now. So they're so much more well-versed on home prices. So as they look and they see some of these homes that are just priced too high, it's really creating a little bit of an excess inventory situation in some of these major markets. But when homes are priced right in whatever market you're in, and that's 20% off of peak 2016, they sell within 5% of the asking price. So the demand is still there. And in markets like South Florida, the demand is extremely high because of high tax states like New York, like New Jersey, like Connecticut and Illinois. So we are seeing a tremendous demand. I just was with a gentleman from New York City yesterday all day in Palm Beach. He's looking to spend $15 million, move his offices here, his entire headquarters. So we're seeing a lot of that.
How does the trade deal, or does the trade deal at all play into this, just in terms of the U.S. and China were at odds for so long? So we did get this trade one phase deal, but we still have ways to go in terms of resolving the U.S. and China relations. Have you seen foreign buyers maybe take a step back at least, or be a little bit more hesitant than they were, say, 2 years ago?
Well, foreign buyers have definitely slowed down, especially here in South Florida. We see a lot of foreign buyers. But that's not so much of a function of what's happening here in our economy. I think it's more of a function of what's happening in their economy. I've seen some significant investments here from foreign corporations into the United States. I think they're seeing the economy very positively, and they are investing here, and they're continuing to invest. And this trade deal is just simply a reflection of consumer confidence. I think that a lot of people were on the sidelines. That's why the November numbers were down. And as consumer confidence started to pick up in December, you saw the numbers go up. And it was a direct reflection of what's happening within our economy, consumer confidence. And of course, now that this China deal has been inked, I think that that's going to only really make the numbers stronger this first quarter of 2020.
All right, Daniel De La Vega, thank you so much for joining me today.
Thank you for having me.
Well, coming up, the CEO of private social network Nextdoor joins us exclusively on its plans to shake up the social media industry in 2020. Don't go away. Welcome back to The Ticker. We're checking in on the closing price of oil today. Crude is off almost 3%. Now that's slumping on a bearish IEA surplus forecast. This comes as a new report from Goldman Sachs predicts that oil markets could take a hit from China's deadly virus, with jet fuel feeling the brunt of it due to a slowdown in air travel. Millions from China are gearing up to travel domestically and internationally for the Lunar New Year holidays. And again, crude off just around 3%. Well, amid a crowded social media landscape, San Francisco-based company Nextdoor brings a private and localized social networking service to neighborhoods. Joining us now exclusively on Yahoo Finance is Sarah Fryer. She's the CEO of Nextdoor. We're also joined by Yahoo Finance's Melody Hyman. Sarah, thank you so much for joining us here today. When we take a look at, so you have been CEO of Nextdoor for just over a year now.
Yeah.
And in your first year, you hit quite a number of milestones with Nextdoor. You were able to raise a significant amount of funding. The company is now valued at just over $2 billion. You've also inked some strategic partnerships in terms of growing the brand, growing the business. When you take a look at what you've accomplished in the past year and what you hope to accomplish going forward, how do you see that shaking out?
Sure, well, thank you. It's been quite the year. So first, we are seeing tremendous business momentum, which we're really excited by. As you pointed out, last year was about making sure we had the fuel to keep fueling growth. So we raised $170 million, $2.2 billion post-valuation. We've been building out the team, so we've really added at the executive level, but all the way through the company. We've almost more than doubled in size. And from a business perspective, I think we're really starting to hit our groove, both with large national advertisers, but also local businesses, which is often where my heart and soul is. How do we help those local businesses thrive? We want Nextdoor to be that neighborhood hub.
Sarah, great to chat with you. Always a pleasure. I know you're out with a note to neighbors this morning, and it really delineates kind of a lot of the progress that you've made this year, but also how important and empowering local communities are. As I understand it, you've recently partnered with Professor Kelly Harding, and she's, of course, the author of The Rabbit Effect, and it shows just how impactful and materially significant having communities and in-person neighborhoods really are for mental health and well-being. Tell us about this new feature that you're going to be unveiling on the Nextdoor platform.
Thank you so much for the question. Yes, so we do have a note to neighbors out this morning. One of the things I learned at the start was I wanted to introduce myself a year ago, so I wrote a note to neighbors. 6 months later, we wanted to go back out, and I had just been to visit 10 of our 11 countries, so last year was a whirlwind of travel. And the common ground I found throughout was how much people were looking for just human-to-human, in real-life connectivity. And that started us really going down this path of understanding what we could do to make communities and local businesses and all of the folks in our community healthier. We have partnered with Kelly Harding, Dr. Kelly Harding. The Rabbit Effect, highly recommend if you need a book to read. And I think one of her key findings, and she's done a bunch of research around this, is just how much social connectivity changes your well-being. In fact, you're 50% more likely just to survive if you have real-life human-to-human interactions in your daily life. And yet, so many of us don't have that. Technology is probably somewhat to blame for that. We see a falling away of a lot of institutions like the church, the Girl Scouts, the Boy Scouts, the Elk Clubs, like all of these things that used to bring people together. And yet we want to still embrace this power of proximity. You're meeting people you don't already know on Nextdoor, you're meeting your neighbors, but we think you can do great things when you bring those neighbors together.
But Sarah, just picking up on that, you know, the kindness feature, it almost is a reactive sort of measure in my mind, because maybe there is some vitriol on the platform. There's perhaps a negative comment that someone is about to post, and Nextdoor is kind of giving you this pop-up option of, are you sure you want to post this? Do you want to change the tone? And even in your note to neighbors this morning, I want to read a quote from you. You write, while we have a lot to celebrate from this past year, we recognize that there is still much to overcome in our communities. Social isolation, the rise of incivility, and increased polarization. So talk to us more about, as we head into November 2020, how Nextdoor is really mitigating a lot of that bad behavior and negative activity that we are seeing proliferate many other tech platforms.
Yeah, so absolutely. I mean, these are global macro themes. They're true here in the US, particularly as we think about an election coming up where people tend to move towards their tribes and further away from each other. But it's also happening globally. Remember what we've just seen in the UK, for example, with Brexit. So we've done a couple of things to try to mitigate that. One, our whole platform is about trying to bring people together again. When we see that incivility may be on the rise, to your point about the kindness reminder, we do often work with academics. In this case, we actually worked with Professor Eberhardt at Stanford, who wrote a great book called Biased, which is all about how do we slow people down. So when you're in that moment where you're about to make a post, maybe with some anger behind it or just a rush to respond, which social media often wants you to do, we actually slow you down. So we have that little pop-up that says, remember, great communities are created with kindness. And what we found is an actually tremendous number of posts, about 75% people go back and rewrite them to be more gentle, to be more neighborly. They don't not post. We don't want to stop people having their point of view. In fact, we think debate is important, but we want people to be able to do it in a safe environment. One other thing we have seen is that at a local level, when people feel a little impotent, frankly, at the national level, when it comes to things like politics, they can actually get things done locally. So it might be, I was just in Australia, they wanted to change bus routes. Their buses had gotten stopped, they couldn't get to work. We see folks changing things like zoning laws by getting together on Nextdoor, maybe in a group where they can take it off from the main feed, but it's a great way for us to actually let civic engagement happen, but happen in a way where the debate stays a little bit more kind and a little bit more all about community building.
And Sarah, speaking of politics, as I understand it, Nextdoor has never allowed political advertising on the platform. We have heard the likes of Mark Zuckerberg kind of come out and double down on his stance, saying that it is freedom of speech. What are your thoughts there?
Yeah, so ultimately with Nextdoor, we actually don't allow national politics discussion at all because we find that so quickly can kind of go off the reservation where people aren't being kind. We try to really embrace local politics, as I talked about. In the case of ads, we just feel in the end we don't want to be policing what's real, what's perhaps disinformation or misinformation. We actually, in terms of ads on the platform, which is how we monetize, we really try to make sure those ads have high utility and are really endemic to what's local. So think about brands like a Home Depot, for example, or think about a local grocery chain that's trying to pull people from online into their store. That's actually more where we'd rather go with the platform rather than getting caught up in some sort of maelstrom around political ads, what's real and what's fake.
Yeah, Sarah, prior to serving as CEO of Nextdoor, you were CFO of Square, and you've really been a part, and especially among female leaders, really representing Silicon Valley. As I understand it, Secretary of State Mike Pompeo was actually in Silicon Valley meeting with leaders like yourself. Can you share what came out of that dinner?
No, but I think it's important for us to be there and have that seat at the table. I think it's incredibly important for there to be diverse perspectives. And one of the things, for sure, in technology, I was in the finance industry before, actually was an engineer way back in the day. The lack of female diversity at the table is something that I've experienced a lot throughout my career and something I really want to help fight against today. There's no way we can all build products that speak to broad communities unless they're being built by people who represent those broad communities. So it was definitely great to be at that table having the types of discussions, but unfortunately, topics cannot be shared. I can tell you in Nextdoor's case, we're all about how to make kindness cool again, and in making kindness cool again, bringing communities back together, and there is not a person on the planet that doesn't want that to happen.
All right, Sarah Friar, CEO of Nextdoor, and our very own Melody Ham, thank you both for joining us today.
Thank you.
Well, coming up, the CEO of the Salesforce Foundation sits down with Yahoo Finance in Davos about the future of sustainable development. You won't want to miss it. Welcome back. Business leaders from around the world are meeting in Davos, Switzerland for this year's World Economic Forum. Yahoo Finance's Alexis Christoforous sat down with the CEO of the Salesforce Foundation to break down everything from sustainability to youth impact.
You committed $17 million and 1 million volunteers last year, I believe, to the Sustainable Development Goals.
Yes.
Give us an update on that. How are things going? What's progress looking like?
Well, I think progress has been outstanding in the sense that, first of all, if I mentioned the Sustainable Development Goals, even within my company 5 years ago, they would wonder what it was.
Right.
Now what you see is every company and every employee within every company is starting to talk about it on a global level all over. And we've seen that manifest itself in Salesforce. And so we track and measure our impact against the Sustainable Development. I shouldn't say against, that sounds like we're competing, but as we approach the Sustainable Development Goals. So we're actually tracking our employee volunteerism. Our employees give about 1.2 million hours out we're forecasting this next year back into the communities in which we live and work. And we're saying, okay, what is our contribution to each one of those Sustainable Development Goals? We're tracking our grants in mapping those back to the Sustainable Development Goals, as well as what we actually provide to nonprofits or education institutions. What Sustainable Development Goals are we helping out there with our products and services? So it's really changed the way we measure impact. And what's great about it is that instead of companies or nonprofits measuring their own set of goals, what really aligns is that I'm getting tongue twisted. The Sustainable Development Goals is a common measurement framework that we all can work from.
Mm-hmm. You have a very robust grant program. You mentioned the grants. You give hundreds of millions of dollars. You gift it to charities and different foundations. There's a lot of competition for these grants. Tell us what it is you're looking for in a grantee partner.
I think the main thing that we do is we've really been looking at places where we live and work and where we can focus on, it's difficult, the grant budget, if you were trying to solve, we focus on education and workforce development. And if we were trying to solve everything in education and workforce development, we would get spread very thin. So the first thing that we look for is in communities in which we live and work, because we also have an employee engagement program where we circle the schools in our local communities. So the first criteria would be, it would be areas in which we can actually influence with the full weight of our programs. It goes far beyond just the grant-making capacity. It's like, how can we engage? That's what Davos Codes is all about. How can we engage in the local communities? So that's the first thing, and then we have some very strict kind of impact measurements, and we see if we want to make sure that these organizations are they established, are they trusted, and what are their tentacles in the community, and what kind of impact they can have, and what are their targets, and how they align. So we have a very rigorous and robust grants team that evaluates.
You mentioned Davos Codes. I love what you're doing here. You've got 50 local school children, age 14 to 15, working with using their computer skills and technology to have an impact on the world. I know last year they tested water pollution and actually got the local government here to change their laws, and now they're recycling plastic. I mean, that's a pretty amazing thing. What are the kids working on this year?
So what's fun about this year, there's really a couple of things going on this year, but one of the things I will mention is this is an example of a multi-sector partnership. We have the government involved, the local government here, the media is broadcasting this all over Switzerland, and then the other thing is we're working with the schools. Then you have a partnership with us in the business community. So that's SDG 17, and we're focused on, I think there's 6 SDGs that have been covered here at Davos Codes, and what they're focused on really is youth are activated right now, and you've seen it like Greta Thunberg being the ultimate spokesperson for it, and they're frustrated. And they want to be able to, how do I take that frustration and make myself a citizen scientist? So what we did was we created a model and a playbook that we worked with the students, with the school, and behind me there's devices here. This is actually an environmental reading device that you can put in any classroom, and they planted these all over Davos, the town of Davos. And this will measure things like air quality and temperature, and then they will feed that into a database, as well as over here they've got cameras to track wildlife. So now they can become citizen scientists, and they planted these all over the town of Davos. I don't know if we have a map.
They must have had a great time doing that. And then all the data they collect gets given to larger organizations that are trying to make a difference, like the United Nations, for instance.
Yes. So going back to an earlier question you had was why one of the things that we're trying to expose is how multi-sector partnerships work. So as people come in and out of the door of Davos Codes yesterday, what you would see is that this is a model that can be replicated in any classroom. And Davos is part of our community. We actually work here throughout the year. And so what happens is that when we've had a number of people come in and say, can we replicate this in our classroom? The answer is yes. And ultimately, the vision is that all this data feeds into a set of activated citizen scientists from multiple countries, and we're giving the youth a chance to express and actually activate their passion for environmental concerns.
I just love it. Great work you're doing. Rob Acker with Salesforce.org. Thanks so much for your time.
Hey, thank you very much, Alexis. Thank you.
Stay tuned for more live coverage at the World Economic Forum in Davos right here on Yahoo Finance all week long. Well, straight ahead, the plot thickens around allegations that the Saudi government hacked Jeff Bezos' personal phone. We've got those details next. Welcome back. It's time for our last tick of the day, and it is FedEx. Now, the company announcing it is delivering ground residential packages on Sundays all year long. This comes as FedEx is looking to expand its focus on e-commerce. We have Jared Blickery, Dan Howley, and Heidi Chung all back with us to weigh in. And Jared, when you take a look at why FedEx is doing this, is it the obvious reason to keep up with some of its rivals out there?
Well, yeah. If you remember, during the Christmas holiday season of last year, FedEx Ground was kicked off the Amazon third-party go-to list. So I think this will help them. They've already gotten back on that list, but they had increased their sales or deliveries by something like 40%. So they are being competitive, but the ground unit is kind of a perennial sticking point in their earnings report. They really need to get on better track with it, and this is probably going to help them do that.
Dan, do you think this will be enough?
I mean, it could be. Obviously, getting the extra day out there would be incredibly helpful. And I mean, for a lot of people who want to get deliveries on Sundays, like me, this would be especially helpful. But yeah, I mean, this is just another day. It's not, another 2 days or something like that. So it should help, but I don't know how much.
All right, guys, let's go beyond the ticker. Saudi Arabia is denying that it breached the cell phone of Jeff Bezos. According to The Guardian, the Amazon CEO's phone was reportedly infiltrated in 2018 from a message on WhatsApp that appeared to come from the number of the Saudi crown prince. Now, the FBI is now investigating this. This is according to a report from the Wall Street Journal. Heidi, let me go to you. More than 6 gigabytes of data was reportedly stolen. What do you make of this, and what do you think this means in terms of the broader picture here?
Well, these investigations are certainly still ongoing, so I don't have all of the information here, but it certainly does look like some suspicious activity definitely took place. And I think this speaks to the broader issue of other entities out there looking to cyber attack the U.S. or, CEOs like Jeff Bezos, other leaders that have influence here, as well as we've seen these kinds of things play out with the election as well. So I think the next issue and the next frontier when it comes to warfare might just be cyber warfare.
Jared, this also casts a shadow over the future king of Saudi Arabia.
Well, there's been so many damning things that have come out against him over the years, and he's managed to just brush them all off. I think it's because the incredible amount of money that he invests in U.S. and world global tech ventures, and he meets with these leaders quite often. The biggest takeaway from me is, what's up with WhatsApp? I use that app, and now I'm concerned about its security here. Hopefully they fix that breach.
And we haven't heard anything from Facebook yet. Dan Halley, Jared briefly mentioned that, but he did also meet with some other big names in the tech space when he was here during his meeting with Jeff Bezos. Is there any thought that maybe some of those leaders could also be at risk?
I'm sure they're actively having their phones investigated, their accounts looked at, to see if they were victims of the same kind of attack here. The WhatsApp attack is something that's happened before. It's through a tool that's used by an Israeli security agency. They say that they haven't been a part of this or weren't a part of this, and they would be appalled if their tool was. But this is something that can happen with WhatsApp. The reason why a lot of people use that service, by the way, is because it's encrypted end-to-end, so it's secure. This is an anomaly, obviously, but if I'm any other tech executive who met with the Saudis, I would definitely have my devices looked at. It also probably would make sense for President Trump to have his investigated, since he has that iPhone that isn't exactly secured.
Yeah, and also it's important to point out that Jeff Bezos owns the Washington Post, and of course this could be in focus because of their coverage of the Jamal Khashoggi murder here just not too long ago. All right, well, Dan Halley, Jared Blickery, and Heidi Chung, thanks so much for joining the show today. We'll keep it right here on Yahoo Finance. The final round will take you through the last hour of trading.
I'm Jen Rogers in New York, and this is the final round. Stocks back to record highs as tech yet again leads the way.
I'm Myles, Udland, IBM, Apple pacing the Dow higher. We'll have more on all of that in the market action coming up in just a bit.
Plus, Netflix shares are on the move after earnings, but they are changing some metrics and competition. Is it a big concern? We discuss. UBS breaking down the hard seltzer craze. We're going to take the plunge to see if the trend is here to stay. Plus, Tesla zooms past $100 billion in market cap, shares on fire. The shorts are getting burned. What is next for Elon and crew? We've got that coming up. With us now, Yahoo Finance's editor-at-large, Dan Roberts, streaming expert, to talk about streaming, seltzer.
There he is. Yay, all right.
It was like a big reveal today. Yay, he's here.
You should have had whistles and stuff. Yeah, like a children's birthday party.
Bring in the balloons. Let's check on the markets right now. S&P 500 and the NASDAQ hitting record highs, boosted by a rally in tech stocks. Both indices on track to close at or near fresh highs. Tesla charging ahead in the NASDAQ, market cap topping $100 billion. Last I checked, the new high there, $594.50. I mean,
well, the stock is so high.
It's so high, and we're going to be talking about Tesla. But first, I need an overarching some market help, because I was off yesterday.
Yeah, nothing happened.
Well, but we were down. We were down, and so to
what do you mean? The World Economic Forum in Davos, Switzerland kicked off.
Coronavirus, great name.
Okay, coronavirus. Why? Because it sounds like a beer?
It's just a good name, yeah.
But coronavirus was the story yesterday. That's why we were down. It wasn't impeachment, but now all that's in the rearview mirror.
It was definitely coronavirus, which has gotten worse. I mean, officials just within the last hour
we shouldn't be laughing
saying
that
they're not going to be allowing people out of the city of Wuhan. If you've been in Wuhan for the last 30 days, you're not going to be able to go. So I mean, it's not like it's great there.
Planes, trains, ferries, the whole thing.
Ironically, our former colleague, Crystal Hu, doing some Instagram reporting today about all different public transportation systems that are shut down there in Wuhan. And President Trump has said, we have a great plan for the coronavirus.
And I mean, look, there's all kinds of bad things always happening in the world, and stock market bears would like all of them to mean stock prices go lower. That happened for about 20 minutes yesterday, and now it's not happening today.
And now we're back.
Yeah, I mean, look, the virus got to the point where it did goad some Wall Street analysts into writing what happens to the stock market around viruses. And the answer, as usual, is nothing. But, that was a thing that hit my inbox this morning.
I remember when I was in middle school years and years ago, and the Norwalk virus.
Oh, that's the one you throw up on the cruise ship.
It was from a cruise ship, but it had infiltrated, made its way to those on terra firma. And I got very sick from the Norwalk virus. Tough one.
Oh, tough for you,
We
Dan.
should not laugh about this.
Look, we can just hit our usual theme in the last few weeks. It is the case that whatever the bad news du jour is, it hasn't stopped the stock progress. Up, up, up. I mean, you said, impeachment? No, doesn't matter.
I mean, I actually thought, because I was just watching the market but not the news, I figured it was some sort of impeachment thing. But silly me. Obviously, I was wrong, because nobody cares about impeachment. This is the only part we're going to talk about it right now is when I say
I care about the coffee ban. I care about the coffee ban on the floor from the senators. They're not allowed to have coffee.
They can have milk. Is the milk lobby
I didn't
involved?
quite understand that. I understand no phones. No coffee? That seems to be a disservice. Why would that help the proceedings?
The milk is obviously a lobby thing.
Right?
No one wants milk. No one's like, need milk. Although, funny enough, I saw a man yesterday on the subway pull out a carton of milk and drink it.
Love that.
Like with the thing. It was this size, and start just drinking it on the 6 train. It was crazy.
A big one?
Like a half-gallon size, or no, a quarter gallon size.
I think millennials, I suspect, are not getting enough milk. Because now it's cooler to do almond milk.
You don't need milk.
It's just water.
There's nothing in milk that's nutritional for you.
Are
that
you
can't
serious?
get anywhere else.
Your bone strength.
You can get that anywhere else.
Sure, just take a supplement. Why drink milk anymore?
Exactly.
And vitamin D.
Lactose is not good for the human body. You're not supposed to be drinking milk. It's
Decades
just
of teaching.
All these farmers in the U.S. who have a disproportionate lobby based on their geography convinced lawmakers that their cows needed to sell the milk.
I guess you've forgotten the all-important food pyramid that we learned about in 6th grade.
Something that doesn't speak to health.
Cereal bowl.
They changed it.
Kids at home, don't eat the food pyramid. You will get fat. All right. For more on today's market action, let's go to Inez Frey live on the floor of the New York Stock Exchange. Inez.
Myles, we're watching at Boeing. It came off its lows of the day. It actually reached a 52-week low this morning of 302 and change. It was downgraded at Vertical Research to a hold, but it came off its lows after CEO David Calhoun was having a conference call with reporters in which he said that he wants to start production of the MAX again months before the MAX goes back in the air. He said that this would invigorate the supply chain. He also talked about the pushback of the timeline that Boeing gave yesterday, expecting the ungrounding of the MAX to start mid-2020, saying that this is because of simulator training for the pilots, which Boeing recently said that it now is recommending. And then speaking of Boeing, during United's earnings call this morning, analysts peppered the call with questions also about the MAX and about the impact on United. And executives didn't give too many details about this, but they did say that had they had the MAX, this would have benefited their revenue. It also would have benefited their CASM, that's their cost per available seat mile. Now, mind you that United beat on earnings. Also, they said that they reached their 2020 adjusted EPS goal 1 year ahead of schedule, despite the headwinds. And speaking to the fact that Boeing yesterday gave this guidance, this timeline in their statement yesterday, United said that it will be pushing out its schedule further at some point, and it does not expect to fly the MAX this summer.
All right, Inez Frey live on the floor of the New York Stock Exchange.
Shares of Netflix are lower today after the streaming titan missed its forecast for U.S. subscriber growth for the third straight quarter. Actually, here in the last hour, a weakening up a little bit as it closes in on being down close to 4%. So there are a lot of different headlines in here on what Netflix told us yesterday. But aside from some of the financial stuff, they're also changing how they measure viewership, and that has gotten a lot of attention.
Well, it's interesting.
What are the details?
First, the Witcher claim got a lot of attention. You know, Netflix dropped the letter in which it said The Witcher is on pace to be our best first season of any show ever. You say, wow, oh my goodness. Especially ironic since, I think we discussed this, I don't forget if you tried it or not, Ethan Wolfman, our colleague, and I both watched.
Watch it.
It's inane and ridiculous.
The last segment ever of Wi-Fi AM was Ethan talking about The Witcher.
It's not good. It's not I mean, I saw an Atlantic story that basically said, it's so bad it's good, and it knows that it's silly, and that's why it's good. So I thought this will be fun. But I didn't even think it was so bad it's good. I thought it was just bad, but clearly people love it. However, now you have to take Netflix numbers with an even bigger grain of salt. And I've already written in the past a few months ago about the problem with Netflix's own numbers when it releases its own viewership stats. And of course, Netflix only does this. It picks and chooses. It cherry picks when it wants to say, look what a mega hit the Adam Sandler, stupid detective movie was. Yes. You all said it was stupid. Yeah, you all said it was stupid. And the critics said it's trash. But guess what? 35 million people watched it on the first weekend. But already those claims were suspect because they're Netflix's own numbers. And because in the past, Netflix counted 70% of watching something as a view. Now, with a movie, I think that's fair, because if you watch 70%, you're probably finishing it. But with a show, a series, it counted 70% of episode 1 as a viewer of that show. But I think that already was a problem because all the time people will try just the pilot episode of a new show, then give up on it. Now, Netflix revealing in its earnings report yesterday, it's shrinking the requirement even more. Now it will count just watching 2 minutes of something, you're a viewer. 2 minutes is so little. I mean, that could be the amount that you watch by accident because Netflix just plays things on your home screen. So a lot of people, raising a skeptical eyebrow. But again, does it matter for Netflix's bottom line? I mean, look, let's remember, Netflix doesn't have ads,
yeah, they're
at
not
least
selling
currently.
Ads.
So who are they trying to impress when they put out those numbers? Just us, media and users saying, look what a hit our new movie is. It doesn't necessarily matter, but I do hope that people will remember now to be really skeptical when you see these touted figures of, oh, look what a giant hit our new show you've never heard of is. You may have never heard of it, but look how many people watched. Well, they watched 2 minutes of it.
I mean,
we can talk about the earnings miss too and whether that matters.
Numbers are good. Nielsen has been criticized for decades about how bad those numbers are. You could turn a show on and walk away. You could lie in that little journal that they leave there.
Right.
Numbers are full of baloney to begin with.
Sure, and let's remember 2016 with the election polls. I mean, since then, anyone should be skeptical of any polling. Myles doesn't want to get into that, but I think it's fair to say
it's like here we're talking about this. Now let me bring up completely unrelated number things.
Well, no, my point is just I think there are a lot of people who they don't really necessarily fully buy into any kind of survey anymore, questionnaire, poll. You see a headline, poll. 75% of people say they've boycotted NFL because they're mad about the kneeling. Well, that was not true. I mean, so it is smart to take all these things with a grain of salt.
How networks have done their numbers for a long time. It's not a perfect science.
Well, Nielsen was
imperfect, science at all.
but when it comes to linear television, it at least is the standard. So, yes, it's in vogue to question Nielsen, but at least for linear television, people say, here's the Nielsen number, and we take that at face value. Now, if you're bringing up the fact that Nielsen has just begun to say it can measure streaming, but it is definitely inexact. We're just not there yet. What more people are calling for is a new standard, some new tool to come along and be a third-party neutral measurement of streaming viewership. But it's hard. I mean, HBO Go, I'm always fascinated. I want to know what percentage of people were watching HBO shows on streaming. Because I think at this point, it's fair to talk about HBO the way we talk about Netflix, Amazon Prime, Apple TV+, Hulu. I know there's an HBO channel, but I suspect a huge percentage of people watching HBO shows are watching them OTT.
Do you think the volume has to be up? That's an issue for us. We got the volume to be up. Please turn them.
Doesn't Nielsen measure 1 minute of concurrent viewing?
So, well, for streaming services, Nielsen is using audio.
I'm struggling to figure out what the problem is here.
The problem with which?
Any of this. Just what the issue is.
If you just want to have always the take that nothing matters, then.
No, but you're trying to have the take nothing matters and that it's bad that Netflix
I don't think nothing matters. I think it matters.
But then you say, but nothing matters because of 2016.
Well, it's understandable to just say, I'm not going to believe any kind of claims from services.
Not understandable. It's not understandable to say that.
If what if Netflix is setting the new standard? Will it then be okay if Disney's like 2 minutes is going to count and HBO, that's just like the streaming metric, and then it'll be apples to apples?
Well, with Disney Plus, I mean, who's going to watch just 2 minutes of The Mandalorian? If you try the first episode and you watch 2 minutes, should you count as a viewer of the show? Probably not.
Again, I'm confused. Coming up, we are going to have UBS breaking down the hard seltzer craze. That's another Dan Roberts special.
Oh, yes.
Stick around for this conversation, but first take a look at where European markets closed on this Tuesday.
Now here are some stocks that we're watching. Johnson & Johnson posting a better than expected profit, but the pharmaceutical giant reported disappointing quarterly revenue that sent shares lower. Toyota, after the automaker announced it would recall 3.4 million vehicles globally due to an electronic defect that could prevent airbags from deploying in a crash. And Boeing, after the jet maker announced that its grounded 737 MAX jet could make a return in mid-2020. The company's CEO also saying the dividend is safe. What? Am I laughing when I'm saying it? No, I was going to actually say that I heard him say it on this call. And and I think that he gets it. This is Calhoun. He's like, we have to give a real timeline and we have to push it further out because when we keep
I was just going to say,
keep saying unrealistic timelines,
this isn't real.
It's making problems for everybody.
But Jen Rogers' rule number one, never talk about the balance sheet.
Yeah.
Discussing the dividend is acknowledging that there's a risk to the dividend. You don't come out and say dividend is not at risk.
He was asked, point blank, he was asked about the
dividend. Don't operate your company in a way where you're going to be asked
your dividend in
jeopardy. We were talking about midway through 2019 how Boeing says the 737 should be back in service by the end of December. Then it was in 2019. Then it was January. Now it's mid-2020.
All of this is true. Man. I'm not a Boeing defender.
No,
but I thought that the idea that they think we've messed up the timeline repeatedly, and now that they know they're going to the simulators, they have a better. They still don't know what's happening.
We make no claims.
They still don't know what's happening.
We should just say we make no claims as to when the plane will be back in service, but we can tell you we're working on it, we're doing our best, and it will get back up in the air someday.
Yeah. I know, but that would
Stock
make
would
sense,
fall
but they
2%.
Actually, I wouldn't even say that. They don't know it's going to be back in the air. Like, I don't think you can confidently say this plane is ever going to fly again.
Wouldn't you just go buy
I don't think they want to come out and say that.
If you let the airlines completely.
Boeing is paying you to pretend, like Boeing is paying Southwest to pretend like they're going to put this. Anyway, fine. We'll talk about Boeing every other day for the rest of all eternity. All right. Hard seltzer. If you thought that craze was over, think again. Now, hard seltzer, of course, was the story of alcoholic beverages in 2019. UBS now expects momentum to continue for the drink into 2020. The firm sees hard seltzer growing from $1.75 billion last year to nearly $5 billion by 2022. So we're looking basically at a tripling of the market here in just a couple of years. Dan Roberts is a noted hard seltzer enthusiast. Your view?
Oh, no view, but I'll just share with you the facts according to the UBS survey. Although, as we were just discussing, people can be skeptical about surveys. UBS says that every single metric it asks about is up. So, do you drink hard seltzer regularly? Has gone up from about 17% of people say yes to 21%. Then, do you drink it occasionally? That one is up the most. That went all the way up from about 27% to 32% say they drink it occasionally. And then, most notably, the number of people saying they're not familiar with hard seltzer as a category has gone way down. Okay, so it was at about 22% when they asked in September, and now it's down to 14%. Now, all of these changes are just since September, people. So in only about 5 months, things have really taken off. Now, what's remarkable to me is a lot of people thought, A, that the hard seltzer train would end with summer. I'm happy to say I'm one of those people. I had a little house party in the fall. No one wanted hard seltzer, even though I stocked up on it. I think that was good anecdata that shows that, as I suspected, it was a summer thing. Well, I'm wrong. And B, people thought that regardless of seasonality, hard seltzer as a fad was on its way down. No, it's still on its way up. It's getting bigger. That doesn't mean it's not a fad. It just means the fad hasn't run its course yet. And in fact, rather than the bubble shrinking, right now it's expanding with a ton of new ones coming into the market. So Bud Light Seltzer just launched this month. And that parent company, Anheuser-Busch InBev, already had two seltzer players, Natty Light Seltzer and Bon and Viv.
Have you had the new?
I've had them all, Jen.
The Bud Light one too?
I've had them all. No, not Bud Light Seltzer.
Okay, that's what I wanted to know.
But that one hit stores a week ago.
Okay.
And Jelly Belly, the Jelly Bean Company, Jen, announcing it will do, now not a hard seltzer, non-alcoholic, but a flavored seltzer thing.
Maybe that's what Mr.
Coca-Cola doing one?
Mr.
Yeah,
Peanut
you just wait. Peanut, but watch out for the peanut allergies.
So now, in this survey, folks said that taste was the biggest consumption driver, which I think is fair. Healthy and variety were the other two that had increased the most.
Well,
since
look, number
September.
2 was trying new things, and number 3 was seeking variety, which I still see as trying new things. So what was interesting to me about this one we're showing right now, this question, is that health is not the leading driver of people buying or trying
it's
hard
still an
seltzers.
alcoholic beverage, right?
Right.
It's like, you know.
But they've, the people behind these drinks have marketed them as a healthy alternative to beer.
That's right.
Lower calorie. Well, that's not why people are drinking them.
So in the going through this, one part that I can't find the chart, but that women, they were down a little bit as in regular drinkers. That was the only decline that I saw there.
Yes.
Yeah, gender, right?
Yeah, they were down about 1%.
1%.
Negligible. Margin of error.
White Claw continues to be the dominant player.
Well, but Truly is number 2, and UBS in this report concludes, for some reason, that the growth of the whole category in 2020 will most benefit Truly.
Well, I think it's because
SAB Miller.
I think it's because well, no, Truly is Boston beer, right?
Which is SAB Miller.
Oh, right. Really?
But is White Claw, so White Claw is
their
not
distribution network.
the standard bearer for
I agree with you. White Claw is like the Kleenex of hard seltzer. It's the de facto one you know, even if you aren't a person who drinks hard seltzers. But I'll give you an under-the-radar one I like. Henry.
Who makes it?
Miller Coors.
Hank.
I don't
There's
know.
a lot of them. The natty one is
and we have,
dangerous.
We have B-roll for all of them.
The natty one tastes like
Unbelievable.
just juice. It's like Hawaiian Punch, and suddenly you're drunk.
Yeah.
Someone in our meeting said they have it on tap now, places. Was
yes,
that you?
Truly, yes.
Truly on
Truly
tap.
on tap.
News to me.
Very dangerous.
All right, hard seltzer. Keeping it going into 2020.
The mom trade does not approve of the Truly on
Very-
tap.
very-
Why? Moms don't like hard seltzer?
No, it just
I
is
think-
like it seems dangerous.
It's a kind of flavor even a teen could appreciate.
Yeah,
Unlike a beer.
Sounds like
Easy.
Juul. You hit your Juul and you take a swig of your hard seltzer.
That's right.
God.
Dangerous.
Coming up, tech in the spotlight. We've got big earnings reports coming up. Who will surprise? Who might disappoint? We're going to discuss right now. Take a look at where big tech is trading in the last hour. Netflix shares falling after the streaming giant missed on U.S. subscriber growth. Where does the stock go from here? Joining us right now, Justin Kuzmarski. He is with NAV Evaluation and M&A firms. So, Justin, Netflix, easily beat on revenue and the earnings expectations. And the U.S. subs, not great, but international was strong. Overall, what did you think of the report?
I think the three key drivers that people are focusing on, obviously the stock was down today about 4%, $13 to about, I think, $328. The big thing is U.S. growth. People are focusing on that. It was 420,000 subscribers in the fourth quarter, down 30% from expectations, 600,000. International is up 15% to 8 million. But I think the big thing is the lack of disclosure. I mean, like Apple is not disclosing unit sales as of last year, investors and market observers are keyed in on U.S. growth, particularly that they're $15 or 3 times what Disney Plus and Apple is. I think it's a big price differential. They have great content, they invest, but watching U.S. growth is the metric U.S. investors want, but may not get starting in 2021.
So when you look at Netflix right now, is it really a competition story? Like, are you concerned that their moat around streaming services is not what I think a lot of investors have believed it to be? Now, certainly the market, I think, has mostly agreed with that view over the last several months, if you look at what Netflix stock has done versus a lot of its peers. But I think they want the market to be talking about the international story. They want the market to say, hey, 2019 was the peak of free cash flow deficit, free cash flow burn. So do you see this as, well, eventually people are going to realize HBO Max and Disney Plus are products that are just as good?
I think you're right on the money with the moat. I mean, there's 60% of 100 million of U.S. broadband households. So that is definitely an economic moat that people respect. Mm-hmm. I think the main sticky point is whether that $15 premium for HD and $12 for full HD can withstand, $4.99 from Apple TV. And Apple TV has, that Netflix a few years ago, investing in content. Will the content for Netflix stand up in time?
And you wonder about the spending, too. I mean, I think a lot of critics for years already have talked about, well, how could the spend on original content keep going up for a company that has had quarters where it isn't profitable on a cash basis? And so, or it is profitable on a cash basis, one of those two. But, it has had issues with profitability. And people say, well, how can it keep spending? How can it keep spending? It's going to have ads. But I just don't see them ever adding ads. I think that would be such a huge white flag for this service. And then the retort to that has been, well, they could have a tier that has ads, and if you want to pay less, fine, and that keeps some people. I just don't see it.
I think the free cash flow is a big thing. You mentioned that. It was like last year, negative $3.3 billion. This year, it's only going to come down to $800 million to negative $2.5 billion. But the investment in shows is almost a race, an arms race. And I think that is something that has been triggered by deep-pocketed companies such as Apple with over $100 billion in cash getting into the content business. It's a 10% margin business. Growth is there, but still, you look at the tech giants, they're all 30 to 40% net margin. So, I mean, this is still a low-margin, high-growth stock. It's just a question of time before that maybe could be swung the other way.
I'm glad you mentioned that, actually, because I've been wondering, might there soon be yet another player in terms of original content that we haven't seen? I mean, look at Google and YouTube. I mean, yes, YouTube has kind of YouTube programs, user submitted, but it doesn't have, fancy premium prestige content. Well, and that wouldn't shock me in the next 2 years.
But think about how long it took Netflix to go from what it was to getting in that. I mean, it was
Apple flipped on the switch, and it's just okay at first, but it got a SAG award,
Right, but I mean, remember, Apple isn't, right? I guess
enough money at Stars, and you'll get a premium show.
But Apple isn't like selling Apple TV Plus, really, right? Like, they're doing it to sell iPhones. They don't actually care about the content. In many ways, right? Netflix is kind of the only company that the content matters. Like, that's the primary.
Is all there is. It's a pure play. It's a pure play company, and it'll always be watched because of the pure play content and distribution. I think you're right. I mean, I think people and investors will see companies dive into this because content's always been king. Look how HBO was always viewed as undervalued when it was part of a conglomerate, and it was unlocked over time. People were following the growth of HBO, and obviously HBO allowed you to cut the cord and go purely streaming too.
So this idea that they're going to be pulling back some of the data that we want, everybody got very upset when Apple did that. Yeah. Stock's up.
Stock doubled.
Stock's doing great. So why is it necessarily bad for investors? And I guess the idea spinning it forward, are more tech giants going to do that? Because we have more tech earnings on tap. The thought has been, Google has a new CEO in play, that we're going to actually have more transparency there, especially in the cloud space. Are you worried that we're going to be losing data just because you want more to put into a model, or because you think it's actually going to be bad for the stock, that's a risk for the stock?
I think it's a great question. It's a $64,000 question. It's selective disclosure. I think companies such as Netflix are always trying to get ahead of the story because they're a 10% margin company. Apple can really do no wrong when they have the margins that they have and the growth that they have. So, I mean, Apple can get away with not disclosing unit sales. If Apple was a 10% operating margin stock, would they be under more scrutiny? Yes. Look at Amazon. Amazon, when they're a 3-4% operating margin stock, has gone up significantly less than when they are now, which is a 6% operating margin company. And remember, it's been a few years since they've had Whole Foods in the mix. That's obviously was a high premium margin in comparison to other food companies. So it really comes down to EBITDA margin and EBIT margin growth for a lot of these tech companies. The higher the margins, the more they have the power to disclose or not to disclose.
Right, and the selective number sharing gets back to what we were discussing earlier with deciding how much constitutes a view now. I mean, some people have said, well, why would Netflix fudge the numbers since they're not trying to impress advertisers? Well, they're trying to impress the public and shareholders and users and critics, media critics and actors, help recruit talent. I think that's why every so often they put out a number and they say, gosh, look how many people, how many accounts or households watched our new movie that critics say is bad.
Yeah, there's an edge to it. That's a great point. People are saying the Irishman shouldn't be Oscar-worthy because it's a streaming movie. And Martin Scorsese firing back at Marvel, and so it's become almost a question of quality, not really on distribution.
And I guess just more broadly, we're talking about the FANGs and about Netflix, and the market cap concentration we've seen has become a talking point over the last couple of weeks. When you look at the market right now, are we just spending way too much time talking about the same 5 companies when you don't have to have a view on Tesla, right? You can just let Tesla be. You don't have to care about Apple. Guess what? Apple's got 60 analysts covering it. Everyone and their mother owns the stock. You can just say whatever and move on. Are you seeing just in the market too many people looking at the same ideas and not realizing, hey, there's a couple thousand stocks out here in the public market?
I mean, that's a great point. This is really a unique market. For the past 10 years we've been on a run, but most importantly, the concentration. The big 5, Apple, Amazon, Alphabet, Facebook, Microsoft, the concentration there is something I think it's a sixth of all market cap. I mean, the market caps of those alone are $5 trillion. So you have that concentration there that's been unlike any other tech expansion we've seen, even going back to the late 90s when the internet was really taking hold for the first time.
Just before we let you go, you've worked on 150 deals, including the merger of Seamless and Grubhub before the subsequent IPO. Been a lot of headlines recently around what's going on with Grubhub. What do you think is going to happen in the delivery space? How many winners are there, and who is it?
I think that's like content that can be, if it's played out inappropriately, a race to the bottom. I think the article that was broke in the fall about the phone orders being counted as real orders is an accounting question. To me, that's an internal control issue. That could be a deeper issue if the lawsuits start flying. I think when Google gets in, Uber Eats gets in, Amazon's talking about a 2-hour service. When Amazon starts talking about markets, especially on the delivery side, then everyone sort of perks up and listens to it. So I think the big gorilla in the room for the instant food delivery, the 2-hour window, or competing against menu pages or Seamless Grubhub, will be Amazon. Does Amazon really want to get in that space to be able to deliver food and maybe electronics to your door within an hour?
I think it does.
It probably does.
Well, I guess on the other hand, though, if you look at what's happening with DoorDash, their cash burn, you look at what Dara Khosrowshahi said about the Uber Eats business, where it works in some markets and others they're just burning cash. Do you think that the investors that are looking at that space have maybe kind of overplayed the TAM here? Like maybe looked at it and actually misidentified the real opportunity? Because obviously here in New York, food delivery, right? Fine, we all get it, but you go an hour outside the city, it's not really a thing. There's a pizza place, Chinese place, and maybe an Italian restaurant.
Well, that's a great place. Our mark actually owned Seamless, and Seamless is here. Grubhub is in Chicago. So it started with law firms and the banks. Distribution really works well in metropolitan areas. It's just like Whole Foods does better in states such as Colorado and New York than it does in states such as Kentucky and Indiana. It's basically the concentration of population and the tastes.
Yeah.
Justin Kuzmarski is the president of NAV Valuation Advisory. Thank you so much.
Thanks, guys. Appreciate it.
All right, coming up, we'll have more on the final round. Plus, Tesla zooming past $100 billion in market cap. The stock on fire. The shorts getting burned. We'll break down what's next for Elon Musk and his potential big payday. back to the final round here on Yahoo Finance. Myles with you in New York. I'm joined as always by my co-host Jen Rogers, back from assignment on this Wednesday, and joined by Yahoo Finance editor-at-large Dan Roberts. Let's take a look where we stand right now. 25 minutes to go in the session. All three majors are still in the green, though lightening up just a little bit as we head towards the closing bell. For more on today's market action, let's go to Inez Ferre. She is live on the floor of the New York Stock Exchange. Inez.
Myles, let's take a look at oil prices because oil has been under pressure today. Looking at WTI down more than 2%, Brent also down more than 2% over concerns of the coronavirus and the effects that this could have on oil demand in places like China. Goldman Sachs noting, comparing the SARS epidemic back in 2003 with what's happening now. Back in 2003 when oil prices went down by as much as $6 a barrel, and how this could compare to this coronavirus and the effects on oil, and Goldman Sachs predicting that oil could go down by as much as $3 a barrel. And then just taking a look at the Dow, we are off our session highs on the Dow, but just notable on the Dow, IBM has been the Dow leader today on the heels of its earnings. Apple hitting another intraday high after that report that Apple could be offering a less expensive version of its iPhone. Also, traders here have been noting that Apple is now the Dow component with the highest stock price since yesterday. Boeing broke below the 320 level. And then just taking a look at Intel. Intel hit a 52-week high today after naming a new independent chairman. Medtronic's CEO will take over that position. Myles, Jen.
All right, Inez Ferre live from the floor of the New York Stock Exchange.
New threshold for Tesla. It hit a $100 billion market cap for the first time earlier today. This milestone makes Tesla the highest U.S. automaker, highest valued U.S. automaker of all time. As we've told you before, it has already surpassed the market cap of Ford and GM combined. And thanks to a compensation package Tesla's board and shareholders authorized in 2018, CEO Elon Musk stands to earn about $346 million in stock if the Tesla market value remains above $100 million for a sustained period. Billion, thank you. Maybe it'll be trillion one day.
Well, what is the sustained period of time that it has to stay above that level?
Myles has been digging deep into this. 1 month and 6 month periods.
It's 6 and 1. So here's the thing. It has to be above $100 billion on average for 6 months, but also it has to be above $100 billion within the last 30 days. So for the package to trigger for Elon. So it's not like, oh, it was up so much during this period, but now it's down a lot. It's like during the period in which it was up over $100 billion, that 6-month window. The most recent 30 days, it must also be above $100 billion.
Well, that's a big if, but it is remarkable because I bet he's happy now he didn't take it private. If he gets that incentive.
I know.
Wanted to take it private at 420. Now it's way, way, way above that 420 mark. Yeah. Look, he's dancing in joy. However, for a long time, we would see these big swings with Tesla because there'd be good news and then there'd be bad news. And there'd be good news. Okay, we hit our stated goal for shipments up, but actually, unfortunately, we're going to have to push back and delay this other model. Or, okay, we've got a great new feature up. We've had to drop prices on this model to try to sell more of them because the price was too high. However, all that being said, this has been quite a run. I mean, from the low that it hit in March 2019.
Yeah, it's funny you say that.
It's on a tear. Not just the stock, a string of good news.
They just showed that chart, and it's like quite a run. It's like it's actually kind of a joke.
It's parabolic.
Like, look at what's happened over the last 6 months, because I understand that the fundamental story may have gotten better, right? But how does any company, the stock just triples in 3 months, and everyone's like, this is normal, this is fine.
The 52-week low is $176.99. And
is that less than 566?
And but the
$590 today.
The high today is $594.50. That's almost $600 a share.
That hits a $100 billion market cap.
It's like 550.
So okay, so we're well above. I mean, we're well above that.
101.86 right now at 565. So bring it back a little bit.
Keep hitting those records, though. It's just no guarantee.
But it has to do it for this 1 and 6, and then
for the stock options, basically the clock starts today, and then in 6 months we'll see if he gets paid.
And then
why'd you say 1 month trailing? Like in 1 month, if it's still been $100 billion that whole time, does he get something?
No, the average over the last 6 months has to also be $100 billion. Now, if over the last month it's $100 billion, but it goes to like 300, so that the whole average for 6 months gets brought up, right? You see what I'm saying? Then it could trigger.
It's not a death zone. You know, you fall below, up, you blow it.
It's not a death zone.
But we're saying he's going to get. earn $346 million, but he would actually get stock that if he sold, then would be worth it. But he can't sell it right away is the other thing. So I just don't want you to think Elon's just going to be rolling.
No. And let's make sure we mention too, it is interesting because the whole reason reportedly he wanted to take the company private, he was sick of running a public, he hates the earnings reports and the whole furor around that, but also hates these shorts who are out there. Well, ironically,
they're helping him.
Now, well, no, now he's loving sticking into the shorts. I mean, golly, he is winning right now.
Look, the answer has always been if you have a good company, you should be public. That's it. Right? If you have a good company, the public market will give you the maximum value for your company over time.
Though the
notion that you need to be private to actually do things is complete fiction.
Well, and the opposite, also not true, which is you have a bad company, you shouldn't be public. Well, it still doesn't. I mean, look at all these unicorns that have gone public, and they're bad companies. Well, they hemorrhage money, and they go public.
And the market price has reflected that. All right, let's head back out to Davos. Johnson Controls Chairman and CEO George Oliver spoke to Yahoo Finance's Julia LaRoche to discuss everything from his company to climate change.
We're a leader in the building space. When you look at our portfolio, we have a very strong HVAC portfolio across every platform, right from residential right up through chillers in the largest infrastructure that we support. We also have a very broad, what we call building management system portfolio with all of the systems that are deployed within buildings. And so for Johnson Controls, we have the unique opportunity to take all of the product that we deploy in the building, all the sensoring that we deploy with data, and combine that into differentiated solutions within the building space. We're about $25 billion in revenue. Over the last year, we transformed the portfolio with the sale of our battery business. So now we're a pure play buildings business and positioned extremely well.
So you're basically touching our lives, whether it's where we work or where we're educated. I do want to talk about the theme of WEF this year, and it's about stakeholder capitalism. So as we go into this week, George, what's on your mind?
Yeah, so I was very supportive of the Business Roundtable statement of purpose, and with that, we believe that we're positioned here with all of our constituents. Customers being able to deliver successfully solutions to our customer base that enables them to win. Our investors, make sure that we're always focused on deploying resources to be able to create value for our investors, and then being positioned globally to be a very attractive company for talent and be able to develop that talent successfully within their careers.
Well, a key part of this week is also climate change. It sounds like you all are also at the front lines when it comes to climate change. What is the opportunity there? Where can you really have impact?
Well, it starts with our vision. I mean, we are in the space we're in. Our vision is developing, deploying the most sustainable, safest, secure infrastructure in the world within buildings and within cities that we deploy our technology in. So for us, it's core. It's core to the theme of the conference. And so it's continuing to be able to make sure that we have the most efficient product, utilizing the least amount of energy. It's making sure that we're now developing data solutions that enable us to be able to enhance how that product is utilized, and then creating new business models with the data that enables us to be able to solve bigger problems that our customers are trying to solve, being able to support their digital transformations, and ultimately deliver significant sustainability within the infrastructure that we deploy, as well as on a go-forward basis be able to sustain that.
Well, you all are incredibly global, so I want to ask you, what is your read on the global economy? Where are you finding challenges? Where are you finding opportunities? What's on your radar?
Yeah, overall, I mean, we are a global company. Over 50% of our revenues are deployed globally, and we've been investing pretty significantly as we did the merger. We completed the merger, the Tyco Johnson Controls merger 3 years ago, and we've made tremendous progress in how we put those businesses together. And we have continued reinvestment in the product to make sure that we're leading through our product leadership, as well as reinvestment in our people globally and establishing the right go-to-market footprint to be successful in supporting customers and ultimately increasing our sales capabilities. So with all of that, we see continued development of the markets that we support. We've, over the last couple of years, we've delivered, very strong performance, and we see a pipeline that's continuing pretty much globally in each of the markets that we serve.
And since you are so global, how focused are you on trade? How do you think about that?
Yeah, so for us, we're a local global company. So what we do is develop our capabilities globally. We have local R&D, technology development in each of the key markets that we serve. We employ and develop people in each of the markets that we serve. So although, certainly we take all of that into account, we also try to make sure that we're positioned locally to be successful in the key markets that we're ultimately growing within.
And one final question, because you've been bringing this up, it's about investing in your people. How do you think about talent? How do you attract talent? What are the challenges and opportunities there?
Well, it starts with being a winning company, that we're in a position in buildings that we are the leader, and we believe that with what we're doing from a technology standpoint, we can attract the best talent. And then with that talent, making sure you're developing the skill sets that's going to make them successful, not only within the company, but more broadly in the industry that they're competing in. And so we've been very successful in being able to attract talent. We are going through a transformation. I think every industrial company's going through a transformation where you take your core capabilities that have ultimately delivered success to where we are today, and then how do you then advance those capabilities with the use of digital capabilities that truly is going to bring our value proposition to the next level.
All right, Yahoo Finance is providing live coverage at the World Economic Forum in Davos starting at 8 a.m. Eastern. You can watch the live coverage here at yahoofinance.com or on our mobile app.
Coming up, don't look now, but tax season is here. H&R Block's top tax expert on what you can do now to minimize that tax bill and avoid fraud.
Importantly, avoid fraud.
Yes. But also
minimize the bill.
Lower.
But
Who
also
doesn't want to
avoid
do that?
fraud.
Right now, take a look at today's Dow leaders.
Everybody's favorite season right around the corner, that of course, is tax season. The IRS will officially begin accepting and processing individual tax returns for the 2019 tax year on Monday, January 27th. Joining us now to discuss tax strategies and tips is H&R Block's Chief Tax Officer, Kathy Pickering. All right, welcome to the grimmest time of year. Glad to have you back.
All right.
So let's just start with the basic mistakes that people make, basic things people need to know. Anything new happening in the 2020 filing season?
So last year, tax reform, biggest tax change in more than 20 years, and we started seeing a couple themes. There were a few new provisions that people missed out on. One was the other dependent credit. So that's a $500 credit for children still in the household, 17 and older, as example. There was also this thing called the Qualified Business Income Deduction, or QBID, or the 20% pass-through deduction. Lets small business owners, self-employed, take 20% off the top. It came out so late. It was so confusing. People just missed it. They didn't understand it. They were afraid to take it. So those are two things that we're really hoping to make sure people understand, take advantage of. And then this is tax season, tax reform year 2. So federal changes all went in last year. State is starting to change this year. One example is people aren't able to itemize at the federal level, and in some cases they are able to itemize at the state level. So we really are seeing those kinds of things. It's a great opportunity to just get refreshed and take advantage of some of those new things.
So that extra credit for a dependent living in your home, is that really aimed at the millennials living with mom and dad?
That failure to launch.
Those pesky millennials.
It's aimed at boomers. We still have millennials.
Back home.
Well, there's one other thing about it. That child tax credit that went in last year, really good, $2,000 credit for under 17, but you had to have a Social Security number in order to be able to claim it. So for people that have ITINs and they're not able to take advantage of that, they can still take advantage of that $500 other dependent credit.
How is your business doing? Just because with all the tax reform that we've had, a lot of it is like, we're going to make it simpler, right? We're going to get rid of these itemizations. We're giving you a better deduction, so it will be easier to do.
And TurboTax has been advertising like crazy about just do it yourself on an app.
Yeah, but it's like they want to make it easier. They want to make it easier. Is that in fact happening, or are you guys still just booming business? How's it going?
In times of change, people get so confused, and they have so many questions, and they really want help. They want people to be able to answer those questions. So we have a product called Tax Pro Go, which for your millennials, for your super busy people that are really comfortable with technology, you can just take a picture of your tax documents, upload it into a secure portal, and then a tax pro who's specialized in your situation, certified in your state, takes it and does those taxes for you. And we've just seen so many people want help. They don't want to figure it out on their own, and they don't have the time.
Let the expert do it. Kathy, very quickly, I cover cryptocurrency here, and a lot of people are up in arms concerned about, Bitcoin and taxes. Are H&R Block professionals doing more, telling clients more about how to file any gains from trading cryptocurrency?
Yes, and the thing people need to know this year is for the first time there's a question on the tax return, do you have virtual currency? And the IRS is looking for people to self-report, right? There's not a lot of information reporting and not a lot of support in that, and they're looking for you to come forward, and they'll be more lenient even if you don't get it right if you're disclosing. But yeah, a lot of interest in it, and we're ready to help, absolutely.
There you go. No one gets audited anymore, but maybe if you own Bitcoin, you'll find yourself getting
a
audited.
letter from your favorite people.
All right, Kathy Pickering, Chief Tax Officer at H&R Block. Thanks so much for stopping by.
Thank you.
And Dan Roberts, thanks for stopping by on this Wednesday. Spend a little time with the group.
Coming up.
Disclose that Bitcoin.
And the Netflix viewing results.
Speaking of disclosing Bitcoin, we're going to get technical with Jared Blickery. The closing bell is coming up. It's just about 10 minutes away. We are back in 2 minutes.
4 minutes to go in the session. Jared Blickery is at the Wi-Fi Interactive Touchscreen for your check on the market as we head towards the bell. Jared.
Well, FinTwit was blowing up today with the bears. They came out the hardest I've seen in probably several days. This is the intraday price action. The S&P 500 definitely gave up some gains. But let's go through some of the bearish scenarios that we have on deck here. First is a tweet by Adam Mancini. A few pullbacks we've had in SPX over the past year have come after RSI has gotten very overbought and then forming bearish divergence. These are the exact conditions present now in SPX, suggesting a pullback to 3,300 or maybe 3,260 to 3,270. Let's go to the next one here. There have been 63 earnings reports. This is by Bespoke so far in 2020, and the average stock reporting has opened higher by 0.62%, but has fallen 56 beeps from open to close. So we're seeing investors use earnings as a reason to lighten up a bit. And then we got the Barron's cover. This is a magazine cover, a contrary indicator, Dow 30,000, why the Dow won't stop at 30,000. And finally, we got iguanas falling out of trees and now coming back to life. If that doesn't say sign of the apocalypse, I don't know what does.
Is that a real animal?
That's a real thing. That's a real thing. It happens in Miami
right now.
when it gets cold.
This is not animal abuse.
No.
This happened.
No, this is happening across the board.
That's the market.
He's fun.
Jared Blickery, Wi-Fi Interactive Touch/Animal Screen. Coming up, it's the closing bell on Wall Street. A cheaper iPhone may be on the way. Why this could be huge for Apple stock. We're back after this with the closing bell. Welcome back to the final round on Yahoo Finance. I'm Jen Rogers with my co-host Myles Udland, and that is the closing bell on Wall Street. You're looking at live pictures of the New York Stock Exchange and the NASDAQ market site, looking like we did have a stronger market about an hour ago, and through most of the day, the Dow had been up as much as 120 points. Giving that up, Boeing, of course, a big weight on the Dow. Sector's getting a little bit messier here as well. Going to be a photo finish, I think, on XLY and XLC Communication Services. Communication Services dragged down by Netflix, one of the worst performers, if not the worst performer in the S&P, off almost 4% today on that disappointing U.S. subscriber number in here. So a little bit of a mixed bag for the market overall. We're back to talking about Boeing, even though tech, I mean, Intel today, up 3.6%, and IBM, I had to look it up. I had to double check that it was in the Dow still.
Come on, let's not bully IBM to that extent.
It's up.
Right?
It's up 3%. That's pretty good for IBM.
revenue was actually up 0.1% last quarter. How about that?
I'm just
Every now
telling
and then,
you.
blind squirrel gets the nut. Yeah, I mean, I think what's interesting with today's market is, Jared just pointing out all these bearish themes that are out there, right? You continue to see an overbought market. You continue to see investors, actually that data from Bespoke, quite interesting, where investors continue to fade earnings results. It's the opposite of what we saw during the beginning parts of 2019 as that rally got underway, where we saw negative news almost immediately bought, right? Apple, January 2nd, 2019 was the last piece of bad news that turned into a market-wide event. Here we're seeing a little bit more caution from investors following earnings reports, which I think could, we'll get a sense, right, as we get, whatever it is, 200-300 members of the S&P reporting earnings in the next 2 weeks. We'll get a sense of how much earnings are playing into the market's overall, thesis right now, the character of the market, as we like to say. But I think Netflix reaction, after a pretty muted reaction last night and a quarter that was, frankly, kind of unremarkable, to see the stock down 3.5%, certainly is a theme worth watching as we get into the teeth of earnings.
And I think there's some people that actually are liking to see this right now. It's healthy. You're responding to negative news that's out there. I mean, the idea of this melt up, you can have this bull market run longer, but a little bit slower. We don't have to be off to the races constantly. It's nice to have Netflix have a little breather here.
But professional marathoners, they don't take breaks. They just run the whole time.
Sometimes they go
We don't want to be an average marathoner here in this market. We want to be pros.
Sometimes you have to go train at altitude and have a tougher go of it. Some
keep going
high
with this one.
expectations.
There we go.
And then come back here. You're looking at Netflix right now, 326 down for the day. Interesting. I was trying to look at the competitors to Netflix because, of course,
here's an interesting question.
Idea here,
who are the competitors to Netflix?
I say now. I mean, I'm putting Disney. I went and did Disney and Comcast. I feel like I don't know AT&T, but really HBO.
Is Apple a competitor?
No, Apple has too much other stuff. There's
is
fine.
Google a competitor?
Spending, not
for
yet.
YouTube?
No, not pure. I don't think. And even though you. They're different because they're pipes. Roku is in there. That's a little controversial. I can understand since I didn't put Apple in there. It could be a little controversial, but it was off 3% today as well. High beta name.
I think the more time that goes by, and not to belabor the Netflix point too often, we'll talk about it many more times in the future, but in a way, they are actually a company alone. They are kind of the only pure play content company. I was reading something from Matt Ball last night where he's like, hey, 35% of Disney revenue is the parks. So are we really talking about a content company here? Because Netflix is 100% content. And AT&T obviously has tons of ancillary businesses around the HBO asset. Obviously, CBS has a lot of things going on. I guess maybe they're sort of the most similar in terms of their pure play impulse at this point. But Netflix really is a unique case, and perhaps we don't view it uniquely enough.
And it's global in nature.
Absolutely.
As we saw with the numbers, so the U.S.
They don't have these rights issues and these
but
other.
The international numbers and what they've done in terms of having to release in every geography and every language, and technology is only getting better in terms of watching a movie from someplace else where there's a different language and they dub it, or you have subtitles. It's a much better experience than it was 20 years ago.
Yes. All right, for more on today's market action, let's go to Inez Ferre. She is live on the floor of the New York Stock Exchange. Inez.
Myles, taking a look at the leaders and laggards on the Dow. Intel finished off on its session highs, closing at a 52-week high, actually, throughout the day. Intel had been number 2, the second top performer on the Dow, and it ended up as being the top performer after selecting a new independent chairman. Also, Intel will be reporting its earnings tomorrow after the close. Also, IBM finished up more than 3%. IBM, throughout most of the day, was the top performer on the Dow on the heels of its earnings. Amex today reached earlier an intraday high. Goldman Sachs, Coca-Cola, all those two also finished off higher. And then just taking a look at the laggards, Dow Inc. was down more than 3%. Caterpillar finished off lower. Boeing closed off its session lows, Boeing down more than 1%. And then Walgreens and 3M also were some of the laggards. And just mentioning Boeing again, Boeing had been downgraded at Vertical Research to a hold from buy, but it came off its session lows after CEO David Calhoun said in a conference call with reporters that he wants to start production of the MAX even before the MAX goes back in the air. He said that this will reinvigorate the supply chain, also saying that the company will keep paying its dividend despite the MAX crisis. And United Airlines this morning during its earnings call, analysts asked about the MAX delay. Also, United saying that given the guidance that Boeing gave yesterday, that United does not expect to be flying the MAX this summer. Myles, Jen.
All right, Nez Frey live from the floor of the New York Stock Exchange. We'll talk to you tomorrow.
See you tomorrow.
Time now for Tech Howl. And joining us is Yahoo Finance tech editor Dan Howley. Bloomberg reports that Apple could begin assembling a new low-cost iPhone as soon as February next month, with plans to unveil the new device in
5 days
March.
from now.
Yeah, it's here any day. Noted Apple analysts Ming-Chi Kuo and Bloomberg have each previously reported that the new model will resemble the iPhone 8, but also include elements of the iPhone 11, which both Myles and I just paid a lot of money for.
I was going to say, we should just turn
annoying.
We should turn this segment once again into Myles and Jen talk about their iPhones.
Just gripe about the fact that you had
No, I think my phone is fantastic. I love everything
But what
about
if they
it.
sell it
And
cheaper?
I'll let
That's
you know,
annoying.
I have purchased Apple Care.
Thank
Excellent.
God.
I know you
Thank
both,
God.
you both were very concerned about that.
Finally, you got
I
it.
feel so much better that you got the Apple Care. Thank you.
I would understand if you wanted to gripe though, if you wanted to, because this phone will be.
Gripes go up.
Yeah, go bring them up.
As Tom Hanks.
What is this phone? Is it really?
It's going to be. It's not going to be as pretty as the one you guys have, or have the capabilities as the one that you guys have. But
feeling good.
It will be as fast, most likely. It'll have the same chip in it. It won't have Face ID. It'll use the fingerprint sensor.
Wow.
So they're going back in design right
So
now.
it'll have a home button.
It should have a home button, yeah. So this is kind of similar to what they did with the iPhone SE, where I believe they went back and did the 5 design and kind of rolled that out. And that didn't do very well for them. The iPhone 5C also didn't do too well. I think the 11 is really the first one that's a lower cost iPhone that has done exceedingly well for them. That's the one that's moving in high volume. And this phone is going to be perhaps as low as $399, maybe as high as $499, $599. Because you're selling the 11 right now at $699, so that's really cheap for an iPhone.
I mean, I guess who is the target consumer here, Hallie? And I think people would obviously say, oh, like they just want to sell more phones in India, for example, right, where you have a lower income per potential customer. But I sort of wonder, like, are they going after the teen market here in the US? Someone on set may have been trying to scoop up an old iPhone for a future teen user. Is that a market that is something Apple wants to look at more closely?
I think they just want to get more devices in the hands of users. And this is something that's kind of coming down where you're seeing, we had the extremes of the cost of phones, where we started at $1,000 with the iPhone 10, and now we're up to what, $1,200 for the 11 Pro Max. I think what you're seeing now is kind of a pullback where, yeah, people don't want to spend this amount of money, every 2 years on these expensive phones. So now you're going to see more manufacturers come out with more mid-range to low-range devices that aren't going to blow away your entire savings on a device. And that's really, I think, where they're going. And I think they're trying to hit that market. The other thing is, yeah, if it's teen users, then that means that those teens also get in on Apple's ecosystem, which, guess what? In the future means they'll have Apple Pay. Yes, they won't have the green check mark. They'll have blue, And I think...
So I mean, you'll have friends.
Yeah, exactly. Yes, you won't be an outsider.
That's right.
And, you're right. As far as India goes, this device would be tailor-made for the Indian market because they're using older devices now as it is, the iPhone 8, to remain relevant there. It's still expensive, though. If they can cut the price to $399, I mean, it might still be expensive for a lot of people in India, though. But if you can get them into the services and eventually start buying AirPods, maybe an Apple Watch down the line, it really is about getting as many people in as possible, not having that high ceiling for an iPhone price.
While we're talking about phones, we need to talk about this Jeff Bezos hacking phone story. 2 UN experts have tied the hacking of Amazon CEO Jeff Bezos' phone to Saudi Crown Prince Mohammed bin Salman. The Saudi embassy in Washington is denying responsibility for the hacking.
Sure.
They're coming out on Twitter saying they had nothing to do with it. The
Right.
reporting, The Guardian's been doing some reporting on this. The New York Times, these UN experts, saying basically malware came actually from MBS to Bezos directly?
Yeah. That's the idea here is that, it was through a WhatsApp video file that was sent. Bezos clicked it, and just because I assume he's using an iPhone, just because you have an iPhone and it's a secure device doesn't mean the apps can't be unsecured. And so the big deal here is that WhatsApp is end-to-end encrypted, so a lot of people like to use it for that reason. That's probably why Bezos was using it. That's probably why the prince was using it. But that doesn't mean that you can't get malware through it. And that appears to be the issue. Now, they can deny it as much as they want, but according to the forensics, it's really looking like it was MBS. So I don't know how much more you want from them besides that, but now the FBI is going to be looking into this. And I think, for a lot of tech executives that met with him or meet with anyone on any regular basis, they should probably look at their devices regularly to make sure that they're not infected with something. Look, Bezos is a smart guy, but that doesn't mean he can't be duped by something like this. I mean, it's not exactly spam. It's from someone that he thought he trusted or maybe had a growing relationship with. But I think that's especially important when you look at world leaders as well, though, because, I remember when Trump became president, the big thing was he's got an iPhone, it's not secured. My God, why are we doing that? So if something like this can happen to Bezos, who you would assume would want to take those serious security precautions, what does that mean for someone like the president?
Or me.
Or you. Yeah.
I have the James Bond theme in my head right now. It feels like
It really. I have so many more questions about all this. I hope it all comes.
We had a whole discussion about what does Jeff Bezos' day look like?
Yeah.
How many,
just get like
how many phones does he? How many phones does he have?
I guarantee he's got one main phone that he uses, and if he got some photos out of it.
More than one.
I think he's sent pics.
Does he also do Android and iPhone? I don't know.
I'm saying
there's more. We want to know.
He's iPhone straight up all the way, I bet.
I want to know.
I would take the other side of
Dan Howley, we'll talk with you tomorrow.
Thank you.
All right, and coming up, could volatility rear its ugly head later this year? And how do you battle that and market fluctuations? Ryan Kelly of Hennessy Funds on one sector that he likes right now in this current environment. But first, let's take a look at where financials traded during today's session.
Now here are some stocks we're watching. Johnson & Johnson, the pharmaceutical giant, reporting disappointing quarterly revenue, though shares were buoyed slightly by a strong bottom line. Boeing, after the jet maker announced that its grounded 737 MAX jet could make a return in mid-2020, and Toyota, after the automaker announced it would recall 3.4 million vehicles globally due to an electronic defect that could prevent airbags from deploying in a crash.
All right, well, 2020's rally is showing few signs of slowing. So how are investors supposed to play this market? Ryan Kelly is portfolio manager at Hennessy Funds, and he joins us now to discuss. So let's just start high level here. When you look at the last 4 months of this market, it's been a pretty unbroken move up and to the right. And as I think a lot of people say, wow, a lot of multiple expansion happened. Boy, stocks are certainly expensive at this point. What do you make of the current market setup?
Well, I think that certainly it's been a very good market, obviously. This melt up, as we're calling it, has been continuous. It's like
does it feel like a melt up to you, I guess?
Yes, I think so. I mean, there's still a lot of news out there which can be detrimental to the market, but overall, I think, though, that this melt up is happening because there are still good things going on out there. And earnings season has begun. Earnings seem to be okay. I don't think the stocks are moving quite as much as they have in other quarters on the news. But I think that overall, this market still has plenty of room to go, but there's probably going to be some volatility around the way. I mean, one thing that we all like to look at is how long has this market been a bull market? And if you look back at the last 4 greatest bull markets in the last, since World War II, really, this one is the longest by far. But it actually hasn't gone up as quickly as the others. In the Reagan era, we had the S&P going up 32% per year on a total return basis. This is only up, well, only I should say, but only up 18% per year. So it's not going to die just because of longevity. There's still more to go. But I think before, throughout the year, we might see some volatility with all the headline risks we're seeing, with the election, with the impeachment proceedings, et cetera.
So let's get to what you like, because I'm hearing you talk and melt up and it's longer to go. And I think, all right, maybe it's not too late to get in on some of the winners that we are reporting on day after day, having, hitting all-time highs. But you like utilities.
Yes.
Literally like the most boring sector possible. If the market is going up higher, why would I get into utilities right now?
I think that we're going to have issues along the way. I think that there's going to be volatility. There's going to be downturns. I don't know when this year, but I think it's going to happen. And that's what we've had. We've had 22 downturns in the last 11 years of this great bull market. So it does happen. So utilities are actually not as boring as you think.
Oh, really?
I'm going to try to convince you. I'm going to tell you where we were and where we are and where we're going. So back in the day, utilities had no growth. They paid a nice dividend, pretty slow, nothing too exciting. It really was the tortoise. Well, in many ways in the last 10 years, especially when it comes to natural gas utilities, which is one of the areas I focus on, those companies have gone through a real revolution with the natural gas boom that we've seen in the United States. They're producing more natural gas. Natural gas is abundant, it's affordable, it's accessible. And these companies are in a period now where they have twice the average earnings growth for the next 5 years. Their earnings visibility is very good, and it's twice as high for the next 5 years as it was, 30 years ago or 10 years ago. So we're in a high growth period. It's not because they're adding so many new customers, but it's because there's a lot of investment. And the way these utilities work is the more CapEx they spend, the more returns, the higher their EPS growth is. There are these companies that the more you spend, the more you make. And they're going through this transformation as they're replacing pipeline, modernizing their systems, making it more safety oriented. And these are all very good news for them. Dividend growth has been substantial, too.
Yeah, I mean, are there any names you like in here? And I guess just more conceptually, essentially, I mean, it's utilities, but it's also kind of betting on the energy space in general. And I think when you look at what hasn't worked over the last decade, you're stuck with energy. And I sort of just wonder conceptually, does it feel like, all right, now I'm going to take my shot? Because I think a lot of people have just kind of bailed on not even looking at energy at this point.
Well, energy, when you're talking about energy and the upstream companies, the producers, the E&P, there's still a lot, I think, of issues there. There's still a lot of pain. The oil prices, natural gas prices being as low as they are, it's hard for these companies to make money. It's great for the end user, and it's great for the utilities. Utilities, they're like, think of it as the meter spins, they make more money. It's a toll taker. So the more natural gas that moves through their system, or the more electricity that they deliver to the house, the more money they're making. So when we have low prices, that's great for them. That means that people are more apt to switch to natural gas, use more natural gas maybe, that kind of thing. And so from a big picture point of view, that's really kind of what's going on, is that these aren't quite as slow and boring as you think. And energy is tough. Energy, if you look at the energy index, it's horrible right now over the last 10 years. Utilities, actually, the fund we run, the Hennessy Gas Utility Fund, is 30 years old, and it has a 10% total return per year in that full 30-year time period, just slightly behind the S&P, but it's much less volatile. It has a much lower beta. It's a nice way to augment your portfolio.
All right, Ryan Kelly, portfolio manager at Hennessy Funds. Thanks so much for stopping by.
Thank you.
Coming up, what we're watching tomorrow, it's the look ahead, plus Elon's big payday, why he needs Tesla's market cap to stay over that big $100 billion mark. We're back right after this. And now here's Myles with a look ahead at what will be making headlines on Thursday.
Well, every day, this market makes you want to call the top, right? We've got a new virus in China, the 737 MAX debacle continues, the global elite are practically giddy over in Davos. Tesla shares go up every day. I mean, at a certain point, as Andy Serwer likes to say, don't all the bad things have to matter? Well, the answer obviously is kind of no, right? Like, the market appears to have rules, but there aren't real rules, right? The stock market doesn't follow the rules of physics or football. There's no referee. Stock prices can literally do what regulators will allow on a daily basis. Now, discerning viewers will hear regulators and think the Fed. This is all happening because of the Fed. The Fed has manipulated volatility and true price discovery out of this market. And sure, the way the Fed acted after the crisis and since has changed the character of financial markets across the globe. But this new normal of lower vol and firm, consistent buying of any market dip is a years-long pattern. It's not new in 2020. And while I know it is unbecoming to make fun of market bears, these folks have simply opted not to see the forest for the trees. And this latest rally we've seen in the last 4 months is just the bears' latest in a series of similar misunderstandings. Now, turning to the calendar for Thursday, on the earnings side, Comcast, Southwest, Travelers, Procter & Gamble, and Skyworks Technology are among the notable companies set to report their quarterly results. And on the economic data side, the weekly report on initial jobless claims and the December reading on leading economic indicators will be the highlights.
I wonder if Southwest will say anything about Boeing.
They'll say, we're waiting.
We're waiting, like the rest of you.
We have no, I think they put out a statement.
Yeah, they
recently.
say something, but still,
They'll be asked
more
again.
opportunity to ask. And
Do you guys have any visibility on Boeing?
That's exactly
on the rebates.
how it's gonna sound.
Great quarter, guys, but I wanted to ask you about the rebate visibility on
visibility.
the 737 MAX.
Mark my words, that will happen. Tesla CEO Elon Musk is on track to be $1 billion richer as the electric car maker's market cap topped $100 billion for the first time ever on Wednesday. Now, Elon's not quite there yet. Tesla's market cap will need to remain above the $100 billion level for the next several months to meet the 6 and 1 month targets in his pay package. Tesla does not pay Musk a salary or a bonus, but his compensation would break all records for executive pay if its shares continue to rise and it hits key production targets. Guess would he deserve it?
Sure.
He's behaving. Yes.
Yes.
He is behaving.
I think what's so interesting about this package is like his net worth is already mostly tied up in Tesla stock, right? So he's gained about $7 billion in personal net worth in the last month because Tesla shares have gone up quite a bit. His stock package, you can do the rough math based on this. He gets 1% of Tesla's outstanding shares issued to him in the form of stock when he hits these milestones. So the one that he would hit with the $100 billion in revenue or $100 billion market cap would be the $20 billion annual revenue plus the market cap gets him the bonus. Then every $50 billion in additional market cap, as long as he hits performance goals, he'll continue to get 1% of the company. So this is why when people said, oh, his package could be worth $65 billion, it's just 10% of the $650 billion market cap that would max him out. But the math isn't exactly all that easy, but it's good for Elon.
It was my favorite part of the filing is that the cap on it is that they went to a $650 billion market cap. I mean, I know it's just an exercise that they
But why stop there?
did. Why? Why not go to $1 trillion?
So
why not put that in there?
I think what I'm interested in, and I have the filing up here, is so it has these rolling profitability and revenue targets, right? And so $20 billion is the current revenue threshold that he's going to hit. $35 billion is the next, but it's for trailing 4-quarter consecutive periods. My question here is if Tesla's growth starts ramping at some insane rate, is there a scenario in which, and I think the answer is yes, he just bangs these out quarter, and all of a sudden he's got 10 straight quarters where all of a sudden he owns 8 additional percentage points of the company and now has $40 billion in stock that had been given to him. Now, it's not worth $40 billion because the strike isn't zero. The strike is $350 a share, but it would be tens of billions of dollars of stock that he has just magically if the company goes nuts. I think the answer is yes.
He can't sell it right away.
He's got a 5-year period, other than things
a tax issue.
Yeah. He wants to buy houses. He's been buying a lot of real estate.
Right now,
one of his sons might have to go to college in this time.
I have to imagine that some bankers are doing a lot of stuff, getting everything that's been levered, redoing it with your Tesla stock here, right? So you need to rejigger all of your balance sheets for your family.
If only there was a firm who does investment banking work with Tesla very often.
You think he has one? Probably.
Yes, we all know where he banks. We all know where he banks. Coming up, we'll have more on the final round. Plus, we'll track the big trends in luxury fitness with the CEO of MindBody, why experiential wellness is the next big thing. We're back with that right after this. back to the final round here on Yahoo Finance. Myles with you in New York. I'm joined as always by my co-host Jen Rogers for the final half hour of today's program. Let's take a look where the market settled on this Wednesday. Mixed market here. The Dow finishing in red figures. The Nasdaq and S&P managing with green closes. None of the three majors hit record highs today. Stock that did hit a record high, just talking about it, our good old friends at Tesla.
Tesla.
Congrats to
And
Elon.
an intraday high that's almost $600 a share.
Yeah, 594?
Yeah, 594, 594.70 maybe,
There you go.
right around there.
And the president today saying we must protect Elon and our great geniuses, such as Thomas Edison and the man who invented the wheel.
We don't know that it was a man. I just want to get that out there about the wheel.
I have the quote here.
I know that.
I
It
think
could
his
be,
quote
the
was-
president might be saying it.
That's
So
fine.
it could be a woman that invented the wheel. That's all.
The people. He did say the people.
The people?
The
Okay.
light bulb and the wheel.
All right,
of
as
these
long as it said people.
That's fine.
I want to make sure that's
All right.
clear.
MindBody has cornered the boutique fitness market by providing cloud-based software across health and beauty brands. They released their 2020 Wellness Index. That includes upcoming industry trends and what the healthiest city in the U.S. is. Rick Stolmeyer is the CEO of MindBody, and he joins us now. So Rick, you guys were kind of SaaS before, like, SaaS was the cool thing.
That's right, yeah. We invented MindBody Online in my garage in 2004. And the basic understanding was that these small businesses, these health and wellness businesses, they needed something super simple they could access from any computer. We didn't imagine the smartphones coming yet.
Yeah.
That we originally had installed software. It was too hard to maintain, too expensive for them. So we were kind of driven to this idea of a web-based software.
So we have a lot of boutique fitness people come in, fitness tech folks like your Stravas, the ClassPass CEO. And one of the things we've talked to them about is just how this is going. Is it peaking? Are we, you're already shaking your head.
Not even close.
Really?
We're in the early innings.
Of boutique fitness. How
Yes.
much more can there be?
Well, what we're talking about here is a societal shift. I mean, this is really, we're talking about Maslow's hierarchy of needs. We're talking about the change that started at the end of World War II that led to a level of affluence across the world that we've never seen before in human history. And it takes a couple of generations for that to change people's behavior, right? The greatest generation wasn't going to spend $200 a month on their fitness, right? My grandmother was never going to visit a day spa, but my mom did. And certainly my generation does. So this is what we see happening. This is not a flash in the pan. This is people recognizing that now that so many of us have moved out of subsistence and safety as our primary motivators, now we can start thinking about esteem, about love, about belonging, and ultimately self-actualization. So we believe the next 10 years, the 2020s, we're going to see more growth in the boutique fitness industry than we did in the prior 20 years. And I'll take that bet with anybody who wants to have it.
And when you look at that, is this people getting more? Is this people that were drawn out of sitting on the couch wanting to be involved with fitness, or is this about taking the folks who were most dedicated and them going further into their own fitness journey, as you might say? Is it someone going from spending $150 a month to $600 a month rather than taking someone from 0 to 80?
Well, there is some of that, right? So you have a little bit of both. You have, first of all, people who already were highly engaged in their fitness. And let's step back a second and recognize that fitness is the entry point to a lifestyle of wellness. Wellness is a multidimensional concept. It's not just about being physically fit, all right? It's about emotional well-being, it's about social connection, it's about mental wellness. And so you start with fitness. You have to have a body that fundamentally works. And people recognized over the last 20, 30 years that this was increasingly important. So what boutique fitness has done is it's provide a way to accomplish that, but also have social connection. It's an experience. It's that classic third place that Howard Schultz was talking about.
Do you, when you think about MindBody, do you worry about, say, a Peloton? So they're in the wellness space as well. They're making inroads off of the bike. They have a community as well. So you guys are set up into all these sort of different boutiques and different shops, but that a Peloton could kind of do that in your house, that they would be able to take it all in as a tech platform. Is that a threat to either you or all the boutiques out there?
Not
Like,
at all.
we don't need the brick and mortar boutiques because Peloton or Mirror or somebody's going to bring it into my house.
Yeah, no, in fact, it's just the opposite. What's happening is it's broadening the market. And we've been studying this closely for several years, right? For obvious reasons, because here we're serving this bricks and mortar industry largely. And you're wondering if this technology, this virtual wellness is going to disrupt that. It's not happening. In every case that we have studied, when the brands release a video on demand or streaming video version of what they do, it actually drives more business to the bricks and mortar locations. And why is that? Because our modern life is abstracting more and more of what we do. And what we find is the more people have their lives abstracted, the more we hunger for and value face-to-face experiences. And in the case I always like to point out is like, have you checked out theater tickets lately? How about live concerts?
Right.
How about anything that involves being face-to-face? Like, why are we face-to-face right now? You could have just put me on a camera and I could have been in California right now.
And so I guess, the question is, in terms of fads, I think a lot of the market right now is looking at Peloton as, oh, well, we've had all these different fads throughout the last 30 years, fitness-wise, that came and went. Do you think that new trends are going to have a longer lifespan? Because it's not about coming up and trying to do the one Richard Simmons video and then moving on. It's really about changing your entire approach, kind of as you're describing, like your whole approach to being alive is being changed by this one thing. It's not something you're going to pick up and drop.
The only thing I'm puzzling over is, like, I actually want to know what precisely went in the last 20 years. What phenomenon would that be? Would that be indoor cycling, right? Spinning, as it was called in the 90s, actually kind of went through sort of a plateauing period, and then it ignited again with brands like SoulCycle and Flywheel and Cycle Bar. So far, what we're seeing is these modalities are really sticky. And that's because they work. I mean, in 45 minutes to an hour, a couple days a week or 3 days a week, if I'm a real enthusiast, I can significantly improve my wellness. And so that stuff really matters and it really works. And so, we think what Peloton is doing is extremely exciting, but notice Peloton, setting up their bricks and mortar locations in coordination with that. We think it's the combination of the two, the face-to-face with a digital extension, is the most powerful business model.
All right, really interesting stuff. Rick Stollmeyer is the CEO of Mind Body. Thanks so much for stopping by.
My pleasure. Thanks, guys.
We didn't even get to the wellness index.
You can do that.
Miami's so healthy.
We're going to talk about, I was going to say, I think machine weights have probably been the thing that have faded the most.
I like where you went more interestingly than like having to recite this data, the data from my own team's research report. So thank you for letting me off that
we're
hook.
interested. I was trying
Welcome
to
back anytime.
Stairmaster went away? I don't know. But
People still on the Stairmasters all the time.
Seriously?
Yeah.
Oh, wow. Who knows? We've got a lot more coming up. Priyanka Chopra Jonas joining us from the slopes of Davos. Why she's all in on her work for the annual music festival Global Citizen. We are back right after this. leaders from around the world are meeting in Davos, Switzerland for this year's World Economic Forum. Yahoo Finance's editor-in-chief Andy Serwer sat down with Global Citizen CEO Hugh Evans and Global Citizen Ambassador Priyanka Chopra Jonas to discuss the company's efforts to end extreme poverty by 2030 and Global Citizen's Global Goal Live. Take a listen.
Well, I've been working with Global Citizen for now about 3 or 4 years, and I think what was most attractive to me was how Global Citizen mobilizes everyday people to understand and give knowledge about all the issues that are happening in the world. That, you know, when people ask me about philanthropy and how they can get involved, and I'm just one person, what can I do? Global Citizen gives you the tools to actually mobilize governments. People's actions, like they can send tweets to governments, they can send emails. Basically, the idea is to mobilize the world into having people understand the urgency and the need which is right now. And I love that it gives everyday people ammunition and incentive.
Maybe we should take a step back and ask you to define exactly what Global Citizen is. Tell us about it.
So Global Citizen is a worldwide movement of millions of citizens working towards the eradication of extreme poverty by 2030 and the achievement of the United Nations Sustainable Development Goals. When we talk about extreme poverty, we're talking about those living on less than US $1.90 per day. There's about 720 million people, predominantly in sub-Saharan Africa, but also Southeast Asia and Latin America, living in that worst form of human suffering. And the whole point, as Priyanka eloquently said, of the movement is to mobilize citizens to take actions, to call on world leaders to make multi-billion-dollar pledges to eradicate extreme poverty. Because here we are at the World Economic Forum in Davos, and you walk around and you hear so many people talking about how do we tackle climate change, how do we end extreme poverty. But we need to take a step back and say, what would it actually take? And we've worked with the United Nations to calculate that the true cost of eradicating extreme poverty in the 59 poorest countries is $350 billion per annum for the next 10 years. And so our focus is to achieve that mission, to call on the world leaders who made the pledges
And made the promise
to be part of the Sustainable Development Goals, to step up and take urgent action.
And so you guys are famous for your concerts. I mean, that's how maybe the average person out there knows your organization. How do those concerts work?
It's actually really incredible. Music is such a bringer together of people, right? And as we were talking about before the interview started with Live, what was it called? Live 8, right?
Mm-hmm. The granddaddy of this kind of thing, maybe, right?
And that time they didn't even have the technology to be able to do it and to be able to have so many people involved. What happens with these concerts is you have these incredible artists that have, free of cost, committed their time and their efforts to give people an incentive to actually. People can't buy tickets to these concerts. You have to have actions, earn
I know
points.
that. I tried to get into one.
Yeah, you can.
In Central Park in New York, right?
Yeah,
I did.
you have to have action. You have to have earned your ticket there. And when you see the amounts of people that come out for these concerts, it just goes to show the kind of footprint and the kind of mark that we've made and how many people have had that kind of action.
And Global Goals is an initiative of Global Citizen. Talk to us
Global
about
Goal
that.
Live is a very,
Global
very
Goal Live,
exciting thing. I'll let Hugh explain it, but I'm very excited about it.
All right.
So, as Priyanka said, you can't earn your way into a Global Citizen Festival. And this year, 2020, marks a historic moment because in the same way that when Live Aid happened in 2005 to support the crippling debt crisis in East Africa, it happened because it was 5 years into the Millennium Development Goals with only 10 years left to halve extreme poverty by 2015. 2020 marks that same moment for our generation because we're 5 years into the Sustainable Development Goals with only 10 years left to go if we're truly serious about tackling climate change and ending extreme poverty by 2030. And so we know that this particular time, on September 26th of this year,
Which is the anniversary of the SDGs, by the way.
Exactly. It's UN Climate Week, and as Priyanka said, the anniversary of the SDGs. We're going to unite the whole planet with 7 simultaneous concerts with the largest cause broadcast event in human history to bring the whole world united as one.
In all 5 continents.
In all 5 continents to end extreme poverty, tackle climate change, and reduce inequality. And all of those concerts, this is not like a telethon. We're doing it in partnership with our great partners at Teneo, and we're working on this strategy to drive it so that everyone has to step up. Governments have to step up, philanthropists have to step up, and businesses have to step up.
Okay, I've got so many questions. What cities, what artists have committed? I mean, it's coming up soon. It's like in 9 months, 8 months, right?
And there's so many commitments. I mean, we have incredible artists like Metallica, Billie Eilish, Miley Cyrus, Coldplay, of course, and many, many local artists in all of these cities. We're in Latin America, we're in Europe, we're in the UAE, we're in North America, we're in, what am I missing? Asia. I forgot Asia.
Yeah.
We're also, no, you got it all.
Yeah.
But there are big stadiums in these big cities?
Yes, 7 concerts at the same time.
Yeah, so we haven't announced all of the specific cities. What we can tell you,
Which is why I'm telling
yeah,
you.
yeah,
vague. Right, that's okay.
Priyanka was right. She didn't want to break all the news, but we announced Dubai yesterday.
Right.
We've also announced Lagos, Nigeria. Obviously, Central Park that you referenced earlier on the Great Lawn in New York City. And we have a huge announcement coming up soon for Latin America. We've got another announcement. We announced Seoul, South Korea. And so we're announcing all the cities one by one around the world. And then by March of this year, we'll release the full lineup of every artist involved.
Now, how much money do you hope to raise on this day through all those concerts?
Well, this is the critical point, because it's not like a telethon, right?
Yeah.
You know, we're not asking people to put in $1 here and there, because that's going to raise maybe tens of millions of dollars, whereas we need $350 billion. So the whole point—
Billion with a B.
300. Yes. Okay, so this is the important point. So the United Nations has independently costed what it would actually require to eradicate extreme poverty and tackle climate change in the 59 poorest countries, and it is $350 billion per year for the next 10 years, or $3.5 trillion. It's not going to be solved through black tie gala dinners, which would be a Band-Aid for a bullet hole. You know, we need this sort of really lasting change. And so the only way we're going to do that is— the reason why Priyanka is here in Davos is to call on world leaders to start making pledges. We saw some pledges yesterday. You saw the chairman of Gavi, the Vaccine Alliance, make a huge pledge at the event we were at yesterday. You've seen pledges last night at the dinner we hosted here. And every pledge will add up towards that $350 billion target. But importantly, this is not Global Citizens' target. This is the world's target.
This is all of our targets.
Right. And you guys don't collect the money.
No.
Right? That's an important point, because some people see all that money and say, oh my goodness, like that's too much money for one entity to
this is really
be in
important.
charge of.
The money does not come to Global Citizen.
Right.
It goes to a set of pre-approved funds that we have identified that we know are transparent, are corruption-free, that have the biggest impact for those living in extreme poverty. Let me give you a couple of examples. The Global Fund to fight HIV, AIDS, malaria, and tuberculosis. It's a $17 billion fund, and they focus on malaria bed nets, antiretroviral drugs, really focused on tackling preventable diseases. And another fund that we focus on is the Global Partnership for Education, administered by Julia Gillard, who's the former Prime Minister of Australia, and Alice Albright, based out of Washington, D.C. They focus on K-12 education in the poorest countries around the world. All of these funds need urgent attention. All of them are lacking the support that they need to truly eradicate poverty, and the money goes and is independently administered. And Global Citizen then holds world leaders accountable. So if a leader makes a big pledge and doesn't follow through on it, they'll hear from millions of our members who'll call on them, who'll tweet them to make sure they follow through.
And Priyanka, talk to me about recruiting the artists or working with the artists. How involved, how passionate are they? I mean, and it's a wide range. I mean, Metallica to Miley Cyrus,
Yes.
right?
I think the idea is to take entertainment, which is such a powerful tool, as we have seen in the history of mankind, to actually mobilize people to talk about what's important. And all of these artists are so committed. So I'm going to be hosting this year with people like Hugh Jackman, Will Smith, and some incredible actors that have come together to also support this. And it's such a wonderful, powerful moment to see like the world's most incredible entertainers come together for the same cause.
And Hugh, finally, can you talk a little bit about the corporate partners and companies that are involved, some name companies?
Absolutely. So we've formed a brilliant partnership with Teneo, the world's leading CEO advisory firm, headed up by Declan Kelly. And he, together with Chuck Robbins of Cisco, Hans Vestberg of Verizon, together with Ed Bastian of Delta, Mindy Grossman of Weight Watchers, Mark Pritchard of P&G, Alex Gorski of J&J, they've really formed this incredible coalition of CEOs, Randy Freer of Hulu, who've all come together and said that they want to step up like never before. So this CEO coalition was formed, and with their extraordinary leadership, they're going to be making not just pledges in support of the concerts and events, but pledges in support of their own supply chain management. They're looking at gender equality. Are they employing enough women in their supply chains? They're looking at sustainability. Ed Bastian of Delta and I were on stage at the Consumer Electronics Summit in Vegas a few weeks ago, where they announced an initiative as part of Global Goal Live called the Great Green Wall, which they're using to offset carbon, which is focused on planting trees the width of Africa as part of their carbon offset strategy. So all of that is a huge corporate strategy to drive corporate America, and we wouldn't be able to do it without the leadership of some extraordinary CEOs.
And finally, one last quick question, I'm sorry. So for people who want to go to the concerts, how do they do it?
Well, download the app, the Global Citizen app, and it'll tell you and give you the ammunition to take action, which will earn you points. And when you earn enough points, you'll be able to come to one of the shows. It's actually
It's
really
not so
simple.
hard. I mean, in other words,
Very
you'll be able to
simple.
do it between now and September,
Totally.
presumably.
You can just you can just download the app right now. Just do it right now.
Stay tuned for more live coverage at the World Economic Forum in Davos, Switzerland, right here on Yahoo Finance all week long. Coming up, what you missed on Yahoo Finance today. We're back right after this.
Time now for all the best moments that you missed today right here on Yahoo Finance.
If you look at the first 3 to 6 months of this year, it's more than likely that this trend of expanding multiples in the S&P continues, and we could see a scenario where equities are up 10% the first 6 months. Now, after that, that's where it gets a bit dicier, because if the Fed does stop expanding their balance sheet, markets start to focus on the upcoming election, because at this point it's pretty much consensus that Trump will win re-election.
This was really a call to arms, because it's not as much about divesting in companies. It's focused on investing in companies that are going to create the new energy, help in climate change, and understanding that the world of finance is going to change as everyone is very focused on ESG. How are we going to represent that in a portfolio so that you're going to get the best performance?
We should see 5G in all metropolitan areas in the United States, as well as in China, Korea, Japan, and Europe towards the end of 2020.
Prop 65, which is, I believe, the proposal in California, has been around since 1986. They have, I think now it's up to 900 substances that are considered carcinogenics. The FDA, as well as consumer healthcare groups, have come out publicly and said there's simply no basis in science to call acetaminophen a carcinogen. So we'll have to see how that pans out. We'll monitor the situation, but at this point in time, there's no basis to believe it should be labeled as such.
We are on the verge of a fundamental reshaping of finance. We're going to see a massive reallocation of capital, and that most financial models and most financial market participants are not fully grasping the magnitude of these changes.
Overall number for 2020, they expect cash flow losses to decrease. So the fundamentals are good, because that's a big concern with Netflix. Are they going to need more cash? How are they going to fund all their new shows? So I think that fear is getting less and less. So overall, I would say there was enough for the bears and the bulls.
The thing people need to know this year is, for the first time, there's a question on the tax return: do you have virtual currency? And the IRS is looking for people to self-report, right? There's not a lot of information reporting and not a lot of support in that. And they're looking for you to come forward, and they'll be more lenient, even if you don't get it right, if you're disclosing. But yeah, a lot of interest in it, and we're ready to help.
That's all from New York. I'm Jen Rogers with Myles Udland, and this is the final round on Yahoo Finance.